Others welcomed Nasrallah's death, which has also raised questions about Hezbollah's future influence in Lebanon's crisis-stricken politics and economy. Meanwhile, in Israel, news of the killing brought both celebrations and concern. Israeli Prime Minister Benjamin Netanyahu commended the strike, but said Nasrallah's death would not be enough to end the threat against Israel. President Biden, who said he had no prior warning of the strike, has already ordered an enhanced defensive posture for U.S. forces in the region. And now there's growing fears of an Israeli ground operation in Lebanon. The coming days and weeks will be crucial in determining the impact for risk assets, for regional stability, and the ongoing diplomatic efforts to avoid a wider regional war.
Conflict increasing in the Middle East. Time for a short break. Up next, we get you excerpts from our conversation with Paytm founder Vijay Shekhar Sharma. Stay tuned. Back on the other side.
As you know, President Zelensky has asked to meet with me, and I will be meeting with him tomorrow morning at around 9:45 in Trump Tower. It's a shame what's happening in Ukraine. So many deaths, so much destruction. It's a horrible thing. I will be able to make a deal between President Putin and President Zelensky quite quickly. If I were president, it never would have happened. Russia would have never attacked Ukraine. Never, ever. We have to make a deal because the consequences are impossible.
Welcome back, and Manisha Gupta now joins us with all the updates from the commodity space. Manisha, good morning. Crude oil prices seem to be on the mend, but it's all about metals.
Oh, it is, yes. 3% of decline in the crude oil prices in the previous week, but we've seen it come back in favor right now. That's because Israel is stepping up attacks on Iran-backed forces. The second point is China's stimulus leading to support there. And third is Brent, the Hurricane Helen is forcing 25% output cut in the Gulf of Mexico. So all of these factors have brought the crude oil prices back into buying momentum there. But as you said, yes, it's all about metals. We are looking at multi-week, multi-month highs in case of metals, and that is on the back of China's stimulus measures. That really seems to be supporting. If you look at the last 1 week itself, we've seen copper prices gain up by 7%, iron ore is up 11%, even silver prices gained up by 3%. And on a month-on-month basis, we are looking at a double-digit return for all of these metal prices there. But it's going to be interesting to listen to the U.S. Fed Powell speech today, and there are a lot of Fed officials slated to speak on this week, so the further direction would come in from that one.
All eyes on metal stocks this morning as well. Manisha, thanks a lot for that update from the commodity space. Now, Paytm CEO Vijay Shekhar Sharma has said that he regrets not choosing the correct banker for the company's IPO. Remember, Paytm stock had tumbled over 30% on its listing day on the 18th of November 2021, making it one of India's worst large IPOs. Currently, the stock is down 69% from its offer price. Sharma added that Paytm did not attract VC investments in the initial 7 years since the inception of the company, and that he has been a bootstrapped entrepreneur. Listen in.
I have a regret now, not in the joining of entrepreneurship. I've been an entrepreneur for long enough now. I have a regret of not choosing the correct bankers for IPO. If you choose the correct bankers, जैसे भगवान के मंदिर में जाने के लिए आपको सही पुजारी चाहिए होता है, शायद हमने वो नहीं choose करे तो उसका choose the right banker, my friends. अभी तो छोटी-छोटी IPO भी इतनी बड़ी हो जाती है. In Iran age, it was driver making a crore. In Paytm's case, I know 20 people who made ₹1 billion, 100 crores.
Excellent.
20 people. And many of them cashed out more than 100 crores. I'm a bootstrap entrepreneur who had to do a lot of cash generation by the business. And in that rush, I learned only one thing for ladies and gentlemen in the room. There's nothing called P&L. This profitability, which is a P&L, which is an opinion. The real truth is cash. Everything else is a trash.
Vijay Shekhar Sharma, candid as ever. But that's a wrap on this edition of Power Breakfast from me and the team that put this show together. Thank you so much for watching. Bazaar Morning Call up next to set you up for today's trade.
India has been the preferred market. The question is, will China outperform just in the near term? So India is the one that you want to be there on a structural story, but could there be a tactical shift to China? And will China come to the party finally? Let's put up, all the headwinds for China and all the tailwinds for India. India, well, the big macro tailwind, low energy prices, the demographics are in our favor as well. Consumption has been strong, onshoring as well as lower unemployment. Those factors have worked for us. While for China, well, the housing bubble has been an issue. They have been having their geopolitical issues, both with the United States, with Taiwan as well. And the business confidence has been depressed out there. The youth unemployment is another factor that's working against them. But if I just pull up a chart of MSCI India and compare it with China in dollar terms, you'll see it was pretty much working okay. And then from 2020 onwards, there's a bit of a breakaway that we saw in the MSCI India markets. And that's the reason why, in fact, all the reasons that I put up for you on the screen, that's exactly the reason why, in fact, we did play out. And if you market weight of the MSCI AC World IMI index, India, in fact, has taken over China out there. But the one we normally look at is the MSCI Emerging Market Index. And out there, India, around 4 years or so ago, the weightage that India was occupying was only around 8%. China was at around 45%. Now, they've quickly, almost converged now because India is up to nearly around 20%. And you have China, well, that's come down to around 25% or thereabouts. So just take a look at the big move that we have seen all the way from that 8% mark all the way to around the 20-21% mark. And that's another reason why India has been getting a larger part of the funds. Now, Chinese authorities, they believe that they need to stimulate the economy, and they want to see them achieve the GDP growth target of around 5%. So a few measures that they've done. The reserve requirement ratio, they have cut it by around 50 basis points. They're talking about 20 to 25 basis points from here on. That could free up close to around a trillion yuan for new lending. So that's point number one. The other one is the stock market, the capital market focus as well. And with the measures that they have come about, what could happen is it could increase the capital market participation.
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, starting a new week, a holiday shortened one at that, midweek holiday for the 2nd of October. And of course, we're kind of kicking off a new month as well, which means we finished the last month and we finished a quarter. So, I mean, beginning of new things in that sense. Will it be new for the market as well? Or will we continue to roll higher like we have? That's the question. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Hi, good morning. I realized looking at us, the colors, the blues, the pop, the flowers, it's all because the most important cue,
it's
Wednesday.
It's a truncated week.
It's a truncated week. But we have so much news to digest, right? So much going on around the Asian neighborhood. And then, of course, we have a new entrance on the Nifty. So plenty to get us started on this Monday.
Oh, absolutely. And I think we start with what essentially came through over the weekend because, globally, the big talking point, of course, was the turn that the Chinese markets were seeing. And we saw a fair bit of action on Wednesday, Thursday, Friday. And it did not stop. Actions kept coming in on Saturday and Sunday as well. So I'll start there. So China has essentially announced more measures over the weekend. Authorities essentially have asked three things. Authorities have asked, in line with what the central bank there, the PBOC has said, they've asked all banks to cut mortgage rates by the 31st of October, one. Second, yesterday there was a meeting, the State Council, chaired by the Prime Minister, echoed what the President said, President Xi said. And specifically, they vowed to speed up 102 key investment projects. These are not new projects. They were announced in 2022, but they've said they'll speed it up. And three of the top sort of tier one cities in China, Shanghai, Guangzhou and Shenzhen, they've announced significant sort of property loosening policies, essentially making it easier to buy property, lesser down payment ratios, etc. So these are the three things which have come through over the weekend as we hit this new week, that is Monday. Now, what complicates the picture in a sense, right, is the fact that China is shut for most of this week. So from the 11th to the 7th, from the 1st to the 7th, which is Tuesday to essentially next Monday, China essentially goes into national holidays, the Golden Week, as it is called. Hong Kong is still trading. So, the China proxy in that sense, a lot of Chinese mainland shares are listed in Hong Kong. And foreign investors prefer to trade on the Hong Kong market rather than the mainland market. That market will be trading except Tuesday. Tuesday, Hong Kong markets are shut, but they're trading otherwise. So those are two things. This morning, if you looked at what's happening with Japan, you'd wonder, well, whoa, 4% cut. But the fact is that the Japanese market had shut by the time election results had come out on Friday. And, you got a new prime minister in place, and the market there is concerned about whether, he'll kind of want to normalize policy and what kind of policies will he really adopt? Fiscal conservative, will he be fiscally conservative, etc., etc. So the market futures, by the way, on Friday were down 6% this morning. Cash is down about 4% or so. So that's Japan as well. So a bit of Asia. I mean, nothing very much from the US market on Friday. I mean, they were slightly down, but the Nasdaq was down 0.4%. Yields were here and there, but I mean, the dollar, I think, is what you should focus on. It's back in the support zone between 110.5 to 110.8. We are somewhere there, and a break below this. This is the, as we've said, 20 weekly and lows of 2023. You perhaps see a fresh leg down, and oil prices, there is this China stimulus. Of course, this what's happened in the Middle East over the weekend and Lebanon specifically, and oil is right there. There's no big pop or anything of that sort. So that's interesting to note as well. Now, in the US, you've got a bunch of data points which are lined up. And I think it will culminate with the non-farm payrolls number on Friday, and that will be the big number to watch out for. I'll just circle back and finish up with the levels here. So that we're trading on Friday, the indices were down. Nifty was down, Bank Nifty was down. So we had a daily negative close, but we were up about 1.5% for the week. So if you're wondering where the weakness is setting in, we are still trading above the 20 and the 40 hourly exponential moving average, simple and hourly exponential averages. So there is no sign of reversals yet. As far as the indices are concerned. Now, we must stay above the 40 hourly exponential, which is 25,970. As we keep climbing higher and higher, you got to be mindful of trailing reversal stops as well. And to my mind, from a very near-term perspective, that number is important to be held on to, 25,970. Now, on the upside, you basically have got to project targets, Fibonacci extensions, 26,521. We put this out earlier as well. We'll see when that happens. Nifty Bank, it closed around the 40 hourly exponential. Actually, we closed slightly below the 40 hourly exponential. We'll see if we stay below it. That's not good news. That is 53,841. We left off at 53,834. So just under that 40 hourly exponential. The supports here below the 40 hourly come in at 53,500 and then 52,900, and targets on the upside basically is the swing high, which is 54,460 or so. So that's essentially a quick picture. It's looking okay. Market's done quite a bit. Some consolidation would be nice. But the bigger question is, which many people are worried about, is whether, maybe too much is done and maybe there is a pullback due. And there you need to watch out for some of the levels that we put out, both on the Nifty and the Bank Nifty as well. Gift Nifty is indicating about a 60-odd point lower start. Surabhi.
Well, absolutely. Prashant, I guess it's all the headlines coming from Asia and two big markets moving in absolutely different directions. In fact, make that cut on Japan now almost 5%. That's the extent of the fall. And let's also pull up the dollar yen, because the currency markets had exhibited this nervousness on Friday itself, because the yen had leapt up almost 2% on Friday versus the dollar. Today, it's eased off a little bit, but nonetheless, it's still around that mark of 142 thereabouts. So what is the issue? Just a moment here. Shigeru Ishiba is the gentleman who has won the leadership of the current party that holds power in Japan, which is the Liberal Democratic Party. He was earlier the defense minister of the country. And he's seen as a bit of a hawk when it comes to monetary policy. And therefore, the market getting a little worried, the yen surging on Friday. But on the weekend, he made some comments to one of the telecasters, the national broadcasters, I think, in Japan, where he said that monetary policy must remain accommodative given the current economic conditions. And that gave at least the currency market some hope. But the nervousness is still very, very palpable in the equity market, as one can see. So that's the picture on Japan and how that's playing out. In China, the Hong Kong market continues to build on what was a tremendous week. There was a 13% rally in China. All put together in the month of September, the Hong Kong market is up 18%. No one comes close to that. And what we've got this morning is some fresh data. It's actually a pretty good data, manufacturing PMI. This is the official PMI number out of China. The contraction is reducing. So for the month of September, this official PMI is 49.8 versus 49.1 in August. So still contracting, but not as much. So that's the good news coming in. Speaking of data, the US market itself, usually September is a challenging month, but not this time around. It's the first time that the US, in all probability, today is the last trading day, will manage a positive September for the first time in 5 years. And the data that came in even on Friday, that continued to play out the Goldilocks scenario, because inflation, that's easing, and growth continues to be a little lackluster, you can say. So why do I say that? Look at the numbers. The PCE price index was up just 0.1% in August versus 0.2% in July. And the consumer spending number, which is the really important one to track in the US market, their consumer spending was up 0.2% in August versus 0.5% in July. So the consumer perhaps continuing to be, in a bit of a spot of bother. And that plays with the Goldilocks scenario. This is the situation on oil last week. This morning, there's a bit of a leg up on prices, around 72.5 on Brent. But whatever's happened overnight in terms of geopolitics, with the big headlines coming in, the Hezbollah chief Nasrallah being killed in those Israeli strikes, none of that has impacted the oil market, including the statement from Mr. Benjamin Netanyahu that Israel is not done. Because why? It's not impacting exact barrels in the market just yet. If anything, there's talk of Saudi Arabia increasing production, and that's keeping the oil market really well supported. So all things put together, the global backdrop is still very, very positive. Quickly coming back to cues here at home. Let's look at the fund flows. Foreign institutions, net sellers of around 1,200 crores, but massive buying coming in from domestic institutions. Obviously, a lot of block trades as well there, but nearly 7,000 crores of buying coming through. In the month of September, it's the return of the large caps. That's the biggest trend that sort of stands out in our market action. Almost 4% up on the Nifty, mid-cap about 2%, and the small cap index is actually slightly negative. And right in step, we have two new Nifty members joining the index today. The rise of Trent, the stock finally enters the Nifty, as does BEL. And of course, Divi's and LTI Mindtree go out. So it's all about the large caps. And we'll see if this trend continues in October, Nigel.
Well, that's right. You know, for me, I'm watching three big points. And I believe that the buy on dips on the Nifty, that's intact till lower levels get taken off. So that's point number one. The problem is, though, the GIFT Nifty is indicating a bit of a pullback today, maybe a 60-point downtick because geopolitical issues have crept back in. The good news is that crude oil prices are virtually unmoved. And point number three is, there's been that raging debate. China is bouncing back. Will it be a threat to India? Well, Kotak has put out a note. They believe that China may rally. It may so. But they don't believe it's a big threat to the Indian market rally because domestic flows are very, very strong and earnings as well is very, very strong. So those are the top 3 points. Let's move on to what happened in Friday's trading session. Why did we end lower? Because the Nifty Bank, that took a bit of a breather. That was down 550 points. But there was more unwinding of positions that we saw on the Nifty Bank itself. And I think in the near term, you want this 53,500 odd mark to hold out because the rally has been very, very ferocious. So the 20 DMA is much deeper, but that's the first line of support that you're looking at. What about the FIs? Well, the FIs, they added some long positions. There were some mild shorts that they covered out as well. They remain aggressively long with 81% of their positionings on the long side. The FIs, well, they're net long, 3.5 lakh contracts on the long side. You have the clients that are net short with 2.5 lakh contracts on the short side. Give and take everything. Let's pull up the options data. And this is a truncated week, so you only have a couple of trading sessions before these contracts expire. And normally you see, a bit of a short straddle that could possibly take place. And there appears there's a strategy in place. The 26,250 call and put, fair bit of open interest build up. You put it together. The premium you pocket is around 300 rupees. So you add 300 rupees to 26,250 and you deduct it from 26,250, which gives you the broad range that you're looking at. So this is the tightest range that we're looking at going by that option strategy. But it's going to be all about stock-specific action, right? So I'm looking at, a couple of them. One is the Flipkart sale. It saw a very, very good response. I was reading a CNBC-TV18 article on our digital platform today, and the response is very, very strong. So I'm looking at a couple of stocks, Delivery as well as Blue Dart. Logistic companies could be in focus. Both these two. The other one I'm looking at is Reliance Infra. They've got a favorable verdict from the Kolkata, courts out there. They've ruled in favor of the company. And we're seeing that the stars are aligning for this one. Sunny people are talking about the assets that they have. They've got some infusion as well. And the 20 DMA is deep at around 260. So not a one for the faint-hearted, but Reliance Infra seems to have been getting its mojo back. So I'll keep an eye out on this one as well.
All right. Okay. So plenty to track as this week kicks off. Let's actually get you the equity call of the morning as well. Alexander Redmond of CLSA says China policy went into overdrive last week. He says the recalibration in scale and urgency of stimulus was applauded by investors, yet questions persist. Firstly, the motivation, he asks. Is this a quick fix for 5% GDP in 2024 or the beginning of a braver, more innovative solution for sustained growth? Secondly, on results, Alexander asks, will last week's initiatives be sufficient to break the deflationary deadlock by reigniting domestic demand? He says the answers will dictate whether the equity frenzy is the fifth bear market rally since March 2022 or something grander. He says they resisted underweighting China in the belief that the market offered the greatest self-help opportunity in the emerging market landscape. But for now, he says that they rent rather than buy the rally, staying benchmark and exposure larger than most funds. So that's the CLSA call coming in, still asking lots of questions on the durability of the stimulus.
Okay, well, so that's the view coming in from Alexander Redmond of CLSA. Ed Yardini is with us, president at Yardini Research. Ed, great to have you back on the program. Thank you for your time. Good to have you here. I mean, I think over the last 2-3 years, we've had, I think, 3 of these instances where we've talked about whether this is it with regards to China and the turn that and some of these measures that we're seeing. So we're at one of those moments again. The thing is, each of those rallies have been very large, between 40-50%. So actually, you can be in it and then without having to worry whether this is because the moves are so large if you get in reasonably early. Do you think it's one of those, Ed? What's your sense?
I think it is one of those. I think it's to a large extent a technical rally. There was a tremendous amount of bearishness before the government of China acted to provide a lot of stimulus. And so there's a lot of short covering, obviously, and then expectations that it's going to work. I'm skeptical because I think at the end of the day, what China needs to do is stimulate consumer spending. And I don't think it's going to be that easy. I don't think offering lower mortgage rates is necessarily going to bring Chinese buyers back into the real estate market. Maybe it'll stop prices from falling. But at the same time, I think they're still going to have a significant residual negative wealth effect in real estate. Maybe the stock market rally will provide some positive wealth effect. But again, the market's down substantially over the past few years. And then there's the whole geriatric demographic profile as a result of the one-child policy. So I'm not convinced that this is going to do what China needs to do, which is stimulate consumption, stimulate more births, more family formation. But it probably sets a floor for now, anyways.
Mr. Yadni, hi, good morning. So
Morning.
what does this mean? What could it possibly mean for India, where investors anyway have been neutral? We're not even neutral. I mean, they've been underweight on this market. It's been a domestic-driven rally. And now you have these big moves out of China, the tactical move perhaps to that country. So what should we expect? Some more foreign selling here and then a shift in flows? Or would it be possible anyway as investors get back into emerging market funds where we have presence of both India and China?
Yeah, well, I think one of the key points here is that central banks, the major central banks, are pumping liquidity back into global financial markets. The U.S. cut the Fed funds rate by 50 basis points last week in the middle of the week. And by the end of the week, the Chinese were cutting their interest rates and reserve requirements. And so there's a lot of liquidity pouring back into the global financial markets. And that means that if China goes up, it doesn't mean that India has to go down. I think both markets could do well in a global melt-up situation. I think the Fed, by cutting 50 basis points in an economy that looks quite good, as a matter of fact, a lot of the numbers were revised higher for GDP and for personal savings on Friday. And so the U.S. economy looks pretty good, and you kind of scratch your head wondering, why is the Fed so rushing to lower interest rates here? Well, all that liquidity is going to create the potential for a melt-up. Look, I've been thinking the S&P 500 could hit 5,800 by the end of the year. Well, we might get there tomorrow or the next day, the way things have been going. And valuation multiples are awfully high. So I think we're in a melt-up situation on a global basis.
All right. Hi, Ed. Morning and good to see you, Ben. What does it mean for an Indian market, though? We have been big outperformers. We're not trading cheap. And suddenly you have the Chinese market coming back into play. And they are also going to deliver double-digit growth, but we are going to deliver high teens. The toss-up between the two in the near term, as you said, both could do well. But in the near term, do you think there'll be a tactical shift towards China?
Well, I think there's so much money sloshing around in the global financial markets that I think it's really conceivable that China might continue to rally here on the hopes that the stimulus will turn their economy around. And yet there'll be plenty of money left to continue to invest in India. So I don't think it's a zero-sum game. I think what we're seeing here is that central banks have basically brought back the everything rally. We're seeing stocks going up. We're seeing copper going up, gold going up, Bitcoin going up. So all that liquidity suggests risk on, and it suggests that central bankers are back to their old game of probably providing way too much liquidity.
All right, Ed, we leave it there. Thank you very much for your time. Great speaking with you. So I think the answer is too much money sloshing around, right? So that's lifting most things, most boats, and that is absolutely correct. Central banks have just about opened with rate cuts, and the Fed has done it, and China has done it, and perhaps others will follow as well. We'll take a quick commercial break here. The first on the program, just a quick tease out of our stocks that you'll hear on the other side. Gale, Zydus Life, Olympic Pharma, Piramal Pharma, Keynes Tech, Wellspun Enterprises are stocks which perhaps should open up in the green on the back of news flow. Biocon, Lupin, Angel One, 5 Paisa are some of the stocks which perhaps open in the red. So that's coming up with our research team. Stay with us.
Okay, let's tell you the corporate interactions that are lined up on the show today. Well, coming up at 8:30, we have the management of PB Fintech joining in to talk about the company's potential plans into the healthcare segment. At 9 a.m., we'll have the management of KC International join in to talk about their recent equity fundraise. They've done a QIP recently, and of course, a bunch of order wins have come through. So we get chatting with Mr. Vimal Kejriwal. At 9:20, Pankaj Tibrewal of Ikigai Asset Management joins in, and he's the market master, so he gives us some perspective on how we are poised. At 9:30, we chat with Aadhar Housing Finance to decode the outlook and the way forward for the housing sector.
Okay, we'll also have, expert joining us to discuss how the impact of exchanges increasing, a trading fee. So Rajesh Palviya will be with us to help us with that. And a little later, after that, at 9:50, the management of Zentech will join in to talk about, the implications for their business because of the new weapon system. Towards the end of the program, Lata will be in conversation with Ashish Agarwal of NASSCOM and Megha Chavla of Bain & Company. That's later at 10:15.
Okay, all right. Well, time to slip into a short break. On the other side, we'll address all the top stocks that we're tracking for you. Don't go anywhere.
This takes me back to a conversation that I remember having with Mr. Murthy about starting Infosys. And I said, like 7 of you, of course, he was the first among equals. But I said, how did you get a decision made? Because, and especially we are known as argumentative Indians for a particular reason. What was that like? And he told me, he said, look, it was very simple. We had a sort of unwritten rule that in God we trust, everybody else brings data to the table. What was it like for you?
So we started with a smaller group. As Pramath was saying, Sanjeev, Pramath, myself, only a couple of others. It was a small group. And I think we spent a lot of time. So even as a precursor, we used to meet one Saturday a month at my old office, and we would have conversations. And this happened for a couple of years. So I think that helps with alignment. And then ultimately we said, we want to build a liberal arts and sciences, an interdisciplinary university. So everybody was aligned. This was going to be
And some people did get off the ship.
Yeah, because some people wanted something else. So we were very clear that Indian higher ed had become too specialized, that we needed a new institution that really provided breadth and depth, that was interdisciplinary and holistic, and that gave students choice. So we agreed on the principles. We agreed on some of the disciplines we would cover and what we wouldn't cover. And we also said that we have to hire the best in the world to come, and the pedagogy has to be exciting. We'll primarily be undergraduate to start with.
Right.
And then over time, we'll build out a very strong PhD program. We won't have a very big master's program. So I think we spent a lot of time. So we were aligned on what the broader purpose is, the vision, broadly what the strategy is. And then we were able to bring in many other people. So we also had a governance model where we said, even if you put in a lot of money, you still have one vote. And you operate through...
How did that conversation go?
Well, I think a lot of it depends on, Sanjeev and I were initially the 2 largest contributors. And we said, we are going to do this. So it just became the norm. And we just went to everybody. When actually there was someone who wanted to put a lot of money in, wanted more than one vote, we turned that person down. So it's just a principle you stick to as you build it out. But we never realized when we started that we could end up becoming the largest, we think, collective philanthropy project in India. We've raised about 3,500 crores, Shireen, in pure...
Welcome back. Lots of stocks to track as Monday kicks off. Let's straight away get down to the CNBC-TV18 list of top stocks to watch. Our team is standing by with all the action. Guys, good morning to all of you. Sonal, let's kick it off. Why are you watching out for GAIL today?
Well, GAIL is in focus because they have updated the exchanges that two of their major pipelines, those will see a delay in completion or at least commencement of their operations. The first one is the Srikakulam-Angul pipeline, which was supposed to start in September 2024, will start in June 2025 now. And there are three more pipelines. The names are there for you on the screen. Instead of starting on 31st October, they will be starting on 30th June 2025. The company says there are a number of reasons. The bigger reason being they have not received approvals at various state levels or local authorities, and that's the reason they are not able to go ahead with the completion in time. While GAIL's work on the side of construction is mostly done, they are waiting for approvals now.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Ekta. She's here to tell us about some of those pharma stocks. Ekta, morning.
Morning. Well, I'll start with a couple of stocks. Actually, a lot of news with regards to the US FDA and inspections being completed in the past 2 days. So Alembic, for example, will be in focus because they've received an establishment inspection report for their oral solid facility. The inspection was for 17 July to 26 July. So the stock should be in the green on account of that. Biocon, I expect the stock to probably be in the red because they've got two facilities that have been inspected. The US FDA issued 4 observations to the API facility in Bangalore, which was inspected in September. And the companies issued 5 observations across their drug substance facility, which is in Malaysia, which manufactures insulin, and 3 observations in a separate facility in the insulin manufacturing facility in Malaysia. So totally 8 observations is what they've got for the insulin manufacturing facility in Malaysia, but in 2 separate units. So that's important to note. Piramal Pharma, companies received an EIR for their facility in Ahmedabad, and Zydus, they've received a US FDA nod for a drug which is used for cancer patients with prostate cancer. It will be manufactured in Moraya, the Ahmedabad facility. Size of the drug is quite big, $869.4 million.
All right, Ekta, thank you very much for that. Well, more stocks with news flow. Vamakshi is here. Vamakshi, morning.
Well, good morning, Prashant. Let me first start off with Keynes Tech. Expect the stock to open in the green, and that is because the board has entered into a share purchase agreement to acquire 100% stake in Iskra Meco India Private Limited for a total consideration of around 43 crores, which pegs this deal at a valuation of that is the price to sale at 0.66 times based on the FY24 revenue of the company. Keep in mind that Iskra Meco India is engaged in supply, installation, operations and maintenance of smart meters in India, and this in turn will enable Keynes to increase its product line and service offerings. Apart from that, keep an eye out on Welspun Enterprises as well, and that is because it has been declared as an L1 bidder by the BMC for a project worth 1,990 odd crores. This is to design and construct tertiary treated water conveyance tunnel from a wastewater treatment facility in Dharavi to another one in Ghatkopar. Apart from that, keep an eye out on Angel One and 5 Paisa Capital, and that is because NSE and BSE have updated their transaction charges to comply with SEBI's circular, which was issued on July 1st. The SEBI circular directed MIIs, that is market infrastructure institutions, to discontinue the practice of levying slab-wise fee structures, which was dependent mainly on volumes of the trading members. And instead of that, the circular has directed MIIs to now follow a fee structure that is uniform and equal for all of its members. Overall, this announcement is expected to be negative for discount brokers like Angel One, 5 Paisa, and that is because under the earlier slab-wise regime, these brokers would pocket the difference between the transaction charges charged to a client, which were generally higher, and the applicable transaction charges that were payable to the exchanges, which were generally lower on account of their high volumes. The estimated impact on brokers' revenue was also stated. Angel One believes that an 8% impact could come in on the revenues, as they had told us back in July 2024. So given those factors, going with the red for Angel One as well as 5 Paisa.
Okay, got it, Vamakshi. Thanks very much. We'll watch out for these stocks as well. Let's quickly recap the list for this morning. Stocks that have positive news flow around them are GAIL, Zydus Life, Alembic Pharma, Piramal Pharma, Keynes Technologies and Welspun Enterprises, while stocks with negative news are Biocon, Lupin, Angel One and 5 Paisa Capital. Okay, let's look at what's happening in the world of commodities. Lots of geopolitical headlines coming in over the weekend, but they haven't moved oil prices much. Manisha is here with the latest. Good morning, Manisha.
Morning, Sylvie. Thank you for that. Well, yes, the crude oil prices actually fell 3% in the previous week, but we are looking at some buying in the Asian markets right now. Well, the Israel stepping up attacks on Iran-backed forces, also China stimulus, and then you have the Hurricane Helen also forcing 25% of output in Gulf of Mexico shut are some supportive factors here. But yes, it's not a runaway rally. The rally is what we've seen has been in case of the metal prices. So when you look at the week-on-week and a month-on-month gains, the metal prices clearly seem to be outperforming there. China has put the most aggressive stimulus since pandemic, and that has been supportive. So we've seen copper prices give you the best weekly gain in 4 months. Nickel is trading at a 1-month high. Silver prices in the previous week hit a 12-year highs as well. While the markets seem to have seen some profit taking by Friday evening, but Asia yet again is trading in the positive. And this week you have the US Fed chair speech, PMI data, and a whole host of data coming in from Europe and China as well. And the markets would be reacting to that.
All right, Manisha, thank you very much for that. So lots to track, and that's commodities in focus. We're going to take a very quick commercial break here. We're going to come back and we'll have the management of PB Fintech and we'll discuss, the news flow around PB Fintech. Are they entering the healthcare space, and what shape, form will there be investments required? Yashish Dahiya, Chairman and Group CEO at PB Fintech, and Alok Bansal, Co-founder and Executive Vice Chairman at the company, join in to take us through some of that thought process. Stay with us.
Money. We've had people like HDFC Group to Axis Bank to the Bajaj Group support Ashoka at scale. Individuals, R.K. Damani, Mr. Jhunjhunwala, Rakesh Jhunjhunwala, many others have contributed. 200 founders have contributed towards building this institution because they believe it's an important project for the country, that India needs a new institution. That's a new form of education for India.
What is the Ashoka differentiator?
Where when we first dreamt of Ashoka, we had no idea that students from 40 countries would be applying to our university. Now our aspiration is, why shouldn't it be one of the best in the world?
We are the best option for anyone wanting to do high quality scholarly academic work in India.
You firmly believed in was that this must be an institute that's also inclusive.
We are perceived as being elite. I think that's largely because we do get very good students, and some of them from the very best schools. So I do think we're serving the country in one way, which is we're preventing the dollars from going outside. Individuals, R.K. Damani, Jhunjhunwala, Rakesh Jhunjhunwala, many others have contributed. 200 founders have contributed towards building this institution because they believe it's an important project for the country.
So we see Ashoka's mission to really be able to serve the country in solving these problems with the cadre of young people that we are feeding into the workplace.
If you want to maximize EBITDA, you'll be a teaching shop. You'll ignore, why would you run a PhD program? It's pure cost, no revenue. Right?
So how do you look at ROI then as far as Ashoka is concerned?
It's impact. We eventually will term out, and alumni, once they have matured, will take our place. We have no owner. There's no one family that backs this place.
The myth is that, if you study history or philosophy or political science or English literature, where will you get a job?
I'm a classic example of that. I studied philosophy and guess where I am. So
we have students who've turned down Berkeley.
Welcome back. Let's straight away get this conversation going with PB Fintech. The company has been in the news of late because there's been a fair amount of chatter on whether they are looking at a full-blown healthcare foray, and if yes, then what is the shape and form that this foray could perhaps take. We have with us Yashish Dahiya, Chairman and Group CEO at PB Fintech, and Alok Bansal, the co-founder and Executive VC at the company as well. Gentlemen, thanks for joining in. Yashish, morning. Let me just, take the straight question, the elephant in the room. Describe to us, when you say we want to enter the healthcare space for improving customer experience, what does that mean? What is this network that you're looking to build? And also the critical question from a market perspective is, are you going to start building hospitals or buying hospitals? Because that involves a lot of cash and that becomes an asset-heavy business model. What are you thinking?
Yeah, first of all, let's just clarify one thing. PB Fintech is looking to make an investment subject to board approval in a separate venture, which actually is not a PB Fintech subsidiary. PB Fintech would probably be a minority investor between 20 to 35% equity holding, right? And this venture, for lack of a better word, let's just call it XYZ. XYZ has its own life beyond that, and PB Fintech's liability is limited to that first investment. It does not have any compulsion to keep investing into the future, right? And all this is subject to board approval. Now, what is XYZ wanting to do? And what is PB Fintech's interest in XYZ, right? XYZ just looks bad, so let's just call it, let's keep calling it XYZ. So XYZ wants to build an HMO. What is an HMO? HMO is an outsourced facility of hospitals which is aligned to the insurance industry. Today, 4 crore 40 million Indians are buying health insurance, and they pay about 10,000 rupees every year to the insurance industry for this, which is about 40,000 crore rupees. And they say, look, whenever any of us 4 crore fall ill, you take care of our expenses. When they go for these expenses, they have something called a claim. And in that claim, there is a lot of pull and push. Why is there pull and push? Because there is a lack of trust between the insurance company, the hospital, and the customer. And one of the ways to align for this lack, what is the lack of trust, right? Insurance companies feel this treatment may or may not have been required. This was an over-hospitalization. This was an overcharge. This particular cost should not be included. Now, at the same time, healthcare costs have been rising. ARPOPs have been going up. ARPOPs have increased by 40 to 50% in the last 5-6 years. And that is not something that eventually who has to pay for it, either the customer or the insurance company. So an ARPOP increasing is great for the profitability of the hospital, but an ARPOP increasing is not great for the insurance industry or for the customer for that matter. So this is a big pain point of conflict. And what this does for the customer is creates...
Yashish, hi, morning. Morning. You know, we'll just come to some of the details in just a bit, but you gave us the headline straight up. You said that PB Fintech, essentially you're incubating a separate company and you are going to put in...
We are not even incubating. We are not even separate company.
It's going to be a separate company in which PB Fintech will have 25 to 30%, possibly subject to board approval.
Yes.
Okay, 20 to 30%, subject to board approval, and I'm assuming subject to shareholder approval as well, right? At some point. Could you tell us what is the investment that you're looking to make?
It might be somewhere between $0 to $100 million.
$0 to $100 million. And you're saying that it's not necessary that after that initial investment...
It's a one-time investment. Okay. It is not a recurring investment.
But after that, will there be some sort of assurance that you will not put in more money to work?
After there is neither assurance that way, nor is there an assurance that we will keep putting money, right?
Okay.
The intent is not to have a recurring investment. The intent is you put in the money first time, and after that, the company has its own corporate governance and its own objective to carry on. And whether that company does an IPO, whether that company raises money, think about it. When InfoEdge invested 20 crore rupees with us, the maximum InfoEdge could have lost is 20 crore rupees. InfoEdge did not have any obligation to carry on investing. After that, Intel Capital came, then Inventors came, and then Tiger Capital came. But InfoEdge did not have the obligation to keep investing with us. And
I completely
was not getting into the insurance distribution business.
No, I completely agree. And I want you to explain this HMO as well, but just the basic hygiene details, if you can. Will it be north of $50 million? Will it be closer to 100? I mean, some sense.
We don't know right now. It's 0 to 100. PB Fintech might prefer it to be 0. But if an industry utility is being created, PB Fintech is interested in an industry utility doing well, it may invest up to $100 million. But that's the broad range. And that too is subject to board approval, right? It's not like management can go and do it on their own.
Okay. Just a question. Yashish, you said obviously it's all subject to board approval. When do you take it to the board?
we're not in that stage yet. See, you guys and, I think ET basically broke the story somehow, but we're not in that stage when we are going to the board kind of tomorrow or anything of that sort.
No, but I understand, but that's why this conversation is really helpful, so that investors exactly know what's the thought process, and it'll take its own due process. I mean, board approvals, etc.
I would say that time frame is perhaps quarters, not years.
Okay.
But yeah, it's quarters. It's not weeks.
In this year, this financial year, or the next?
How do I know? It depends on where the other partners also get together, right? It's when that company says, I'm ready, I have finalized all my investors, and now is PB Fintech ready, is when we would have to take it to the board. We can't take it to the board till that company, XYZ, tells us that I am ready with all my other partners. And yes, we may now invest.
Fair point.
It's not something we can control.
No, fair point. Absolutely. So, which is why let's go back to the original point that you were making. Now, we've understood that PB Fintech will only invest 20 to 30%. I mean, that's the extent of the stake. And it could be, the cap is 100 million. That's what you've kept in mind, at least as of now. We've understood that. Now, let's look at the contours of this new healthcare company that you're speaking of. Apart from PB Fintech, who are the other, potential co-founders? How is this going to be set up? And again, what's the strategy? Not buying hospitals, setting up hospitals, working with a network of hospitals. What's the model? And has this been done anywhere before?
No, sure. So the model is essentially an HMO model. And this entity is obviously finalizing with its other investors and other partners. They could be healthcare companies, they could be insurance companies, they could be development finance institutions, they could be private equity players. There's a whole bunch of people that it will speak to. Now, what is this entity trying to do? It is basically saying, for the 4 crore people who buy insurance, I want to give a hassle-free experience. They should not interact with 2 words, bill and claim. They should come to me for getting treated, get treated, and go home. And it's my job to make sure they stay healthy. So I would probably overinvest a bit in their wellness, in their care, in their post-hospitalization treatment, so that their chances of falling in and coming back to hospital are the lowest. Please appreciate. No, it's a very important thing I'm trying to say. This entity actually makes more money if its hospitals are empty. And I think that is where people have not understood what this entity is trying to do.
Exactly. So yeah, absolutely. Let's also bring in Alok. He's been patiently listening to us, quizzing you. Alok, that's exactly what we need to understand, that this new, and it sounds actually almost too good to be true, right? Because as Yashish very rightly described, up until now, the interests of a hospital company and the patient or the insurance company have been at odds. That's the way the model works. The hospital wants to maximize profits, and the insurance company or the patient wants to minimize cost. You are looking at setting up this new company, which is going to bridge the gap. How is that even possible? And again, who are the other investors or potential like-minded sort of people who will come together with you on this foray?
Here, Yashish mentioned there are 2 parts, right? One part is whether it's good for the insurance industry or bad for the insurance industry. And if it's good for the insurance industry, it's good for Policywala or PB Fintech as well, right? So there's a part which I think we have explained enough in the last 5 minutes. Now, coming to this particular venture, there are 2 parts. One is the asset part, which is the hard part in terms of hospital, land, building, whatever. And the second is the operation and management part of this, which actually controls the customer experience. Our interest and the industry interest actually is to manage that O&M part. If you manage the O&M part, asset can be owned by anyone. If you look at a lot of examples from manufacturing across the world or hotel industry from across the world, you don't need to own those assets. You need to own the experience. Now, when it comes to...
But the asset owners, Alok, but whoever is the asset owner, you might be renting the asset, I get that, and this is just an operation and management. Whoever is the asset owner, they will want the highest ARPOB. At the end of the day, they'll demand from this company, right?
No. So this is not asset owner in terms of hospital, right? This is asset owner in terms of... Just think of Taj Hotels managing some hotels which are owned by someone else but managed by Taj. Or Apple getting someone to create a phone for them, where they manage the design, they manage the marketing, they manage the brand, but someone is creating that phone for them. They're manufacturing the phone for them. So the person who is owning the asset has a very different alignment. A person who is managing the experience has a very different alignment. Now, in this particular case, the investment is going into an entity, or it's proposed to go into an entity, which will eventually own the experience. But to get there, you can't have on the day one that, okay, I'll manage the experience, but someone owns the asset. Just think of how McDonald's would have started. They would have created few their own units and then got into franchisee model, right? So you have to start somewhere. You have to do the POC, and once you have done the POC, then asset can be owned by anyone.
No, absolutely. I had a couple of questions and we're running out of time. So very briefly, Yashish, will this be a conflict with other hospitals?
We are not even thinking about that. This hospital is going to be aligned to the insurance industry. We are not really thinking about what it does to the other hospitals. I do believe it will, if successful, set benchmarks for the others, because today people can argue that, listen, costs are just going up, we can't manage them. But if one entity is able to reverse that, then an argument gets created that, hey, it's possible, so why can't you? Interests are misaligned.
Got it. But if this drives sort of footfalls to a certain network of hospitals, I mean, will hospitals outside of this network, obviously they won't like it. I'm saying that does this in any way hamper your core business?
In India, there is enough demand for for healthcare. I don't think that is the challenge, and I think everybody has their own market. This is meant for middle class India. That middle class person cannot afford 78,000 per room night. Let's be very clear.
Got it. Absolutely, absolutely. I mean, we can barely afford, and I completely agree. And we are middle class India. Yashish, just a quick point. Does this XYZ entity already exist, or this is to be created? I mean, this is yet to come up.
No, this XYZ is yet to be created.
Okay, and this will require this entire thing will require shareholder approval as well, or no? Just board approval?
No, it will not require shareholder approval. It's a minority investment, which is what our IPO funds were raised for and have been earmarked for that already.
Got it. We'll leave it there, gentlemen. Great to have both of you and really coming out and talking to us about this. Appreciate your time here on CNBC-TV18. Mr. Dahiya, Mr. Bansal, really great speaking with the both of you. We're going to take a quick commercial break here. That's PB Fintech for you, as you heard it. I think we have Prakash Devan now joining in with what he's making of the markets. But I think, Prakash, good to see you again. You heard the conversation with PB Fintech. Your first thoughts? You're on mute, Prakash.
So what I was saying is, Prashant, it's a very noble cause. Great to have something like this come into the ecosystem, but it's too early to even figure out how it's going to impact, what is going to be the exact quantum of impact. So I think we'll have to wait for that XYZ company to be formed, what valuations PB Fintech allocates money to it, and things like that. So too early to really make any conjecture, but yeah, I mean, it does look like they finally want to get into something to diversify their business model in terms of the risk from just insurance selling.
Okay, all right. Hi, Prakash. Good morning and good to see you. It was good to meet you yesterday as well at that event, and the equity cult here in India is well and truly, developing. So that was good to see the kind of feedback we saw. But a quick question on China. We're having a melt up in metal prices. I know prices are up 5-6% as we speak. What do you like from that space?
So good morning, Nigel. Yeah, so I think out of the metal mining companies, you would rather stick to the bigger ones. And from that perspective, NMDC continues to offer great value. As I said last time, you probably have a revival of some of the sleepier ones like the OMDCs and the Moils of the world. I've been positive on Moil since quite some time. It's delivered from there on. But I think there's a reset that's, again, imminent. Importantly, what's going to happen is everybody is a bit doubtful and skeptical about whether the stimulus is going to have a long-term impact or how long-term the impact would be. And once that happens, you'll probably see the mining companies and metal, suppliers, their underlying derivatives. And don't miss out on the graphite players. There's, I think, globally, and you track this so well, so you would know, I think the HEGs of the world will also start getting their place under the sun very soon, if not yet. And that's the space to kind of look at. We spoke about refractories, we spoke about the mining companies, but I think the graphite plays also could start looking up. But, principally, steel is where all the focus and attention is. it could be a bit of a journey which has some volatility. But stick to the larger ones like SAIL, JSPL, and I don't think you'll go wrong.
Okay, all right. Prakash, request you to stay with us for a bit. We have Anuj who joins us to help us out with how he's seeing trade setup today. Morning, Anuj.
Morning, Nigel. Well, you know, it reminds you of that famous Amir Khan dialogue, Jana tha Japan, pahunch gaye Cheen. So today we have both Japan and China in focus, and my sense is you want to focus more on China and less on Japan. For starters, of course, it's a crucial day because the first Monday of a new series, and normally that is crucial because you keep an eye on some markers. Two important boundaries, 25,998, the expiry day low, and 26,277, the prevailing all-time high. I mean, if you break 25,998, then it could trigger a fall, and if you cross 26,277, then you're set for a bigger rally to 26,500, 26,800. And if the gift nifty is right, we'll start somewhere in the middle of these two markers. As I said, instead of Japan, focus on news coming out of China because that's positive for us, for some of our stocks. Friday's other big talking point was Bank Nifty. That's something to focus on. There was a 500-point decline on Bank Nifty. And there's some chatter about a possible double top on HDFC Bank, somewhere around that 1800 mark. Let's see. For the fresh rally now, HDFC Bank needs to cross that 1800 mark. Also, IT will be in focus because you'll be starting the earnings season from the second half of next week. In terms of stocks, metals is something that you could focus on once again because of the fresh stimulus measures that you have from China. And lastly, I'm focusing on what the three big indices have done this month and this year. I mean, what you can say is Nifty is the more consistent performer, 3.7% this month and 20% this year. Nifty Bank this month has outperformed, but this year has underperformed. Nifty IT this month's underperformer, but this year's outperformer. So clearly, Nifty is slightly better placed. The Nifty IT is at make or break level around the 20-day exponential moving average, and Nifty Bank has been outperforming, but Friday's decline was big. So you got to give it some importance. Let's leave you with the quote of the day, and since it's Monday, it's a bit more motivational. If we have the attitude that it's going to be a great day, it usually is.
It's going to be a great day.
It's going to be a great day, yes.
Thanks a lot, Anuj, for giving us trade setup as well as that thought as well. Well, for the time being, I'll tell you what, we'll take a snappy break. We come back, we'll continue our chat with Prakash. We'll also get in our technical experts. Don't go anywhere.
Down Duke, Urbana Champaign, London School of Economics to come to Ashoka.
The valuations are berserk over there. I mean, again, great companies, but and again, I usually don't talk about stocks, but just to put some sense. And again, don't get me wrong, I'm not disputing valuations or anything, but just to give the Infosys example, let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. Let's say it's a 30p by then because we're a fairly large company. So it needs a $4 billion PAT, profit after tax.
So when we say melt up, I just want to sort of finish that point. It usually we are talking about like a frenzied move in the very short term, but that's not what you mean. You think
I mean it makes a major long-term top, which is not a great thing. So I mean it's great that we are going up on a wall of worries in a way that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets don't climax at periods like that. And this seems to be more like the 90s bull market where, small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. And B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up where the entire market goes up 10x in a decade. And then you don't see that prices for, maybe next 10 or 20 years. So I'm hoping we don't get a melt up and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4 level supply. The big guys haven't yet come. And in the bigger ones, if I take the top 10 companies, no one is supplied. Having said that, the owners of those companies, whether it's BAT selling down ITC or Singtel selling down Bharti, that's happened. But it's not like the Reliances or the Tatas or someone has come
the
with
new businesses
with
or
China, China, China. I think that's the sort of chorus out there. The Chinese markets are up 4% right now. As we speak, Hang Seng is up a little less, but it's up and it's been, from the lows of September, quite a remarkable 25% kind of a move that we've seen. We've got Andrew Tilton, a Chief Asia-Pacific Economist at Goldman Sachs, joining us. Andrew, great to have you with us here on the program. Thanks for your time. Prashant this side. Andrew, is this a big tactical move? We've had at least two of these since 2020, which eventually does not go anywhere. But when you're in it, it feels like the real thing. 40-50% kind of moves from the lows. Are we in the midst of one of those, or do you think this time it's different?
Sure looks that way. We've seen a big shift in Chinese macro policy over the last week. Investors have been waiting for quite some time for signs that policymakers would take more decisive actions to stem the housing downturn and try to stabilize growth. Last week we had a PBOC announcement with a bunch of monetary policy easing measures, and then a Politburo meeting indicating the willingness to deploy more fiscal stimulus. So those are very important signals that I think markets have been waiting for a long time.
Hi, Andrew. Morning, and good to see you, Ben. But do you think the Chinese authorities have done enough? Because in the past we have seen the announcement come about, the excitement as well, heats up, but ultimately it fades away. But this time, do you believe they've done enough?
We know a lot about the monetary stimulus. We've eased policy rates 20 basis points, cut reserve requirements half a point, taken some measures to boost the equity market as well as housing. What we don't know as much about yet is the fiscal stimulus. There have been various media articles suggesting potentially bank recapitalization, consumer-related stimulus, but the details of those fiscal measures are not yet available. So I think it's too early to say they've done enough. We'd likely need fiscal stimulus in the trillions of renminbi to really move the needle in a significant way on the Chinese economy. There are big structural challenges, a multi-year housing downturn, cautious attitude from both consumers and businesses. And so to turn that around and really improve the growth outlook for 2025, we're going to need to see a big dose of fiscal stimulus, and we're still awaiting the details of that.
So, Andrew, we have major moves happening in two large economies, right? There's China on one hand. Tell us, to sum it all, whether you think this will really move the needle. We just had the latest official PMI numbers out this morning. They're not as bad as what we've seen earlier this year. So all things put together, where does it leave China? Is it getting out of the funk? And then there's Japan, where there's leadership change, where there's a question mark on whether BOJ will keep hiking, whether they'll pause because the Fed is cutting. What should we expect from Japan over the next 6 months?
Well, these two countries are really going in very different directions with regard to policy. Japan is tightening, albeit slowly, and from a very easy level, tightening monetary policy and potentially fiscal policy with the new PM, talking about potential tax changes. Whereas China is going the other direction, easing monetary policy, potentially easing fiscal policy quite significantly. And I think you've seen the equity markets respond accordingly, with Japan down, China up. But the bigger lens I'd put on all this is we are seeing an opening up of space for a lot of central banks around the world to cut rates. The Fed has begun cutting with a 50 basis point move in mid-September. A lot of emerging market central banks that were on the fence, maybe waiting to think about cutting rates, are now feeling more free to do so. The U.S. dollar has weakened. Those capital outflow pressures, particularly from China, have eased, and that's opened up policy space. So you remove some of those constraints on policymakers, and in a place like China, where growth data have really been disappointing, that provides a better backdrop for policy easing, which is what we're beginning to see.
Andrew, you said, right, it's not monetary. It's exactly what they do on the fiscal side which will matter. And there was a Reuters article which essentially said that they're planning to, in dollar terms, about $120 odd per child, per household, I mean, something like that. That's essentially what they said. Direct money, cash transfers is what that article suggested. Is that going to be? Is that what is going to be needed for markets to remain excited? I mean, real economy we'll get to when it happens, but what will it take for markets to continue to do well?
That will be a shift from what we've typically seen Chinese policymakers do in the past. Typically, they've used fiscal stimulus to support infrastructure spending, government priorities, sometimes trade-in allowances to encourage households to move up to more green or newer appliances and cars. Direct cash transfers have typically only been done in very small size. So a larger scale cash transfer would be a signal that policymakers see the concern around the economy and are willing to do more. Just to put it in perspective, we think the monetary easing measures taken last week would be worth a bit less than a half point on Chinese growth. Now, 1 trillion renminbi, which I think is the stimulus to which you're referring, on the consumer side, if that were implemented, that adds up to 80 basis points, so 0.8 of a point of Chinese GDP. Not all that money would necessarily be spent, but again, you could be talking about an impact on the order of potentially half a point of Chinese GDP. There are other tailwinds. The housing market continues to slide, and exports, which have been very strong over the past year, probably won't be quite as strong in 2025. So there are a lot of moving parts, but as the external side of the economy, which has really been supporting growth, starts to fade, policymakers will need to do more to support domestic demand, particularly consumption.
All right, Andrew, we'll leave it there. Thank you very much for your time. And I hope that we can sort of, you'll come back and we can sort of track this progress and what's happening in China with you on a regular basis. We'd love to do that. Thank you for joining us here on CNBC-TV18. We'll take a quick commercial break here. We'll have Mitesh and Sudarshan on the other side with their technical trading ideas. Stay tuned.
With massive issuances, which I think is around the corner. It should come.
I mean, bankers we speak to tell that over the next 12 to 18 months, about $25 billion worth of IPOs should happen. But that is, I'm not sure how much of the...
So, Prashant, 25 also, I'm saying, is a small number now. It's a $5 trillion market cap. So if you don't do 50 billion, is 1%. So issuance is, the government ought to be doing 25 billion. The larger groups easily can take 25 to 50 billion. And this is combination of primary and, of course, QIPs and so on. We've seen promoter selling, we've seen PE selling, we've seen MNC strategic selling, and it's gone from across the world, right? If GE of US has sold, Whirlpool has sold, BAT has sold, Sumitomo from Japan has sold, Singtel has sold, and now Hyundai is approaching the market. So all these chaps are getting it right. But we still haven't come and raised the money.
And that will happen according to you?
I think it's inevitable. I mean, that's what capitalism is, right? That demand for paper will create the supply.
And we're a long way off from that climax. Or
I hope I'm not proven wrong next week, but I think this has legs to go.
This has legs to go. PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But defense, etc., right? That part, it looks like we're starting to rotate. People are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done, or is just like a pause and refresh case here?
Again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate. And then the excesses which happened in that period made them complete pariahs. So 4 years ago, we were on a show and Ramesh and I remember we would talk about PSUs and everyone was like sniggering, like, what's wrong with these chaps? But because the correction had...
Welcome back. Hope you're having a good morning. As promised, our technical experts are with us. Mitesh Thakkar and Sudarshan Sukhani join us on the show. Good morning, gentlemen, and good to see you. And as always, Mitesh, you go first. Tell us, how do you approach trade today?
Good morning, Nigel. Today, I think the GIFT Nifty is indicating a mildly negative start, and my buying zone or my support areas on the charts which I would want to enter at is one closer to 25,970 and then 25,800. So while the immediate decline may not give you an entry opportunity, I think during the day, if we come closer to about 26,050, 60 odd levels, I would want to start taking some long positions on the index and keeping a stop below 25,970. Maybe add aggressively in case we get closer to about 26,000, 26,020 as well. So it's a buy on dips kind of a market for me. It is still a positively trending market for me. But yes, you can have a few days of pullback in between. And I think maybe today, in the worst case scenario, till tomorrow noon, we can have some kind of a pullback.
Okay, got it. Sudarshan, hi, morning. What about you? How are you approaching the market today?
Good morning. Well, on Thursday, I had suggested taking profits, and we had a big rally that day. Ideal location to exit long positions. My view continues to be that the market will be choppy and sideways. Now, there's a strong possibility. Actually, the market can be anything. But my sense is that the probability is that we will be choppy and sideways. It's not going to be fun taking a long position in this environment. And we don't know the lower levels to which this market can go if it does that. So the trade is, do not take any trades in the Nifty and the Bank Nifty, focus on stocks.
Let's get to the stocks then, Sudarshan. Tell us what is on your radar.
Well, a lot of mid-cap stocks are moving up and giving buy on dip opportunities. But I'll start with a large cap, that is Reliance. Reliance has just broken out of a small consolidation. So the chances are that while Reliance can outperform and push the Nifty up, some other sectors like banks and IT could push it down. And therefore, the Nifty could be choppy while Reliance could be an outperformer. So buy Reliance with a stop under 29.34. Buy Hind Petro with a stop under 403. Grasim is a buy with a stop under 26.49. And finally, Chambal Fertilizers, which is also breaking out of a consolidation, is a buying opportunity with a stop under 484.
Got it. And Mitesh, what about you?
I have some conditional buys. Ambuja Cement is something, which gave a good move on Friday. And if it can clear 636, 640 band, I think it will give a short-term trend reversal signal. So the trade would be buy about 640, keep a stop at 629. Look for a target in range of 670 to about 675. Buy on BPCL, which was a recommendation on Friday as well, did extremely well. Should see some more continuation. So BPCL is a buy with a stop at 360 for targets of 380. One sell, City Union Bank, keep a stop at 166, look for targets of 155. While Canara Bank on a mild decline, let's say a rupee or rupee and a half decline, around 112, 111. Canara Bank is a buy call for me with a stop at 108.5 for targets of 119.
All right, we'll speak with you again soon, Prakash, Mitesh and Sudarshan. Thanks very much for that. Prakash is still with us. Prakash, just a quick word on, if you will, the oil marketing companies. I think we had a technical trade there. Stocks were up 6% on BPCL on Friday, and that basically is, the story is the big drop in oil. This morning, the story is oil is unmoved despite all the geopolitical escalation, China stimulus. Both actually should push prices higher, but nothing. 72. So just your thoughts on that, Pak.
No, so absolutely. So let me echo the view that I had even last week when we spoke about this. And BPCL is the one that I'd spoken about as probably well poised out of the three, given that it has a very fair balance of marketing and refining. Right? Unlike IOC, which is more skewed towards refining, HPCL more skewed towards marketing. And Prashant, the crisis released not impacting oil, Saudi still, wanting to kind of keep upping the output is a very clear indication that oil is going to be range bound and probably biased towards the lower side. So if that were to happen, of course, that's an assumption and it could go wrong if some events happen which we don't know which could could be out of the anticipated move. But my sense is oil marketing companies will still benefit because they offer the best value. In fact, BPCL is probably one of the lowest valued stock in the Nifty as of now, if I'm not wrong.
Oopsie.
I think we lost the line.
Okay, all right. I think that line has snapped over there. But we'll thank Prakash on that note for joining in and giving us his insights into a whole host of stocks. Well, the next one we're looking at is KC International. Remember, the company has got a tailwind because we have the National Electricity Plan that was announced last week, and that's a tailwind for the industry itself. But to get more company specific, they raised some money via the QIP route, around 850 crores or thereabouts. To understand what they'll use it for, what's the way ahead, we're joined by Mr. Vimal Kejriwal, the MD and CEO of the company. Hi, Mr. Kejriwal. Good morning. Always good having you on the show. Break it up for us. This money that you've raised, you've mentioned that some debt repayment will take place. So how does it, deleverage your books? Point number one. And point number two is you're taking an enabling resolution for around 4,500 crores. So is there further equity fundraise that's due in the coming months?
Morning, Nigel. As far as the QIP is concerned, we have raised around 870 crores. And the primary purpose is debt deleveraging. Almost everything will go towards debt repayment. We have kept some small amount towards general corporate purpose, I think 20-25 crores. So large purpose is to strengthen the balance sheet. And the impact of that is that, our debt equity, which was expected to be around 1 at the end of the year, will now probably be around 0.7%. Similarly, debt to EBITDA will improve by around 30 basis points. And if you look at the overall impact on the balance sheet for an annualized, 870 crores would mean around 75-80 crores of, interest cost saving. And secondly, since we'll be repaying some of the debt, etc., it gives us a lot more room to use non-funded limits, so we can raise some more bank guarantees and LCs, which will help us in, growing the business a little more than what we could have grown otherwise.
But hi, morning, Mr. Kejriwal. Got that point. But, the thing is, I think originally the enabling resolution was for a much larger amount, I think 4,500 crores. And that got the market excited about potential inorganic moves or maybe acquisitions that you'll look at doing. And then eventually you raised only 870. So what is the thought process? And I mean, the buzz is on ITD cementation, whether you were interested, whether you've pulled out, what the issues there were. And if not ITD, any other company. But again, the QIP amount now doesn't seem to suggest that you're looking at any immediate mega acquisition. But just set the record straight on this.
Yeah, so good morning. I lost you for some time, but I think the question was, you've got a enabling for 4,500 and you've done a lesser amount. So I think it's very clear that when we had raised the QIP also, which was enabling resolution, we had very clearly mentioned that a part of this, which was close to 800 or 900 crores, would be used for balance sheet strengthening. And the second one was enabling to keep us, ready with a sort of a war chest or thing. And when we get a good acquisition or multiple acquisitions. So right now we are looking at quite a few of them, but I don't think anything is something which will happen today or tomorrow. So we do have an option of raising more money, but I think it will happen as and when we get something.
So the war chest, basically the war is not fully on, I guess. But I was asking you about ITD cementation. Are you completely away from that particular potential asset? Have you lost interest there?
So I don't think I would like to comment on an individual asset. Okay, we have quite a few of them in the pipeline. Some of them are in the civil side. Some of them are on the oil and gas, etc. So I think we will have to wait and watch what happens, how it develops.
Right. Mr. Kejriwal, I would not normally push you. Good morning, Prashant here. But, our colleague Yash had reported on the 1st of August that you are the front runner to acquire the promoter stake in ITD. So just for the sake of clarification for our viewers, are you still in the race or are you no longer in the race for that asset and you could be looking at others?
Prashant, I will unfortunately not be able to comment on individual assets. Okay, and that's what we had said earlier also.
Okay, no problem.
Okay, all right. Got it. So in case you're going to be doing some inorganic growth, only then will you come to raise some money? Is that the way we look at it?
100%.
Okay, all right. Got that. There's a ratings downgrade that's coming from CARE. Give us further clarity on that. Was there any, any payments that you missed, or if you could give us some clarity on that front?
So, Nigel, there was no payment missed or anything. If you read the rating rationale, the rationale is all positive, except that they said that the gross current assets should have come down more than what they have come down, and that's the single biggest reason why they decided to downgrade. And they have also mentioned the QIP. Our request to them was that we should wait for the QIP to happen. But anyway, the rating committee decided that they cannot wait for that to happen. Now that we have done the rating, the QIP, we will go back to them. There was no other reason. There's no miss or anything. We have been absolutely on dot on all our payments.
We take your point on that, Mr. Kejriwal, and appreciate you joining in, giving us details with regard to that QIP. Most of it will be used for debt reduction. You're fairly comfortable with regard to the leverage in your books, and only in case you're going to be doing an inorganic growth will you come ahead and raise further capital from the markets. We look forward to chatting up with you in the time to come. Thanks a lot, Mr. Kejriwal. Well, let's go back to Sudarshan for his 9:10 call. Sudarshan?
Well, Hind Petro can be considered for buying. Hind Petro with a stop under 403.
Okay, all right. Thanks for that. Mitesh, what about you?
I have a BPCL as my recommendation. Look for targets of 380.
Okay. All right. Thank you, gentlemen, for those calls. Let's quickly move on. There is a note from UBS on the two-wheeler segment. And it seems that they're striking a bit of an optimistic sort of call over here, if I'm correct. Let's ask Vinny for the details. Vinny, morning. What is UBS saying?
Good morning. So yes, at least for the consumer, it's going to be exciting because it seems like we're going to be seeing an increase in terms of discounts for two-wheeler vehicles as well. We've seen it in passenger vehicles, and now it's increasing in two-wheeler vehicles. That's the word coming in from UBS, especially in the e-commerce platforms. That's indicating a bit of a higher discounting here. They're saying there's a sharp step up in discounting for online platforms, which has increased competition and some bit of inventory pressure for companies. That's a concern coming in there. Now, they expect these discountings to remain high even during this festive season, which is just starting and just around the corner. Other than that, high discounting is seen for especially Hero Motor around 11 to 18%, while for Bajaj Auto also it's in the range of 12 to 16%. So talking about entry points for electric two-wheeler vehicles, that's significantly below the best-selling ICE motorcycles as well. So yes, electric two-vehicle, that is obviously a better option and attractive pricing versus an ICE bikes that we've seen coming in. TVS, that's gaining market share. Hero Moto is losing market share. So that is why they're maintaining a buy on TVS Motors, Eicher Motors, and a sell on Hero Moto and Bajaj Auto.
All right, Vinny, thank you very much for that. Naveen, fluorine is the next one we want to talk about. Sonal is here with that one. Sonal, morning.
Good morning, Prashant. Well, a lot of analysts, they visited CDMO facility of Naveen Fluorine, which is at Devas. And the takeaways were that management expects strong growth runway in CDMO business going forward on the back of scale of the Fermion contract. That is a big contract that the company has been speaking about for a long time. Company is targeting 40% CDMO revenues coming in from the late-stage molecules by end of FY25 itself. This would be a big trigger for the stock. Now, Naveen Fluorine is one of the two suppliers of an intermediate product which is going into Bayer's darolutamide, and the annual revenue potential here is around $25 million, which could rise to levels of around $75 million by FY29. And Naveen Fluorine says they can make up to 50% of this particular revenue potential in their books itself by FY29. So this is something that the street is very bullish on. They also say that the 540 crore specialty chemicals plant is expected to be commissioned by October end. However, the recovery in specialty chemicals which they had expected in the second half is not something which is confirmed. So this is something that could worry the street because China dumping and demand concerns in China still continue to impact the global chemicals industry. Jeffrey says continued channel destocking and Chinese aggression pose challenges to companies' intermediate heavy portfolio. They have an underperform with a target price of 3,000. Morgan Stanley has an underweight as well. They say near-term earnings are not yet fully de-risked, but upgrades still some time away. So these two brokerages are not bullish on the stock. However, Nirmal Bang has upgraded it to a buy. Target price has been increased, which is on the back of a rolling forward to the next financial year. They say worst is not behind due to macro factors, the biggest one being China competition, but margins are expected to improve from the current base because they were at multi-year low levels already. So that's why Nirmal Bang is positive on the stock.
Right, Zonal, thank you very much for that. So those are details coming in on that one. We'll just sort of count down to the market opening. The first rates should be up on your screen shortly, and we'll look at that. The indices, and we'll, as always, go into individual names and stocks. So what do we have? First rates coming through. The indication, of course, early on at 8 in the morning was about a 60-65 point cut. In the pre-open as well, the indication is about a 0.4, 0.5% lower start. So we'll see, we'll pick up from there. 26,061 is where the pre-open left off at. But the first rates around the 26,100 level on the Nifty, 85,300 on the Sensex is what you have. So that's about a 1/3% lower on those two. Midcap index is starting down about 1/4%, 60,271. And as always, the IT services index comes up with a meaningful move. So the meaningful move today is down about 1% lower, nearly 1% down, 41,940 or so. So that's the IT services index. And take a look at the heat map overall. I mean, many more down as compared to up. That's essentially what you've got. So about 38 odd names, 35 odd names lower. 2 unchanged, and you've got and the rest which are trading up, or at least starting up at 9:15 this morning. Surbhi.
Okay, let's look at the individual movers and shakers. First, the company that we were just speaking with, actually, PB Fintech. Some recovery on the price again. The damage was quite severe in the last couple of sessions. There was some recovery on Friday, and it's continuing today, about 3% on the higher side. But anyway, let's look at the larger market move, the 100-point cut on the Nifty. To start off with, the bank Nifty is actually leading things on the way down with a cut of about 0.5%. So the banking pack is not really helping matters much. Aside of that, Hero Moto, Tech Mahindra, these are some of the weaker names. Reliance is down 1%. So that's cooling off. A lot of IT selling going on right now. Tech Mahindra is not alone. Infosys, Wipro, TCS, all the large cap IT names are on the way down. So banks and IT put together, not really very inspiring for the bulls this morning. However, on the upside, it is that metals rally. Remember, even Manisha was talking about it. Prices, I mean, base metal, ferrous metal prices, they've been going through the roof on the China stimulus, and that is continuing to percolate down into stocks. It was the best performing part of the market last week, and that trend continues. Hindalco, JSW Steel, and even the names beyond it, names like Vedanta, SAIL, Nalco, all of them are up and about. So metals pretty strong, banks and IT slightly weak. Midcap's absolutely flat for now.
Well, that's right. And you have, iron ore prices that are flying up. So NMDC, that's the core play on iron ore. So that stock is up close around 4.5%. And we are at CNBC-TV18 have been making this point on Vedanta. It's not for the faint-hearted, but if you're going to get a Chinese stimulus, if you're going to get Fed rate cuts, then that's the best way to play it. And I think the stock from there, it was at around that 450, 440 odd level. Didn't do anything much for a long time, but it's given dividend of close to 24 rupees odd. And after that as well, the stock is up more than 15% from those levels. So that's been one of the big players out there. Colgate is another stock from the frontline names that's up close to around 2.5%. So big move is what we're seeing out there. Tata Chemicals is another one that's up close to around 2.5%. What's not doing too well? NCC has seen some profit taking from the recent peak. That's down 2.5%. TVS Motors as well is down close to around 2%. From the broader markets, Reliance Infra, the stock has seen a big surge in trade volumes as well as rather high, because the Kolkata High Court has ruled in their favor with regard to an arbitration order. So that's one of the top volume movers in today's trading session. What else is doing well? A couple of smaller names. Vakrangi is up close to around 11%. I don't know whether there's any news flow. That's one of the top volume movers out there. And Z Media is another one that was this month. It's up close to around 60%. Well, I think they've announced some fundraise out there a couple of days ago. So that's another one that's moving well. All in all, the market's a little bit down, 80 points lower, but I think par for the course after the kind of rally that we've seen. Prashant.
Absolutely. I mean, you got what, a 90-point cut now coming through, and that's the sort of state of affairs. Just a few other names before we bring in our market guest. PB Fintech is already giving up gains. It's at about 1660 or so, about 1.5% higher is all that's left. What else? I mean, there is NMDC, as you said, Nigel, 4%. That's the biggest volume-led gainer right now on the NSE. Reliance Infra, 2.5% higher, but that one has been a rocket. I mean, from 200 to 300 in 3 or 4 days flat. And it's starting another 2.5 higher right now. We've got LT Foods, which is up about 3.5%. Volumes actually at least with stocks which are up, not very much. I mean, tapering off, at least at start, not a very big volume-led day. Reliance Power, again, another rocket. It's down about 4% this morning, 45. It's the biggest volume-led gainer by far. Hero MotoCorp with a 2% cut is at number 2 position in terms of volume-led losses. Phoenix Limited, the mall operator, 5.5 lower, 1757 on Phoenix Limited. 70, so that's got tremendous volumes as well. And you can go down to JSW Energy, RITES, the recent listing Cross and Bharti Hexacom, and so on and so forth. So that's essentially some of what is coming through. Surbhi?
And we have to check on the new entrants in the Nifty, right? For what it's worth, I mean, just to market.
Yeah.
Trent is in. It's been a massive wealth creator. Today it's down about 0.1, 0.2%. Doesn't matter, but what a journey. And now it makes its way to the Nifty 50. And of course, BEL is keeping it company. BEL is down. All of PSUs are down. There's a general cool-off across the board. Railway PSUs, defense PSUs, SJV, and a lot of PSUs are down, including BEL. 2 new names on the Nifty.
It's a running joke between me and our producer, Anurag, about I really want to go to Zudio.
When will you do it, Rajat?
I've not been able to, but hopefully, right? I mean, that's essentially the big driver for this one. Really, so many sell-side brokers have covered the stock for years, have sort of said it on record that, well, we got this wrong. And we did not get this in terms of what a powerful engine Zodio's turned out to be for Trend. Well, let's welcome in our market master, Pankaj Tibrewal, founder and CIO at Ikigai Asset Managers, is with us. Pankaj, great to have you with us here on the program. Thank you very much for your time. So, at the margin, Pankaj, you've been cautious, right? You've been advocating that maybe the time has come to go a little bit more large cap. Too much concentration in mid caps, small caps and smaller caps, perhaps not a great idea. And now we're finally starting to see the breadth of this move narrowing, the breadth of the rally narrowing, Pankaj. So let's begin there. Your observations.
Good morning, Prashant. Over the last few weeks, we have met a lot of investors through different forums. Though the Nifty is making new highs, but you don't see that happiness on the face of investors because their individual portfolios have not participated in the rally the way Nifty has, gone up. And clearly, there are few observations, Prashant, which clearly is now being proved by the data. So if you look at from June till September now, and this quarter is coming to an end today, what we are seeing is the divergence between index return and median index returns has started to happen. In this quarter, NSE 500 index has given about 8.5% returns, but the median return of the index has been about 5.5%, which means the index heavyweight is leading the index higher, but the breadth of the rally has started to narrow. This brings us to the question, is the return of polarization, which has started to happen. And normally when earnings growth starts to slow down, which we saw in the first quarter and likely in the second quarter as well, we see that polarization happens. It happened in 18-19 as well. Still early days, but the question is the return of polarization starting to happen? In the Midcap 150 index, 25 stocks have given the bulk of 50% return of the index. So clearly, you are seeing the median return trailing the index return, and this is the first sign. The second important observation in the market is that there is a style shift starting to happen. Over the last 3 years, you have seen value, momentum, high beta, and in certain areas, low PE doing extremely well. But over the last 3-4 months, post-elections, you are seeing growth, quality, and low volatility making a very sharp comeback. Please don't ignore this because whenever style regimes changes happen, it leads to realigning of your portfolio. It happened 3 years back. Probably interest rate cut may be the catalyst, but it is looking now that probably there is some change in the style which is starting to happen and portfolios need to adjust towards that. The third point is that we were in a way beneficiaries of Chinese underperformance. Look at the way the Chinese markets have bounced back over the last 1 month. Now, on a year-to-date basis, Chinese markets are outperforming Indian markets. In 1 month, it made the entire change. And hence, though FI flows were not very strong, but on the margin, it could impact the FI flows as we move ahead. Last but not the least, valuations are one standard deviation above overall market. And in certain pockets, it's crazy. Look at the SME part of the market. It's in a different frenzy altogether. 65 times the index is up over the last 5 years. So I think what I would suggest to most of your viewers and the investors in the market, this is the time to go back to basics of investing. Make sure that the quality of the company you are investing is not compromised, and make sure that the portfolio is resilient enough that whenever there is a drawdown, the portfolio stands tall. So these are the few things which is under your control, which you can do.
And hopefully investors are listening to a lot of that sane advice that we're getting in from market veterans like you, Pankaj. I mean, I think that was really well put. And just to sum it up, basically what you're saying, styles are changing. The market's going back to areas like quality, low volatility. Then there's a resurgence of China, and then we have lofty valuations in India. So it's a potent mix, right? Now, against this backdrop, the IPO market continues to sizzle. We have Swiggy coming up, we have Hyundai coming up, and so many more. So just allow us to play this one bite, Pankaj, before we sort of get back on that question of the IPO market. And this bite comes in from one of the biggest poster IPOs of 2021. Paytm and Mr. Vijay Shekhar Sharma, he was on a panel at an industry event, I think on Friday, where in his candid style, he went on to admit that one of the mistakes that he made in life was selecting the wrong merchant bankers. Let's listen into this and we'll come back to the IPO discussion.
I have a regret now, not in the joining of entrepreneurship. I've been entrepreneur for long enough now. I have a regret of not choosing the correct bankers for IPO. If you choose the correct bankers, जैसे भगवान के मंदिर में जाने के लिए आपको सही पुजारी चाहिए होता है, शायद हमने वो नहीं चूज करे तो उसका choose a right banker, my friends. अभी तो छोटी-छोटी IPO भी इतनी बड़ी हो जाती है. In Iran age, it was driver making a crore. In Paytm's case, I know 20 people who made ₹1 billion, 100 crores.
Excellent.
20 people. And many of them cashed out more than 100 crores. I'm a bootstrap entrepreneur who had to do a lot of cash generation by the business. And in that rush, I learned only one thing for ladies and gentlemen in the room. There's nothing called P&L. This profitability, which is a P&L, which is an opinion. The real truth is cash. Everything else is a trash.
Lessons learned in the heydays of the new age company bull market, right? And in hindsight, when you end up being a lot wiser. Anyway, let's get back to the question that I was asking, Pankaj. We are in the kind of market that we're in. We're getting a lot of new issues. Do you think mistakes would be made again? What's the advice that you would give out to investors so they don't have that repeat experience? I mean, not just Paytm. Several companies went through the crunch. Zomato came out triumphant. What is the one thing that you would advise to investors now as we're looking at these multi-billion-dollar issues that will hit the screen very soon?
Surabhi, last year we did a piece on IPOs and I posted it on my Twitter handle sometime last year. And the data was staggering. Last year was one of the biggest years in last 20 years in terms of number of IPOs we saw. But if you look at a last 20-year history and IPO sizes of 50 crores and above, 53% of them underperform Nifty. So in the very short term, IPOs tend to look very good. But over a medium to long term, I think very few IPOs do well. And only 24% of the IPOs since 2002 have become 5-baggers or more. And 51% haven't even doubled post-listing. So clearly the data suggests that you need to be selective on the names which come for the market. And clearly on the SME side, we are seeing frenzy and euphoria. I think many of them will probably not see the value over the next 5 to 10 years. So the real advice would be, don't get carried away by greed. It's clearly visible on the street today. Take a more, saner call right now. Make sure that you do your proper homework before investing. Otherwise, in this kinds of market, the probability of making mistake could be much, much higher. And we need to be careful. And I am saying this again, that at this point of the market, we need to be risk manager rather than fund manager. Make sure that you appropriately price the risk in your portfolio so that you can survive on the pitch for a longer periods of time. For that, if you need to give few overs maiden, let it be. But don't lose the wicket. Otherwise, you won't be able to come back to the match.
Amazing. Well put, Pankaj. But, you'll be looking out for that loose delivery, right? To dispatch it to into the stands. And there's still some opportunities that are still prevalent in the market, be it from the power space, maybe some of the financiers as well. So give and take everything. You're sounding a little bit cautious, particularly about the broader markets, but you're still stating that there are good themes out there. So list a couple of them because our viewers would like to know where should they be building position with conviction for the next few years.
Good morning, Nigel. On the themes, I think power demand and electricity could be a slightly medium to longer term theme, and energy transition. And look at some of the data points. After 15 years, US is starting to see increase in demand for electricity, led by data centers, EVs, and so on and so forth. You will be surprised to know that CY19 to CY22, out of the top 10 air conditioning installation markets, 8 were out of Europe. Who would have thought that Europe will install ACs far more than any other country, and 8 cities out of the top 10 are from Europe because of global warming. So I think there are 4 important points: global warming, data center, which is AI, electric vehicles plus bitcoins and cryptos, and the constraint on transmission and ESG, which is leading to the entire energy transition and increase in demand for power. I think this could be played through various things: distribution, transmission, or generation, and the ancillaries to that. So I think it's a mega trend. Valuations could be something which is prohibitive right now, but keep a close watch on this trend over the next 5-10 years. The second one is the pharma sector. I think, broadly speaking, I think we have still some visibility on earnings growth there. And I think most companies will deliver earnings growth better than the broader market. And I believe that valuations are not so prohibitive there, whether it be the generic player, whether it be domestic or CDMO. I think pharma sector is looking okay. Financials, I believe, is one space where valuations in our favor, whether it be lending or non-lending. And I think insurance is coming out quite strong, as well as some of the banks and NBFCs. So that's another space where we are positive on. And auto ancillaries, don't forget that space. I think many auto companies are changing their texture, not only from pure auto to industrials. And I think that's a big shift which is happening. Who would, kind of expect that recently the global purchase head of Airbus was in India, finalizing vendors for the next decade or so. So I think a lot of areas like aerospace, defense, they are going through their own challenges of supply chain globally. And I think India is finding flavor. And many auto companies are transiting and pivoting themselves, not only from pure auto, but to industries, industrial areas like aerospace, defense. And these are some of the companies to watch out in the portfolio as well. So these are some of the areas where we think you need probably be a positive on. But I again repeat, it will be a bottom-up stock pickers market. The best of the breadth or the best of the broad-based rally which we saw over the last 3 years may be behind us, and the data is suggesting that. And probably our first quarterly newsletter will be coming soon. We'll be elaborating more on that as we move ahead.
But you gave us 3 or 4 broad themes to look for at least, right? I mean, it's become tougher, as you said. Power, pharma, financials, and auto ancs. These are 4 broad areas. And I like what you said. Be a risk manager rather than a fund manager now. I mean, you're in that phase of the market. So I think that's our headline from this one. Pankaj, I know you don't want to talk about single stocks, but just your thought process as an investor. You heard the news flow around. The case is this: PB Fintech. We had the management with us earlier today. Platform company, light asset model, it's done very well. Stock's phenomenal. It's doubled this year. And now it came off about 20% last week on fears that they're going to get into hospitals. Well, they've clarified they're going to do a minority investment up to $100 million one time into an operation which is going to be a network of hospitals. And it's now going to be done in PB Fintech, but an outside company. As an investor, how would you look at this situation? I mean, for those who own it or are thinking about this one?
Prashant, I think rather than commenting on stock specific, I would say that there are few thoughts about the new age companies. When I interact with a lot of them over the last few years, I believe that the private market and public market are 2 different animals. You could take a decision by speaking to 5 people on the private equity side when you are unlisted. But when you are listed, you need to be far more responsible because there are a lot more investors and the thought process is very different. I think we saw that in few cases where at the time of listing, the promoter, the company said, we don't care for profitability. We only care for growth. And over a period of time after listing, market showed that the cash flow is reality and rest everything doesn't matter. And the company came back to profitability and cash flow and see how the market rewarded them over a period of time. This is just one instance where the narrative at the time of IPO and after maybe 18 months of listing was very different and how markets rewarded them. So I think over a period of time, many new age companies, probably who don't have the experience of public market listing, will make those mistakes. But I think companies who kind of correct those mistakes also very fast will kind of move ahead with much, much better market capitalization. So I think it's a learning process. I'm nobody to comment whether the company you mentioned is taking right decision or wrong decision. Its time will suggest. But one should stick to the core. If it's an asset-light model, over a period of time, one should strengthen the moat on that and not pivot too much from their core. I would suggest that. And public markets are a very different animal than the private credit markets.
All right, Pankaj, thank you so much for joining in. And it's really important to get that voice of reason, slight bit of caution as well, perhaps keep it on the table, given the kind of market and the global environment that we're in. Great speaking with you today. Thank you very much for joining in. Well, speaking of the market, just a quick check. Yeah, the cut's actually gotten deeper. We're almost 150 down on the Nifty, so there is a fair amount of caution in the in the market today. Bank Nifty is down about 0.7%, and as we've been highlighting, the problem is both IT and banks. The twin engines, well, neither is firing today, and there's a bit of roundabout weakness. Even autos actually, Hero Moto, M&M. Look at Bajaj Auto, look at Tata Motors. There's no pre-festive cheer and that whole run up to the numbers which come tomorrow. None of that's showing up. So cool off in auto, IT, and banks. Well, let's then turn the spotlight on the housing finance space now. The cabinet approved the PMAY Urban 2.0, the Pradhan Mantri Awas Yojana, the 2.0 version, to talk about the potential impact on the sector and on individual companies. We have with us Rishi Anand, the MD and CEO of Aadhar Housing Finance, joining in. Rishi, great to have you on. So obviously, there's a fair amount of excitement around this scheme. We spoke to some of the public sector entities as well, and they were telling us about how this is sort of getting bigger and better. But you tell us, what is your exposure, first of all, in the first version? Was there any exposure you had? Did you disburse any loans which come under the first round? And now with this 2.0 coming in, what is the impact overall for affordable housing and, of course, for Aadhar in specific?
Great. First of all, good morning, Surbi. Thank you for having me. Okay. With regards to PMAY version 1, which got over in March 22, Aadhar Housing Finance gave out subsidies to about 82,000 customers, which was almost 50% of my total existing customers, to the tune of 1,800 crores of total subsidy. So we were a substantial player in the segment that we operate, which is typically EWS and LIG. As far as PMAY 2.0 is considered, or that has been, as you said, it's just got launched. The contours are almost out. I would say, and the industry echoes what I'm going to say, is it is a better version of PMAY. It is a very well thought through, drafted PMAY version. For example, while the total subsidy seems to be going down from a 2.5 lakhs to 1.8, but the subsidy now comes over 5 years. So it is total subsidy of 1.8 divided by 5 years, which effectively means for housing finance companies like us, the AUM, so the way it works is whatever subsidy comes to the customer comes in the loan account, which effectively means my AUM goes down by that amount. Now, in the current scheme, the AUM is the fall in the AUM is going to be split over 5 years. More so, the consumer will have to be non-delinquent for 5 years, and the percentage of BT out, which has been a concern in the housing finance sector, will also drop because the consumer has to be listed through one company and he has to stay with one company for 5 years.
Okay, so it tightens up maybe some of the, let's call them, maybe, loopholes or pitfalls that perhaps certain entities would have taken advantage of earlier. So it tightens up those loose ends, and the spread is now over 5 years, as you're saying. Now, let's talk about the numbers here and now. Let's talk about the FY25 targets. We're almost done with half the year. In terms of AUM growth and the total AUM, the size that you want your book to be at by the end of the year, what is that number? And this will only roll out, I guess the impact will start flowing through only in the second half, Q3, maybe Q4. What will be the exposure or expected exposure to PMAY 2.0?
So, Surbi, we've guided in your channel itself, we've guided multiple times that Aadhar is looking at a growth of 18 to 20% on disbursement, which will translate to about 22 to 24% on AUM. And as we speak today also, I would stick by those numbers, given the performance in Q1 and Q2. While the Q2 numbers are still to be published, but indications are good. Yes, you're right. The PMAY subsidy scheme effectively will be, I would say, October onwards. While the scheme says 1st September onwards, any consumer who is availed a loan is eligible for PMAY subsidy. But effectively, I think from October, mid of October onwards is when we are going to see some traction happening towards PMAY subsidies. I'm sure there is this question around what is the kind of growth that everybody is expecting or the industry is expecting out of the PMAY subsidy. For that, you will have to understand that this is a refinance scheme. So first we will have to go out and lend. Only then the refinance happens. I would say on an incremental basis, anywhere between 10 to 12% growth is what we are all looking at.
All right. Hi, Mr. Anand. Good morning and good to see you. So you have detailed a fair bit with regard to the PMAY. Tell us about how do you see yields panning out? I think your yields currently are around 14% or thereabouts. You could correct me on that number. But you have been focusing more on LAP. So how does it change things from here on? And also your cost of borrowing. How does it compare with what we saw, say, in the first quarter from now? And how do you see things panning out from here on?
Okay, hi, Nigel. Yes, one is, I think you had three questions. One is on cost of borrowing. Cost of borrowing, I would say, from our perspective, looks like they have peaked, and what we are going to see in the coming quarters is only going to be either cost of fund is either going to be flat or it's going to be slightly. We are expecting that December quarter there should be some announcement by RBI on the downward trend of yields. As far as our spread goes, we have maintained a healthy spread of 6%, and we've always guided the market that upward of 5.7% is the kind of spreads that we will maintain. Either ways, whether the interest goes southwards or northwards, we work on spreads. We have an 80% book which is floating, 80% liability which is floating. So whatever comes in terms of incremental yields, incremental cost of borrowing will be passed on to the consumer either ways. So that's how our spreads are. Yes, on incremental yields, we are at 14%. On the book, we are at 14%. Incremental, we are at about 13.6, 13.7%. So I think I missed one of the questions you asked. If you can come back on that.
LAP as a percentage of your total mix has been moving up, I think so. How do you see that panning out?
The LAP, right?
Yes.
Okay, so loan against property, it's a part and parcel of the mortgage business that we do. As the regulator allows us, Nigel, 60% of our balance sheet has to be individual housing loans, which would translate to, for a layman, would translate to about 70% and 30% home loan and non-home loan respectively. Today, Aadhaar stands at about 25, I think, and the management has also guided multiple times. We will be at 75-25% home loan to non-home loan. So I would not say there is a substantial increase. In fact, it is a calibrated increase on loan against property, and that's where we would want to maintain at about 25%.
Mr. Anand, hi, good morning. This
good morning,
majority of this comes from resale and self-construction, etc., right? Has in the segment that you operate, has real supply started to come in a big way on the affordable side? Not yet.
So I would say, since we work primarily, Prashant, we work in the affordable segment. A majority of our consumers would buy properties which are already built, which is resale, as you said. There will be a 30-35% of the consumers which would construct on existing plot. Now, construction on an existing plot is actually creation of a new asset. So asset is getting built with that kind of loans. On the affordable segment, there is multiple state governments. There are multiple projects that have come in right from at various stages. We are currently, as we speak, talking to CIDCO on a big chunk of projects that have flats that have come in. So there are multiple states. I remember talking to Tamil Nadu about a couple of Tamil Nadu government, state government a couple of weeks back, Karnataka government, MP. So there are multiple states who've taken already lead into providing affordable housing. So it's a good place to be in today.
Okay, but I got that. So it's getting you have the visibility of supply because we've had people who started with affordable housing going into premium because that is where the demand is, the money is. But you're saying that at least government initiatives, state government level, etc., there's visibility of a lot of supply now.
So yes, I would say two things here, Prashant. One is, yes, is there a visibility of supply? I would say completely yes. As I stated, I have been personally interacting with state government bodies, so I can there is a clear visibility. More than that, there is a lot of availability of properties in the outskirts of larger cities that we operate. So my consumer, irrespective whether he's buying from a government-led initiative or he's buying on resale and self-construction, the demand is looking very positive as we speak, Prashant.
Okay, all right. So we'll leave it on that note. Thank you very much for joining in. Good getting that perspective from you today. That is Aadhaar Housing and how they see the road ahead, and of course how they see PMAY 2.2 also sort of boosting their business this year. Stocks down about 3.5%. And with that, quick check on the market as well. The cuts are getting deeper. 172 down and 26,000 is under question as well. By the way, let's do a quick check on the rest of the region as well. While we are sliding quite a bit, look at the Hong Kong market and look at the mainland China market. And this was the question always. Will there be some rotation away from India into China? Too early to call any parallels over here. Hang Seng is surging 3.5%, and then mainland China ahead of the holidays that are coming up, this Golden Week period, 6% up on the Shanghai Composite. That is what mainland China is doing, while Japan is still down about 4.5%. So pretty dramatic moves across Asia today. Let's take a break on that note. Coming up on the other side, we discuss, of course, some of the changes that have been announced by the exchanges in terms of the fee structure. Now they have to move towards a flat fee and not the slab-based system that was followed earlier. What does this mean for transaction charges? We'll ask Rajesh Palvia of Axis Securities in just a bit.
That it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return, and the what so-called poorest PSU may give you the best return. So it was a mean reversion trade which happened, and of course all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change, but you went from terrible to being good. So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically these are not high return areas. By definition, if you make 25% IRR in an infrastructure business, the cost to the consumer, which is the average public, is going to be too high. So your money made is really on leverage, and therefore the return on equity comes in that business. So and people are shy of doing leverage after again the last cycle.
Even
and the flip of it, sorry.
Welcome back. Well, let's get the conversation going around the new regime which kicks in from tomorrow with respect to transaction charges that market infrastructure institutions, MIIs as they're called, the system that they will have to now adopt. And in line with the regulatory changes, NSE and BSE have revised transaction charges to comply with SEBI's directive requiring them to do away with the slab-based fee structure that was prevailing earlier. Now, one has to look at a true-to-label fee structure, which is based on average realizations. And the question is whether it could perhaps impact revenue for brokers, particularly discount brokers. To talk about this, so we have with us Rajesh Palvia, VP Technical and Derivative Research at Axis Securities. Rajesh, thanks for joining in. Now, this is something that's been discussed, I think, over the last couple of months since this was announced, this flat fee structure. What is your take now that brokers can't pocket the difference between how much they're collecting from the end user, which is me, and actually paying to the exchange? What happens now? And break it up into different class and category of brokers, from the discount guys to the regular broking institutions.
Good morning, Surbi. So definitely the circular came in July to all market infrastructure institutions that, they cannot have now slab-based mechanism to facilitate all these brokers. So I think now it's fixed charges, all transaction fees they are charging to the broker. It would be a fixed charges. They cannot have slab mechanism based on their market share. So discount brokers were enjoying this, slab-based structure much because they were attracting more, volumes in terms of as they are charging very low brokerage or, zero brokerage kind of structure. So I think the major participations were attracted by the major derivative traders were attracted on the discount broker. So I think there could be impact on their, volumes, and maybe what benefit they are getting by these slabs will impact to their profitability on an immediate basis. But the way Nifty has changed the structure now, the cash segment now will be having 2.97 for per lakh, and for equity future again they will be having 1.73 rupees per lakh, and for equity options it's 35.03 for per lakh of premium value. So this is the flat, transaction fees they have to charge to the client now. There will be a level playing field for all the brokers. So client will not have any kind of differentiation across all the broker community. They will be having the same structure in terms of charges, because what has impact those who are high frequency trader, those who are doing bulk trading, or those who are having high volume. They are the cost is the major key driver for those to deploy all algo kind of strategies. So they will be impacted by this thing, but brokers on the discount broker will get the major hit by this thing.
So Rajesh, let's just take the, the rates are on the screen, the ones that you mentioned. Let's just take that example, the equity options, segment, because that's where we're getting so much of volume, where the earlier band was 29.5 to 49.5, and now there's a midpoint, flat 35.03, as you said. The question is, will broking costs go up for the end customer? Zerodha, has come in and made that statement that their revenues are going to be hit. Is this the end of discount broking? That's question number one.
So definitely to meet out the revenue difference, I think they have to increase the brokerage structure to meet out all this the difference which they were getting by the transaction fees slab structure. So I think yes, definitely there will be an increase in the brokerage by the discount broker. So that will give impact to their business volume also, because now there will be a similarity in the charges between the full service broker as well as the discount broker. So yes, there could be some hit on the brokerage side. So client have to give more brokerage on the discount broker platform also going forward.
All right. Hi, Rajesh. Good morning and good to see you. And let's talk about the exchanges then. Everyone's debating NSE will list or will not list, but BSE is running away and the stock has been on fire. I think in the last 40 days, the stock is up close to 25% or thereabouts. What are you making of the current valuations? If you could give us an update first on a forward multiple, what is BSE trading at? And do you think it's trading at very elevated multiples? Because there are some curves that are coming into play with regard to transactions, with regard to volumes as well, which could be a risk to earnings. So your take.
So I think on the exchanges front, I think there won't be any major difference, because they will be getting the same charges, and there is no as such changes from their revenue front by this transaction fees, because they will be getting the same transaction fees what they are charging. So I don't think there will be any changes in the revenue of exchanges. But yes, the way BSE has moved up in anticipation of that, NSE there could list, and that the peer company benefit. And most of the participants have participated in BSE because it's available on the exchanges. So I think that has stretched the valuation at this juncture, and the way stock has moved up, yes, definitely it's at a stretched level at this moment. But on this transaction fees, I think there won't be any changes in the revenue of exchanges.
Got it. Transaction fees aside, what is the multiple it's trading at, BSE? Yeah, the valuation multiple you were telling us about BSE, that's trading at fairly elevated levels. You made that point, but if you could give us the number.
That I don't have a ready number with me.
Got it.
Okay. So, Rajesh, the point that you've made is that this should be largely revenue neutral for exchanges, but it's a question of what brokers do now and whether the discount brokers start increasing pricing. I know, this is not a space you track. You're not a fundamental analyst on capital market institutions, but nonetheless, I remember having a conversation on this when the original regulations were announced, and one counter thought process there was that it's still a very competitive market. You still want to do volumes, you want to catch in the retail, you want to get the larger institution, the algo guys, like you said. So it will prevent, in general, a rise in, too much of a rise in broking fees, and it will remain very competitive. And, you know, while discount brokers will have to actually hike, the basic broking charge, there are other levers which they could adopt as well to overall keep costs low. Is that a scenario that could play out? What's the final sort of word on this, you think?
So definitely the brokerage is the only tool where they can, compensate all this, the slab hit which they have got by this flat structure. So I think there would be increase in the brokerage going forward. As we have seen, in last couple of years, the major traction which we have, attracted on the derivative market is because of the one of the reason is, low brokerage structure for this discount broker, and they have facilitated most of the traders by, charging low brokerage. And now we have seen, a huge rise in derivative volume. So and a lot of concern raised by the regulators also by seeing this kind of, extraordinary volume, which we are seeing in the option market as well as in the derivative market. So a lot of measures they are they are considering a lot of measures to, curb these kind of, extraordinary activity and to protect the interest of retail clients, those who don't have, edge on the derivative market. So I think by increasing these charges, I think there would be some volume activity would be dry up, and as well as the another measures which going to come after this SEBI meeting today. I think another measures will also, give some, volume dry up going forward. So I think the concern is it has to be level playing field. There should not be any discrimination between the larger player, but between the and the retail player. And there should not be any discrimination between the broker to broker. So I think it's going to be a level playing field for all across the broking community, as well as it will help to the traders also.
Okay, well, let's hope it plays out well. Thank you very much, Rajesh, for giving us some perspective in this. So new regime in terms of transaction charges kicks off from tomorrow. By the way, on the market, interesting trends. We dipped below 26,000. Now there's a bit of an attempted recovery. The only thing that's seeing buying in the market today, by the way, is metals, thanks to China's roaring rally. And then there's a lot of consumer that's on the green side today. Asian Paints, Tata Consumer, Lever, Titan. These are stocks that are up. And the reason now the Nifty is fighting to get back above 26,000 is actually IT. Remember, at 9:15, a lot of IT stocks had opened weaker. But the mood of the market seems to be move towards cash, move towards safety. And FMCG and IT fit right in that equation. So look at from the lows and HCL Tech, Wipro, a lot of these IT stocks, they're recovering from the opening gap down level. But Prashant, it's really, stark the difference between the whole India-China, just in terms of how the equity market is reacting today.
Absolutely. It's like all over the place, right?
Yeah.
But for specific, I think Japan is still down. China is up. Here we've got this going on. So, I mean, just above the 26,000 level now as we look at things. Mitesh is with us with what he'd want you to do. Mitesh was telling us in the morning that he'd expect maybe a sideways kind of market till, I think, noon tomorrow. And then, of course, you go into a holiday on Wednesday, midweek one. Mitesh, go on. What's your take on things now?
So, Prashant, the sideways to a mild pullback is what I was expecting, and the first target was around 980-600 zone, 26,000 zone, sorry. I think that's been tested. If we don't break today's low, I think sometime during the day we'll get a mild bounce back, and that would be a long trading opportunity. And in the worst case scenario, I'm penciling a test of 25,800. So I think, we'll wait it out. Another few hours, we'll know whether we're getting a pullback from these levels or whether we'll test 25,800 before bouncing back. There's a good congestion of moving averages as well as retracement areas around 25,800. So that is the bigger support level. But since we have kind of, managed to hold on to the first level around 25,980, I think we'll keep a watch. But the overall trend is still on the positive side, even if we go down to 25,800. After a 8-9 days of rally, this will be a 2-day, 3-day kind of a pullback. So nothing much to worry about as of now. But yeah, you might want to tactically wait it out before you want to take a fresh position on the index. On the stock side, a Pidilite is a buy. Keep a stop below today's low of 33.50. Look for targets of 34.75 to about 34.85. And the other stock which I like is Polycab. It's giving a good pullback. So buy here with a stop below levels of 68.50 and look for a target of around 7,200.
Got it. All right. Thanks a lot, Mitesh, for that. So not too perturbed with this bit of a dip that we're seeing this morning. And it's saying till that 25,800 level holds out. That's the first reference mark. Mitesh is not too worried. Well, let's shift away a little bit from equities and focus on the commodity market. Manisha Gupta joins us to help us with the sector of the day yet again. Manisha.
Thank you for that, Nigel. Well, I'm looking at metals as a sector because we've seen constant gains onto this one. The last 3 weeks actually have been quite strong, and that is the reason the month of September is headed on a stronger note. This is on the back of very strong China stimulus. Well, almost this has been the most aggressive stimulus since the pandemic. So whether it has been about mortgages, making injections, financial injections that is into the economy, and then it also has been about easing mortgage repayments, borrowing costs have been reduced. So all of that really has helped the metal prices in sentiment right now, because the factory activity numbers that we saw come in from China have been on the weaker side yet again for the previous month. But the expectation is that the steps that China has taken, we will start to see those signs in the final quarter of this calendar year. The best of the gains really came in for the copper prices, 7% of gains in the previous week, and this has been the best weekly gain that copper has seen in last 4 months. Well, the other reason that you also have seen copper prices gain is because the inventories have slightly declined, and the markets are looking at stronger data demand coming in also from the European markets there. Not just copper, nickel is trading at a 1-month highs. Iron ore prices in the previous week gained up by 11%. That is because the China port inventories in case of iron ore have continued to decline. And then there have been weak shipments from the major producers like Australia and Brazil as well. We also have seen strong gains continuing in case of zinc, because the projects which were expected to start for the second half of this year now have been postponed to mid-2025, also supporting. Silver also has continued to gain. We saw a 12-year high in the previous week, some profit taking from those kind of levels, but that clearly has been the gain in sense of gold as well, where we did see all-time highs in the previous week. Some profit taking is how we are working with right now. China, of course, is the largest consumer of silver, have been buying a lot of gold as well in most part of last couple of years as well. And the markets do believe that all of these dips will be used in case of buying there. Just to show you on how the metals have worked on a week-on-week and a month-on-month basis, as you can see, from 3 to 8% of gains is what we've seen in the last week. Copper gained up by 7%, zinc 8%, iron ore prices gained up by 11% as well. The last 1 month, that is the month of September, also has been very good for the metal prices. 7 to 15% of gains is what you can see onto this one right now. For the overall year 2024 as well, it continues to be quite well for the metal prices. So 17% of gains coming in for copper in this year until now. But the best of the gains, as you can see, have been in case of precious metals, with silver clearly outperforming all of those metals for 2024 till time, with 37% gains, 30% up for gold as well. And as you can see, 11 to 20% of gains is what we've seen in case of base metal prices also. It's going to be an important week, this one, because one, you have various data coming in from US, but most importantly, it is going to be the US Fed Chair speech that the street will be watching out for. There is a lot of data coming in from the European countries as well, but inflation will be top on charts here. From Japan, you have industrial production numbers, unemployment and retail sales. And from China, the street will watch out for the Caixin manufacturing data and the PMI numbers. Well, all of that data comes in this week itself.
Parisha, thank you very much for that. So that's a lot of action as far as commodities, and all driven largely by what's happening in China. We'll take a quick commercial break here. We'll get you an exclusive conversation with Anil Kumar Gupta, Principal DG, Director General of Directorate General of GST Intelligence. That conversation is coming up. My colleague Timsy will be conducting that interview. Stay tuned.
The leadership of the last cycle was all the high quality businesses in the last decade, which were all getting re-rated. Asian Paints, Page Industries, Kotak Bank,
consumers, retail.
even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected, that Kotak, HDFC haven't performed for the last 5 years. Again, great companies, but it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move? And there are memes on HDFC doing the round the way it was for ITC. And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
so things like that tend to happen. I can't forecast what will happen in...
But you're very bullish on the financialization theme.
I am very much.
The magic one that everybody is talking about at this point in time is AI and what AI can do, and specifically generative AI. How do you see that linking back to the efforts on the healthcare side, the innovations that you're working on? I mean, how transformative is AI likely to be, or are we on the cusp of seeing that kind of transformation?
Usually when you get new technology, it's applied to in the rich world for those who are well off. And what we'd like to do this time with AI is make sure, both in terms of discovering new interventions for nutrition or vaccines or drugs, and helping give people health advice, in voice, in their native language, that we actually bring these AI advances to those most in need. I mean, after all, where's the greatest shortage of doctors? It's in developing countries. And so the foundation is leading the way by giving grants to various people and pushing this forward. Even for a topic as complex as nutrition, the AIs are going to help us understand things faster than we would without it.
If you could do a startup all over again and focus on AI, what would the niche be that you would like to address?
Well, if you could go back to my school days even, and then I was saying, hey, how do we make software as smart as human beings? And I was constantly thinking about it. I underestimated how long it would take, but here we are on the cusp of that. And so now the lens I apply is the lens of the foundation. If I was somebody young, sure, I'd compete with, OpenAI and all these people. But, now I'm in the stage of saying, how do I help other people working in AI apply it to those most in need?
As far as India is concerned, the role and relevance and the significance of India, especially as far as the foundation is concerned, and what you're hoping to do on the innovation side.
So India's the country the foundation does the most in, other than the US.
Right, welcome back. Let's straight away head across to our colleague Timsi Japuria, who is in an exclusive conversation with Anil Gupta, Principal Director General at the Directorate General of GST Intelligence. Timsi, over to you.
Well, the Directorate General of GST Intelligence has detected the highest ever numbers of tax evasion cases, totaling approximately 6,084 cases involving over 2 lakh crore rupees of GST, which was evaded in FY24. According to the annual report of the DGGI, the Central Investigation and Anti-Evasion arm of the GST at Center, the sectors with the highest evasion were online gaming, banking, financial services and insurance and services, followed by iron, copper, scrap and alloys in goods. The evasion detected in FY24, remember, is double to what was detected in FY23, which was about 1 lakh crore rupees, involving cases over 4,800. Joining us today, Principal DG, who heads the Directorate General of GST Intelligence, Anil Kumar Gupta. Very warm welcome, sir. To begin with, let me ask you, monitoring and enforcement has played a critical role in the success of GST in India. And an interesting case that came to the fore was that of Infosys. It was in July when DGGI issued a pre-show cause notice to Infosys for alleged evasion of over 32,000 crore rupees of IGST between July 2017 till FY 2022, out of which 3,898 crore worth notice for FY 18 was withdrawn. So where are we currently on this demand?
Thanks, Timsi. Good morning to everyone. In fact, it's true that the intelligence and investigating arm of any organization, CBIC like DGI, plays a very important and crucial role in ensuring the compliance of GST law, which is the mandate and role of DGI. and also in that process to check black money. So in that role, we, beside booking cases and detecting cases and finding newer modus operandi in which some of the elements or some of the taxpayers are very minuscule who play with the GST law and evade taxes, we book them and bring it to the fore. And DGI, in fact, besides ensuring compliance of GST law, also in that process educates and brings transparency in the way the GST law is being complied by the taxpayers. So as regards your question about Infosys, yes, Infosys is a long story. In fact, DGA was investigating this case since 2020. And in between, somewhere towards the beginning of this current financial year, about February, March, we came to know that state GST is also investigating into this case. And as per the mandate of the GST Council, that when multiple agencies are investigating a same taxpayer, in that process, we transferred the case to state GST authorities in April or so. But later on, there was some High Court matter in Karnataka High Court where Infosys has challenged the authority of the state GST authorities, and in that process there was a dialogue between the state and the center, and again this case came back to us towards the end of July 2024. But before that, state GST authorities had already issued a DRC-01A, which is a pre-show cause notice to Infosys of about 32,000 crore or so. But when the case came to us, we issued the DRC-01 since we are investigating that case. And the issue in brief is of import of services made by Infosys from their branch offices for execution of their export orders. So the matter as stands, of course, now for the remaining years from financial year 2018-19 onward, the issue is under examinations because the circular which Infosys claims that they're entitled to it, Circular 210 of GST Council, which was issued recently after a GST Council meeting in June 23. That is the issue in brief, whether that...
So where are we currently on this demand?
...is available to Infosys or not.
What is the current
this
status
demand
of
is
this?
pending, and still because Infosys is to file a reply. Infosys is yet to file a reply for this remaining 4 years. Once they file the reply, only then we will examine, because it's a pre-show cause notice. In the GST law, for issuing a show cause notice, you issue a pre-show cause notice and then give an opportunity to the company or the taxpayer to file a reply. Once the Infosys files the reply, we will examine, then accordingly decide on the matter.
So recently, sources claim that the government is considering amendments in the GST Circular 210, which talks on valuation of supply of services import by a related party where recipient is eligible to full ITC. To make it simpler, it's correct. For the correction of the interpretation, this circular was issued. It is understood from sources that this circular could be tweaked further to give a relief for Infosys. Do you think this is in offing?
Yeah, well, it's difficult to say what is in offing and what is in the pipeline, because all such decisions are taken by GST Council, apex decision-making body. What I can say only is that we have suggested, we have also made a reference to the board, our policy wing, giving certain difficulties and implications of Circular 210, which are under examination in the board. And once a call is taken, the future course of action of that circular will be decided.
So what do you think can be actually done to give relief to Infosys? Is there an intent within the government to do so? Or you think that the case is strong enough and government should pursue the case towards plugging this leakage?
No, this question has two arms. First is whether our case is strong or not. That I will say we only book cases which are legally sustainable and as per the GST law prevalent at that time. So whatever DGI has done, it is as per law. There is nothing wrong in that. The second aspect is whether government intends to do any relief to Infosys. That is up to the government. Government is considering weighing all pros and cons, and Infosys is a premier IT company of India. Whether such transactions need to be taxed or not taxed, that is the prerogative of the government, and whatever the government will decide, will implement accordingly, because we are the implementing arm of the government, and policy making arm is to decide what is the future course on Circular 210.
So coming to the insurance services, recently notices were sent to as many as 20 general insurance companies operating in SEZ units for alleged evasion of about 20,000 crore rupees as unpaid dues for services furnished before the employees of industrial units within these zones and their families. Companies such as HDFC Ergo General Insurance, Star Health and Allied Insurance, Cholamandalam, MS General Insurance, etc., they were issued notices for IGST dues alleging misuse of provisions that exempt certain SEZ services under Section 16 of the IGST Act. What is your view on this? Is there an intent in the government to clarify this issue? Or again, as I said, are you going ahead with this demand to plug this leakage of 20,000 crore rupees, making these insurance companies pay back?
Yes, basically these are the supplies which insurance companies have made to the units located in SEZs, and normally a supply to SEZ is exempted, and that is what the insurance companies have taken the benefit. But however, when we found and went into details investigation of these insurance companies, we found these were not actually supplies to the SEZ units by the insurance company. It was in fact a supply for ensuring the life of the employees and their families, employees of the SEZ units and their family, which is not a supply per se to the SEZ unit, which is exempt. So this is clearly a taxable supply for which insurance companies are liable to pay. And let me place on record that some of them insurance companies are already paying tax on GST on this kind of a supply. And we also found that some of the insurance companies, while paying in one case, were not paying in another case. So this is, as per the GST law, it is a clearly taxable supply, and for which we have our Mumbai Zonal Unit has investigated cases and issued show cause notice to various insurance companies.
So we saw the GST Council setting a lot of pending issues. They have settled, for example, for the insurance sector only. 53rd GST Council settled the cases where GST Council has taken note of the industry representations and clarified in favor of the insurance sector with respect to co-insurance, reinsurance, wreck and salvage, etc. Is this matter of IGST dues from the SEZ units covered in this particular clarity, or this is separate from what came in the GST Council?
No, what 53rd GST Council meeting and the circulars thereafter had clarified, this current issue of supplies to SEZ is not covered under those clarification and was not the subject matter of discussion for those issues which were before the board or the GST Council. This is a separate issue, independent issue, which is not covered in those clarifications of co-insurance, reinsurance and other sectors.
Group. We have a great team there. We work a lot with the national government and many of the state governments. And not only do we see in areas like nutrition or using ultrasound to detect a difficult pregnancy, we're doing a lot of studies with our partners there, which will have a benefit for India. But also, because the digital infrastructure in India is so strong, we can try things out there and take them to other countries. The digital infrastructure itself is a great example where the leadership has laid that foundation, and now both India and Gates Foundation are going to Africa and other places and saying, hey, you should do the same thing.
Was there a specific learning from this trip to India for you?
Well, it was pretty amazing in Odisha to see how the digital approach was connecting with farmers, that they had categorized which farmers were in which location, what were they growing. And so when they would see crop disease outbreak, they could notify them. If they saw weather coming, they could notify those farmers. If the market prices were changing, they could help guide the farmers. And so the digital revolution, bringing that into that agricultural sector, that was the first time I saw that at work. And it's being scaled up in India. Now we'll take it to the rest of the world.
News which just came out, a government-to-government deal between US and India to set up a semiconductor fab unit in the country.
Right.
There are elements of technology transfer, etc. That's the cutting edge semiconductor and sort of plans to localize production. Right. I just wanted your thoughts.
I think it's great. I would love to, India's quote a non-aligned nation, and I don't think we should be asking to align, but I think it's great that we're reaching out to each other, helping each other, investing in each other, and I would love to see far more of that. And this has two elements. One is the national security part, which of course all countries have interest in. And the second is just, better economic relationship.
Over the last 2-3 years, we've seen the rise of the so-called industrial policy across the world. Yeah. National security is being prioritized, as you said. Do you see this as part of that, in the context of that?
Yeah. So industrial policy, I'm a little cautious about. I think to combat some of these things and to do things in your country's own interest, which are hard to do economically, you're going to need some economic policy, industrial policy, like the United States has, for rare earths and things like that, and lithium. Every country is different. So the national security needs of India are going to be more around energy. I think for everybody, it's going to be semiconductor chips. So I do think that's industrial policy. I would caution industrial policy when it's used for regulations, bureaucracy, politics, votes, social, and it doesn't have the twin of permitting.
Welcome to It's the Economy. The government last week extended the import authorization system for laptops, PCs, tablets, and servers. Remember that in August 2023, the government first ordered that imports of these items will require licenses. And then they softened the rules to say that importers will just have to get authorization. Now, the system of authorization was to end on September 30th, that's today, but it has gotten extended to December 31. What has been the impact of these controls imposed so far? And what are the likely changes after December 31? I have the right set of experts to speak about this. Ashish Agarwal of NASSCOM, Kumarti Banerjee of ITI Council, the India unit. They represent Apple, Dell, IBM, and all the biggies who make these laptops. And Jairam Sampath of Keynes Technologies, who makes the same things in India. Gentlemen, thank you very much for your time and for your patience. Ashish, let me start with you. Was there a problem for any of the laptop computer users in the past 1 year, or was it a smooth availability?
Good morning, Lara. So it has been a year now since this import authorization requirement had come in. And from a IT user industry, just who are really purchasing this for their use, what we have seen is that over the last year, things have pretty much settled down. There was initially an uncertainty about how this process might work out, and it might result in some problems for us. But for the user industry particularly, I think we have had some discussions with them, and the process is pretty much smooth, and we haven't seen any serious problem as long as it is just about some procedure for registration, and it doesn't apply for them directly because a lot of them procure through other people who are the actual importers.
Okay. Many of them are also in, STPI and SEZs, right? The IT companies. So they were anyway excluded?
Yeah, so bulk of our industry is in SEZ and STPI. So there are two kinds of exemptions which are there. One is for the import into these SEZ and STPI. And also from if you are actually taking to the domestic tariff area from this SEZ, then that is also not considered as an import for this authorization. And the second area is also there's a lot of work which happens in our industry which is related to R&D and testing and all of that where the quantities are small but it's important. So even that is exempted so all of these exemptions have been very useful.
Okay. Let me come to Kumardeep. Kumardeep, you represent the Dells and the Apples. How smooth was the import process, and were the numbers, volumes lower because of this, hurdle that you all had to cross?
Thank you, Lata, for having me on the show, and hello to Ashish and my other friend here. First of all, let me begin by thanking the government for extending the current import management system by 3 months. However, what we have been maintaining is that the industry needs more clarity on any new import authorization policy, whether you call it a license, whether you call it a authorization policy. And now what we understand is that it is set to take place from January 2025. Now, coming back to your question about how difficult it was, let me re-emphasize the fact that many of our member companies are now PLI signatories, the production-linked incentive scheme, which means that they are manufacturing in India. However, one must understand that due to the lack of the proper electronic component ecosystem in India, it is almost impossible to manufacture everything in India currently, and there needs to be sufficient timelines so that manufacturers can shift production. We also want to emphasize another point, which is, I specifically take the example of US, where the US government recognizes that companies will continue to source some products from maybe any other geography, perhaps China. And because US does not produce sufficient quantities of all these products, as acknowledged in NTIA's limited waiver of Build America, Buy America waiver requirements for broadband equity access, deployment program, or BEAD as it is known as. So those are some of the challenges. You understand that last year we faced a whole lot of lack of clarity as to what is going to happen. And that is the same situation we are right now.
Okay, so your members of ITI Council are not opposed to it in principle, but they only want clarity and timeline. Am I right?
We are opposed to any kind of quota system in principle because none of this can happen because it will disallow lack of products and innovative products to the Indian consumers. That is one part of the story. But we also want to work with the government, and since many of our members are now PLI manufacturers as well, we want to work with the government. We want sufficient stakeholder consultation before a new system is put in place and give us some transition timelines. That's all we are asking.
Fair point. Let me come to Jairam now. Jairam, have you all been good beneficiaries of what looks like a nudge to exactly do what Kumardeep is saying? Nudge the foreign manufacturers to do PLI or tie up with Indian companies. Has that happened?
Lataji, good morning. Ashishji and Kumarji, good morning to you all. See, fundamentally, the idea is to generate the capacity and capability within India, and which is very strategic. See, we can have, of course, keep importing for till we lose all our money. So fundamentally, that has helped us. We got some 4 RFPs for, we are into the high performance computing servers and little more complex products. So contrary to what is the perception, actually, we can do those things better than high volume products because Indian ecosystem does have capability, and we are now capitalizing the companies. Some people have gone to markets to raise funds and so on. So we have the latest generation of machines. So I think these low volume and all these high complex products can be very well done in India. And of course, for doing high volume products, you do require to put some more capital, and these companies have to put in more capacities to get it done. And I think PLI's scheme has been very nicely configured. You see, we can never have a perfect solution. So we could always say the glass is half full or half empty. I would look at the half empty portion as an opportunity for our company. So I think all of us, all the stakeholders must look at how to strengthen the Indian manufacturing ecosystem, which will help users and it will also help global OEMs also. There is no difference between us and in the world. Yeah.
Got it. You are assembling for them. But Jairam, you know, the total amount that GTRI has put out in terms of imports of these and related products is about 10 billion a year. It will take Indian companies quite a bit to get to fill that kind of gap. How much time and how much money will it need?
So, let's do some maths. If $10 billion worth of manufacturing can be done with an asset turns of what, 6 to 7, about 2 billion of investment. The 28 PLIs, if my memory serves me right, 28 PLIs have been given. So per company, the investment is not very high. So we do require a little bit of margin push. These are not very large numbers when you accumulate all the efforts of all the OEMs and all the other beneficiary companies here.
Okay.
So it's not that big an ask. It's not one company is being asked to put $2 billion and fill this 10 billion gap. There is an economic involved. Okay, nobody would like to lose profits from their country. And the other thing about policy, consultation, all that, yes, it is true that it has to be done. But the fundamental thing is that time is of essence, right? We have a small window of 4 or 5 before the other guys, wise up to this whole thing. And they may not really cooperate. Other countries may not cooperate for you to gain all the money, right? So we have to do whatever it takes.
Yes, and of course, there will be rival countries offering incentives. Ashish, what's the experience at NASSCOM? Did GCCs or any part of your, membership complain that, we are a GCC, we want to use the global, products in India as well because the systems have to talk to one another? Was there any opposition at all on those lines that this is impeding smooth work?
NASSCOM actually represents a broad spectrum of industry, right, which includes the hyperscalers, the GCCs, even the laptop manufacturers are with us along with the IT services company. So I think to the earlier point that, uncertainty is a huge negative. And we saw that in the start of this policy in last year, but then the government, took some time, but it settled down into a process which today it is a process which requires you to go through those hoops to just manage your imports. And even this extension that came in today, just a few days back, there was an apprehension that, what will actually materialize, because ideally it should have come in, maybe 3-4 weeks earlier at least. So from an uncertainty point of view, it impacts everybody. And also, if we take a step back and look at the big picture, right? So on one hand, as India, we are trying to encourage a lot of data center investments into the country. And a lot of these data centers, the servers they use aren't off-the-shelf servers. Some of them are manufactured by the hyperscalers themselves, or they have IP issues in that. So it's a very small market, but an important market. So from a government and industry point of view, the way we see it is that broadly the incentives are aligned to say that you want to strengthen Indian manufacturing, but you want to do it in a manner that it doesn't disrupt anybody. So similarly, in terms of laptop manufacturers, you already have manufacturing capabilities, but if they have to do something beyond just this process of authorization, then they will need adequate lead time and they will need to do cost-benefit analysis. And ultimately, as user industry, whatever the cost may be, all those costs will get passed on to the user industry.
Absolutely.
So in that sense, we will be impacted. And this is an important thing for us even as user industry. So we are closely watching this space.
Got it.
And I think while the time and all of that, we need to look at, but at least the sense we get is that the government is in no hurry to do anything which should negatively disrupt this entire space, which is actually requiring...
except that you could be a little more transparent about it, as Kumardeep said. Kumardeep, what is your ask? There is no complaint to manufacturing in India, right? Do you therefore expect that much more of this 10 billion that is getting imported will start getting made in India? What's your best guess?
Absolutely, absolutely. Because the intent is to manufacture in India, not just for the Indian market, but also export from India, and India becomes a cohesive part of the global supply chain ecosystem. That intent is very, very clear. All we are asking for, as I completely agree what Ashish said, that there should not be any uncertainty in the policy moves. He mentioned, and I re-emphasize that what should have come perhaps a month or 2 months back, because the inventory management is done 3 months in advance, at least a quarter in advance, should have not have come last week. That is all we are asking for. Now, there are 3 months. Again, you are giving a piecemeal approach. You're giving us a 3 months timeline that you continue with this. We don't know what is going to happen in January. In the middle, I'm relatively sure that there will be a new policy or the guidelines would be put in place, which we are hoping that there should be robust stakeholder consultation on this, arrive at a solution and work on a particular timeline. That's all we are asking for.
Yeah, fair point. Just let us know in advance, sir. Well, Jairam, we have lots more questions for you, especially your chip plant, which has created such a buzz, the plant that's coming in Gujarat. But I am out of time. I will request Jairam to stay on. Thank you, Kumar and Ashish, for participating in this conversation. More clarity and earlier, clear the uncertainty as early as possible. That's the ask from the industry. No disruptions otherwise. Wrap up on Bazaar on that slightly optimistic note. The markets are not in the best of optimistic spaces. We will continue our conversation with Keynes on Chartbusters after a very quick break.
So you got to be a little cautious when you use it. But yeah, we're going to have some. And like I said, I think it's very important that America and India have a great economic relationship.
Would you agree, though, that in the former part of what you described, industrial policy is kind of taking the lead? Businesses and who you align with, who you want to do business with, building supply chains. A lot of that is now, it seemingly is led by that. I mean, what governments really want to do.
Well, no, it's two different. Governments have always negotiated economic arrangements, stuff like that. If you look at the United States, the industrial policy is a very teeny part of the economy. So it isn't like it's taking over the economy. Right. I think in other parts of the world, it's obviously a much bigger part of the economy. So, but yeah, nations, because of national security and because of what some people might consider unfair competition, there will be forms of industrial policy. If I was a government, I'd be very, very careful. It should be very targeted, very specific. It shouldn't be to protect local industry. It shouldn't be to just create jobs. It should be for a very specific reason. But you're going to see it, and hopefully it's well done.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down. Inflation is coming down. And relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality.
Yeah. You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
So my caution is all geopolitics, which may determine the state of the economy. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's a chance for accidents in energy supply. God knows other countries get involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest question. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy, but we are spending a lot of money. And in my view, that spending the money causes growth. It also causes inflation.
Hello and welcome to Chartbusters. I'm Nigel. With me is Mangalam. The markets today have opened up a little bit on the lower end for the time being, but par for the course after the kind of rally that we have seen in the Nifty Bank. That's the one that's seen a 1,000-point cut in the last 2 trading sessions. So let's see how it goes. Mangalam?
Absolutely. Let's see how it goes. Slightly iffy in today's trading session. The week extremely important, and the month even more so. But let's talk about individual stocks and individual corporates as well. Jairam Sampath, the director of Keynes Tech, he's also the CFO there, joins in to discuss their foray into semiconductors and the impact of the electronics import policy. They've also announced the acquisition of a smart meter installation and operations company, Isran Menco, for about 43 odd crore rupees. Thanks a lot for joining in. Always a pleasure speaking with you. So let's go one step at a time. On the proposal of Keynes Semicon Private Limited where you are likely to invest about 3,300 crores in this semiconductor plant. Just wanted to know, one, what would be the asset turnover? By when does it reach its full revenue potential? And what would be the benefits in terms of regulations coming in from, the cabinet's approval that have come by?
Sure. So thank you for having me on the show. The Keynes Semicon approval in some sense represents a landmark decision by the government, because we are not one of those big business houses or something. We've kind of been working very hard at developing electronics manufacturing in India. And as part of our strategy to become an integrated manufacturing player, we had embarked on this journey. And I'm happy to tell you this total project's capex is about 3,300 crores. And on the plant and machinery capex, the central government provides us, as per their ISM policy, about 50% capital subsidy. And then state government also provides us about between 20 and 25% capital subsidy. So this basically helps us to overcome the initial, let's say, stage of manufacturing implementation, and we are forced to implement some legacy technology which may not be in the initial stages very profitable. So what it does to us is essentially, in terms of timeline you asked, so we are looking at next, let's say, FY26 as the year in which we'll start commercial production. We'll, of course, early in FY26 we'll start our proof of concept line and working with customers and getting it approved and so on and so forth. This is also the time required to work with all our collaborators and getting our manpower trained, recruited, etc., etc. And in this business, see, typically, if you go by the experience of the existing players globally, anywhere between 1 to 1.5 times, let's say, gross assets turns are possible. Now, it depends it depends very much on what kind of work we do. So if you continue to do low value added work, then it will be closer to 1. If you do high value added work, 1.5. We have attempted to kind of tune our capex more towards the advanced packaging areas, which is also the emerging area. And we wish to work in tune with the latest generation of packaging technologies. Of course, the capex permitting, of course. And so almost 3/4 of our capex, we are aiming towards the advanced packaging area, where we work with, let's say, cutting edge technologies and also in the advanced packaging.
All right. Hi, Mr. Sampath. Good morning and good to see you, Ben. So just to revise, the total investment that you will be making is around 800 crores. The revenue potential could be roughly around 4,000 crores odd. And as you said earlier as well, it will be margin accretive whenever this gets up and going. Yeah, and most of the capex will go towards the advanced side of things. Are we getting that correct with regard to this facility itself?
Absolutely.
Got it. All right. Now let's focus on the small inorganic growth that you've done, Mr. Sampath. What exactly, does the company do? If you could tell us in the smart meter value chain, will it be in the PCB assembly? Will it be in the grid? Will it be in the, display designing or in the software development? So could you tell us where this particular acquired company comes in the value chain?
Absolutely. So we are a company which manufactures devices, and we are into some portion of our business into solutions and so on. This particular company is in the area of providing total solutions for smart meter implementation, okay? And they work with several other agencies to make sure that smart meter implementation is enabled. And they have proprietary technology. They have also technology which help in software management and so on. So this particular company actually is a device company with an added strength in software, which is like the heading systems and meter data management systems. So why is it? How is it critical to us? Because it ensures that we secure our orders in the field. This company has been working with many AMISPs and all the other agencies to secure orders out of the new program that government has brought for implementation of smart meters.
Right.
So this essentially means that we secure our business in this area and also take advantage of the solutions capability here.
Got it. Mr. Sampath, quick couple of questions. Last year, I think this acquired unit did around 65 crores of revenues. So how do you see the revenue scaling up, this acquired unit? And what is the margin profile?
Yeah. So, of course, I'm not at liberty to discuss too many things, which is not in public domain, but suffice it to say that they have secured an order of close to about 3.5 million already. And maybe out of the remaining portion, which is the MIS fees deal with, maybe about 20% or something we are expecting as a share of our business. So it's a fairly lucrative business. In terms of margins, all I can say is that it will definitely be margin accretive to our current situation. And being a solutions portfolio, there's a possibility of future revenues too by through AMCs of software and so on, without too much of cost being incurred. Plus also supply this software to other device manufacturers.
All right, we understand that you are not at liberty to give us a lot of numbers, but we will push you once again, perhaps when you come after your second quarter results. Thanks a lot, Mr. Sampath, for joining in and giving us the outlook on this acquisition, your semiconductor foray. We'll talk about the order book, order inflows, as well as margins for the entire company when we are, speaking to you post your second quarter numbers. We elicit a promise from you to join us when that happens. Take a short break now, come back, get you more on the markets. In fact, we'll get chatting with Manan Shah, who's the Managing Director of Man Infra.
investing.
Welcome back. Let's get chatting with the management of Man Infra. We have with us the management of Man Infra joining in largely because of their Atmosphere O2 project receiving the OC or occupancy certificate as well. Manan Shah, who's the managing director, joins in. Manan, thank you for joining in. You've received the OC for Wing F of the Atmosphere O2 project. So just wanted to know how much of it is sold, how many more wings for which you are expecting the OC to come, by when? And as a result of all of this, what's the total revenue potential that you've realized so far and what's in store for this year?
Good morning.
So Atmosphere O2 has basically tower D, E, F, and G. D and E tower, the OC is already received for some time back. F tower is the one which we received the OC recently. And G tower is under construction, which we are anticipating to complete by 2026 mid. Now, in terms of potential, we've already sold 90% throughout the DEF towers, and we're receiving continuous momentum. In fact, October, November, December, Jan seems to be the festive months. So we are seeing the sales potential even going further.
Okay, all right. Hi, Manan. Good morning and good to see you in. Nigel on this side. Manan, what is the total sales potential? 90% is sold out, you told us. You're seeing good amount of momentum, but the number we missed.
We are looking at approximately anywhere between 3,500 to 3,700 crores.
That's overall or for this project itself?
Overall for entire O2, which includes the G tower as well.
And by when does that all start to reflect in your books? Because you've sold 90% of DEF, G starts, the construction completes in the middle of next year. So by when does all of this revenue start to show in your books? And what's your collection run rate likely to be?
So see, basically it's an associate company, so the revenue will not reflect into our books into the top line. The profitability is already started to get recognized from last year itself, and it will continue to go on. Talking regarding G will get completed in 2026. So the sales for that has also crossed 50% already, and we are just 30% at construction of the total tower. So we don't see any worry regarding the sales for that tower as well.
Okay, just explain that to us. Why will all the revenue not get accrued into the books of Man Infra?
So because it's an associate company, we own 33% equity. And being an associate company and not a subsidy, the reflection in the turnover will not come straight.
So your share of revenue in that, then in that case, would be just around 1,000 crores, right? 1,000, 1,200 crores, because it's 33% of potential 35 to 3,700 crores revenue.
I mean, revenue, again, like I said, it will not reflect into the books. We should see the profitability of the project. So yes, but 33% of that would be us.
So what is the profitability of the project? Sales we have. What is the rough profitability that we're looking at from this particular project?
We are anticipating that to be anywhere between 300 to 350 crores.
And so you would be able to realize close to around 100, 120 crores, right?
That's right.
Got it. All right. You know, collections for last year were, I think, around 1,200 crores for the company. And on a quarterly run rate, now you're doing in that vicinity of around 280 to 90 crores. Should we expect collections to continue in this vicinity on a quarterly basis?
See, more than collection, what happens is the construction stage of the project is more important. So last year, when you saw a lot of projects were getting completed and you were acquiring, this year, the majority of the projects have already been completed and now the newer constructions have begun. So collections, more than that, I would say you should see the pre-sales number, where last year we were at, I think, around 750 crores odd for the entire year. This year, in fact, the first quarter, we've sold more than 700 crores of pre-sales number.
So what is this number likely to be for the full year? That's point number one. Give us that number. And secondly, also give us the number for the US business. How much do you expect coming in from the US by when?
So for this year, basically, we're looking at an anticipated number of nearly 4,500 crore of launches. So that's nearly 1 million square feet is what the targeted launch is. And out of that, we've always seen a potential of around 50% getting sold in the first year. So I think you can say the pre-sales would come down to around 2,500 crore comfortably.
Okay, all right. What about the EPC project? What will we end in terms of an order book for this year?
So EPC, basically, we are looking at the port project is the major contributor, where we've still got another year and a half worth of works left. So around 750 crore is the approximate order book. But if you see the overall consolidation, we do our in-house construction as well. So the potential that's upcoming for the rest of the projects, that will also start coming in, though it will not again reflect in the top line, but it should reflect in the bottom line.
Quickly, the US business, you said how much it will be going forward? You had a target of investing about 100 crores here.
That's right. The money has already been transferred. We've got liquidity over there. We are seeing some good potential acquisitions happening in the next couple of months. I think by February or March, we should be able to launch our first branded residences project as well. That is moving on at a steady pace. We've almost received the approvals for the same also. So I think the realization and the profitability you'll start seeing from the US venture I think a year and a half from now.
Okay, Manan, appreciate you joining in and giving us all those details. Your body language says that you're bracing for good times ahead. We'll track you on all these numbers and we look forward to having you back on the channel, maybe post your quarterly numbers. Well, on that note, though, I think we can slip into a short break, come back. We'll continue to focus on markets as well as on stock-specific action.
This takes me back to a conversation that I remember having with Mr. Murthy about starting Infosys. And I said, you know, like 7 of you, of course, he was the first among equals. But I said, how did you get a decision made? You know, because, and especially we are known as argumentative Indians for a particular reason. What was that like? And he told me, he said, look, you know, it was very simple. We had a sort of unwritten rule that in God we trust, everybody else brings data to the table. What was it like for you?
So we started with a smaller group, as Pramath was saying, Sanjeev, Pramath, myself, only a couple of others. It was a small group. And I think we spent a lot of time. So even as a precursor, we used to meet one Saturday a month at my old office, and we would have conversations. And this happened for a couple of years. So I think that helps with alignment. And then ultimately we said, we want to build a liberal arts and sciences, an interdisciplinary university. So everybody was aligned. This was going to be
And some people did get off the ship.
Yeah, because some people wanted something else. So we were very clear that Indian higher ed had become too specialized, that we needed a new institution that really provided breadth and depth, that was interdisciplinary and holistic, and that gave students choice. So we agreed on the principles. We agreed on some of the disciplines we would cover and what we wouldn't cover. And we also said that we have to hire the best in the world to come, and the pedagogy has to be exciting. We'll primarily be undergraduate to start with.
Right.
And then over time, we'll build out a very strong PhD program. We won't have a very big master's program. So I think we spent a lot of time, so we were aligned on what the broader purpose is, the vision, broadly what the strategy is. And then we were able to bring in many other people. So we also had a governance model where we said, even if you put in a lot of money, you still have one vote. And you operate through...
How did that conversation go?
Well, I think a lot of it depends on, you know, Sanjeev and I were initially the 2 largest contributors. And we'd said, we are going to do this. So it just became the norm. And we just went to everybody. When actually there was someone who wanted to put a lot of money in, wanted more than one vote, we turned that person down. So it's just a principle you stick to as you build it out. But we never realized when we started that we could end up becoming the largest, we think, collective philanthropy project in India.
Right.
We've raised about 3,500 crores, Shireen, in pure philanthropic money. We've had people like HDFC Group to Axis Bank to the Bajaj Group support Ashoka at scale. Individuals, you know, R.K. Damani, Mr. Junjunwala, Rakesh Junjunwala, many others have contributed. 200 founders have contributed towards building this institution, because they believe it's an important project for the country, that India needs a new institution. That's a new form of education for India.
Welcome back. You're watching us here on Chartbusters. As you can see, the Nifty is at the low point of trade. 25,940 is where we are, led lower by Reliance. We are seeing some bit of outperformance coming in from the Midcap index in the sense that it's not fallen as much as the frontline indices, but weakness persists for the Nifty Bank. How the second half of trade pans out, we'll leave it to the team of Trading Guard, which comes up next. But don't go anywhere, because along with Trading Guard at 11 today, we have the big voice of Marx Mobius coming in as well. So stay tuned for that.
What is the Ashoka differentiator?
Where when we first dreamt of Ashoka, we had no idea that students from 40 countries would be applying to our university. Now our aspiration is, why shouldn't it be one of the best in the world?
We are the best option for anyone wanting to do high quality scholarly academic work in India.
You firmly believed in was that this must be an institute that's also inclusive.
We are perceived as being elite. I think that's largely because we do get very good students, and some of them from the very best schools. So I do think we're serving the country in one way, which is we're preventing the dollars from going outside. Individuals, R.K. Damani, Jhunjhunwala, Rakesh Jhunjhunwala, many others have contributed. 200 founders have contributed towards building this institution because they believe it's an important project for the country.
So we see Ashoka's mission to really be able to serve the country in solving these problems with the cadre of young people that we are feeding into the workplace.
If you want to maximize EBITDA, you'll be a teaching shop. You'll ignore, why would you run a PhD program? It's pure cost, no revenue. Right?
So how do you look at ROI then as far as Ashoka is concerned?
Its impact. We eventually will term out, and alumni, once they have matured, will take our place. We have no owner. There's no one family that backs this place.
The myth is that, if you study history or philosophy or political science or English literature, where will you get a job?
I'm a classic example of that. I studied philosophy and guess where I am. So.
We have students who've turned down Berkeley, who've turned down Duke, Urbana-Champaign, London School of Economics to come to Ashoka.
The valuations are berserk over there. I mean, again, great companies, but and again, I usually don't talk about stocks, but just to put some sense. And again, don't get me wrong, I'm not disputing valuations or anything, but just to give the Infosys example. Let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. Let's say it's a 30p by then because we're a fairly large company. So it needs a $4 billion PAT, profit after tax.
So when we say melt up, I just want to sort of finish that point. It usually we are talking about.
Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Sonal Bhutra, and things are getting a bit painful for our markets now, extending itself on the way down. The Nifty and the Sensex lower by 1%. The Nifty closer to 25,950. The Sensex, after losing 800 points, is now down to levels of 84,750. Realty, auto, banks, all of them are struggling. It's only the metal index which has hit a record high given what's happening with China. And in fact, China continues to steal the spotlight even today. The Shanghai index is up 5.5%. Hang Seng has moved up 3.5%. Nikkei continues to struggle. And in just this month, China has literally made up all its underperformance. Month to date, in the month of September, the Shanghai index is up close to about 15%.
That's a big move that we are seeing. It's a lot about the Asian markets now, right? We're talking about those big moves in the Hang Seng. China, of course, remains the top story to talk about as well. But just for our own markets, if you look at the Nifty, a lot of these heavyweights are putting pressure right now. Mid-caps, I would say they are actually outperforming the markets, considering the fall is not as much as the benchmarks. Reliance is the one that I wanted to point out. That's putting a big pressure on Nifty today. And this is followed by ICICI Bank and HDFC Bank. So these three putting pressure of around 110 points on the Nifty right now. So we'll keep tracking that for you. But we do have a big voice on the show today. We'll be chatting with Mark Mobius, the chairman of Mobius Emerging Opportunities Fund, joining in now to discuss his view on emerging markets, what happens to global markets after the Fed rate cut, and a lot more. He's joining in now to have that conversation with us. Mark, good morning. Thank you so much for joining in today. And, you know, we are talking after a long time, especially after so much has happened in the global markets. We're talking about the Fed rate cut, a lot of stimulus that has come by in the Chinese economy as well. So first up on China, do you think this is the time to look at China and China could outperform Indian markets?
It's, as you can see, in the last few days, China has outperformed the Indian market. But I think this is going to be temporary. There'll be a pullback. Nevertheless, it's a very, very positive situation, not only for China, but for all emerging markets. Why? Because, as you know, China represents such a big part of the index, of the emerging markets index. So you've seen China is now up tremendously, and that drags the emerging markets index as well, because India is such a big part of the index. Now, what happens? That helps all emerging markets, including India, because 50% of the money going into emerging markets is index money. So when the index goes up, a lot of people pile in, which is why you're going to see more and more investors coming to India as well as China.
Mark, good morning. That point is well made. The China outperformance helps all emerging markets in terms of the fund inflows into emerging markets. But what about China per se? You're saying that this up move perhaps is a bit tactical. You're still skeptical whether there are more legs to go. Why is that?
Simply because it has to be made clear to entrepreneurs, the big entrepreneurs in China, that the government is behind them and will not interfere with their businesses. As you know, under Xi Jinping up to now, the big entrepreneurs have really been under pressure, and many of them have been leaving, or at least not participating in the market. Now, Xi has been saying he wants to help entrepreneurs, particularly small entrepreneurs. That's a very, very good sign. Politically, it's a sign that the situation is changing. He's beginning to change his stance, and that would be positive for the market. So I think maybe what we've seen now is maybe a little bit too much on the upside. There'll be a correction, but I think we're now probably in a new bull market for China.
So do we need more on both fronts, fiscal and monetary stimulus in China now, Mark, to look at a more defined rally in the Chinese markets?
Yes, I think you're going to see more activity in China. As I said, there'll be corrections along the way, but I think we're now starting a new bull market.
That's interesting. A new bull market emerging in China. Investors have burned their fingers over the last couple of years with the kind of underperformance. So now India versus China. India's already in a bull market. All signs appear that India's bull market continues, and now you've got China with one too. So how would you compare the two?
Well, what's going to happen, of course, China is larger than the Indian market, but India is now catching up. As you know, they're beginning to change the indices to favor India more and more, a heavier weighting for India. And that means that, as I said, 50% or more of all money going into these emerging markets is index money. So when India takes a bigger share of the index, more and more money comes into India. So I think the fact that China is on the bull market is very positive for India and all other emerging markets.
Okay, so one is the Chinese factor that you're talking about, which will work for emerging markets. What are the other triggers for Indian markets now, Mark? Because we are already seeing valuations at highs across most of the sectors. What would the next trigger be for Indian markets? Even earnings, they were very tepid in Q1. The expectation is 15 to 18% for FY25 for Nifty. What is making you positive on the Indian markets?
What's positive is a long-term picture. There's no question that India is on a growth trajectory and is doing very well economically. Now, the problem facing India, as SEBI has pointed out recently, is derivatives have become too big. There are too many people gambling on derivatives, and that could put a damper on the market. So we have to watch what measures SEBI is going to take in terms of the derivatives. When that happens, you'll probably see a downturn in the market, just temporary downturn, but you'll see some correction in India. Nevertheless, we are now on a long-term bull market for India, and I see the Sensex index going up to 100,000.
How soon? Sensex at 100,000?
Yes.
How soon would that happen? By when do you expect that mark of 100,000 on the Sensex?
Probably by the end of the year, provided that the measures taken by SEBI do not put a big damper on the market. That's something that we have to watch.
But in your assessment, even if we do have measures, adverse measures, it will cause only a temporary downturn, right? It's not something which can puncture this long-term bull market in India.
That's right. The bull market is there and will continue because India is on a growth trajectory which cannot be stopped.
Sure.
We're in a tremendous period of India's history that has not been seen before.
Any fresh ideas in terms of individual stocks, Mark, when it comes to India and your investments?
I can't give you individual stocks, but I would say the sectors that are probably most interesting now is real estate. The demand for housing in India will continue to soar, and you're going to see more and more demand for middle and lower income people to have good housing. That's a very important sector. The other is metals and automobiles. Again, infrastructure spending is on the upbeat. More and more infrastructure you will see, and so therefore metals is a good area. The other area would be infrastructure related to metals. As you see, infrastructure is going like great guns, and of course the need for more and more infrastructure in India is tremendous. And then don't forget pharmaceuticals. I would say India being the largest exporter of pharmaceuticals will continue to be doing very, very well.
Okay, so those are some sectors that you like. The other space would be the emerging themes, right, Mark? We've been a service economy for a long time, but now we are focusing on products as well. Semiconductor is a big theme. Do you like something in that space, the allied sectors that could benefit from that and the opportunities there?
Well, I'm very bullish on semiconductors in India, but this takes time to develop. India, of course, as you know, is a big exporter of software, but eventually it'll become a big exporter of hardware, computer hardware, which includes chips, semiconductors. But that takes time to build. And hopefully the measures taken by government to free up the import market will be very important, because in order to produce this hardware, you need to import components, equipment, etc. That means you've got to free up the import market. And that is beginning to take place. Modi is beginning to loosen up on these controls. And that means you can build a very, very vibrant semiconductor market.
Mark, if we may request you to just hold that thought. We need to slip into a very short break, but we want to continue our conversation on the other side. So do stay tuned in.
Move in the very short term, but that's not what you mean. You think
I mean it makes a major long-term top, which is not a great thing. So I mean it's great that we are going up on a wall of worries in a way that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets don't climax at periods like that. And this seems to be more like the 90s bull market, where small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. And B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up where the entire market goes up 10x in a decade. And then you don't see that prices for, maybe next 10 or 20 years. So I'm hoping we don't get a melt up, and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4 level supply. The big guys haven't yet come. And in the bigger ones, if I take the top 10 companies, no one is supplied. Having said that, the owners of those companies, whether it's BAT selling down ITC or Singtel selling down Bharti, that's happened. But it's not like the Reliances or the Tatas or someone has come with,
new businesses
with massive issuances, which I think is around the corner. It should come.
I mean, bankers we speak to tell that over the next 12 to 18 months, about $25 billion worth of IPOs should happen. But that is, I'm not sure how much of the...
So, Prashant, 25 also, I'm saying, is a small number now. It's a $5 trillion market cap. So if you don't do 50 billion, is 1%. So issuance is, the government ought to be doing 25 billion. The larger groups easily can take 25 to 50 billion. And this is combination of primary and, of course, QIPs and so on. We've seen promoter selling, we've seen PE selling, we've seen MNC strategic selling. and it's gone from across the world, right? If GE of US has sold, Whirlpool has sold, BAT has sold, Sumitomo from Japan has sold, Singtel has sold, and now Hyundai is approaching the market. So all these chaps are getting...
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Let's continue our conversation with Mark Mobius. He's the chairman of Mobius Emerging Opportunities Fund. Mark, we spoke about the sectors that you like in India and what's happening with Chinese markets as well. The big event of that Fed rate cut and possibility of more in this calendar year itself. Do you think apart from emerging markets, there are other markets which are looking interesting to you that tend to benefit from the developing space?
Yeah, there are other markets, but it's very, very selective. As you know, the U.S. market is doing very well. And one of the reasons why there's so many interesting companies in the U.S. is because they are benefiting from the surge of emerging markets development and growth. So I would say selectively you could look at the U.S. market, but the emphasis should be on those companies that have exposure to India, to China, and to other emerging markets, either in terms of supplying these markets or buying from those markets. So it's really a mixed picture for the U.S. market, but you can't ignore the U.S. market. It's so huge. And there's so many things going there.
So Mark, if you had $100 of a fresh investment to make, how would you divide it in terms of the US markets, in emerging markets, and within emerging markets, since China is now playing catch up, would you look to realign the weightages? So break up that $100 for us in terms of a fresh investment today.
Well, I would say at least 50% in India, then 25% in China and Taiwan. By the way, whether you consider Taiwan part of India or not, it is very much benefiting from the surge in growth in China. So you have to include Taiwan. And then another 25% divided between Vietnam, Turkey, Brazil, and then Korea and Thailand. Those would be the breakdowns. Again, notice I haven't put anything into the US because I believe now's the time for you to be in emerging markets rather than the US market.
Okay. What we've seen earlier, and there was a Citi note that I was reading, it said that FIIs have historically been sellers of Indian equities in the month after a US rate cut cycle begins. What is the FII view now, Mark, according to you? We did see that big flow coming in September in terms of FII flows, and that has not been very consistent now in Indian markets. Do you think we'll continue to see these flows? How are FIIs viewing India now?
You're going to see more FIIs coming into India. As you know, many of the FIIs have been going into derivatives. So you're going to have a lot of very short-term money in India for that purpose. But generally speaking, because of the index, as I mentioned, the heavier weighting of India in the index and the fact that the index is going up on the back of China moving up will be very positive for India. And you'll see more flows into India from the foreign investors.
How concerned should we be about the valuations? Because Indian markets, despite very high valuations, have continued to outperform and soar. So is there really a big consideration now for Indian markets when it comes to fresh investments, high valuations?
Well, many people measure valuation on the basis of PE, price earnings ratio. And yes, of course, if you look at the price earnings ratio, it's very high by historical terms. However, what people forget is the E of the P. You have the price and the E, there's earnings. With earnings moving up at such a fast pace, the market looks not overvalued because of that big move. So you have to look forward. A lot of people, of course, look back. They say, oh, the PE looks high, but they forget that the market is moving at such a pace and the growth in the country is so great that the future PEs are actually coming down.
Okay, but it's just that for this year and the way we have seen quarter one performance, E also isn't looking as exciting as it used to earlier, right? So there has been a concern around future earnings growth in some of the sectors which have seen returns which were not expected earlier anyway, Mark. But you know, the other asset class which has been doing really well is gold. Is it still the time to look at this particular commodity? How much can one put into gold at these levels?
I think it's a very good idea to hold gold, maybe 10% of your portfolio. I think gold is very important to have. And as you know, one of the reasons why gold prices are moving up is because of Indian buying. With per capita income moving up in India, of course, there's going to be more money going into gold because Indians, you know, traditionally love gold, like to have gold, and consider gold a currency.
Mark, getting back to India, you listed out many sectors which look interesting to you: real estate, affordable housing, infrastructure, etc. You skipped out banks, and banks is the largest chunk of where the FI money is parked in India. So, you know, one argument which has been made for a very long time now is that Indian markets are at an all-time high valuations, but the relative valuation of banks is still attractive because banks are nowhere close to the historical high valuations it's enjoyed in the past. So why have you, not added banks in your list of sectors which you like in India?
Well, in that list, I would add financials. As you know, I've given you 3 sectors. I would add the 4th one would be financials. Yes, that's a good possibility. Generally speaking, I'm not excited about banks because it's very difficult, not very transparent. It's very difficult to know what kind of loans they have on their books and what could go bad. So you have to be cautious with banks. Look at if you can, look at the loan book. Very often that's not available. But yes, banks would be a sector to look at.
So you would like banks as a space as well, apart from real estate and pharma that you spoke about. Mark, I was looking at the fund holdings, and Persistent Systems is one of them that you have in your fund. That is the Emerging Markets Fund. How do you look at the entire IT space? And in the IT space, do you like the large caps or the mid caps right now?
Well, as you know, I love technology. I like to be in technology, whether it be software or hardware. But as I mentioned, the sectors that I quoted previously tend to be faster moving at this stage of the game. And I think that's where you want to be. Doesn't mean Persistent is not a good stock to hold, and we will continue to hold. But generally speaking, we're better off in the sectors I mentioned, the real estate, and that's the metals and infrastructure.
You know, Mark, increasingly a lot of experts we speak to are sounding cautious now. They're saying that the run-up has just been too much, too soon, too excessive. In fact, one of the fund managers today said that it's time for fund managers to be risk managers. So while, yes, India's long-term bull market is structurally intact, just over the next 12 to 18 months, would you be a bit cautious given where we are? And outside of the derivative, the SEBI action on derivatives, are there any risks lurking on the horizon?
Well, that is the key risk. As I mentioned, if you have SEBI coming out with regulations to limit exposure to derivatives, then you could have a downturn in the market because, as you know, there's a tremendous amount of derivative activity in the market, and that would have a big impact. So that's why, yes, I think the advice of fund managers to look at risk is very, very sound and very timely. It's a good time to consider that. And of course, as I mentioned, I've always said that despite the long-term bull market that you see in India, there will be corrections along the way. And a correction could be 5, 10, 15%. That's for part of the activity of markets generally around the world. So expect that, but be ready to buy in again when the market comes down, because there'll be opportunities to buy cheaper stocks.
Okay. So Mark, anything that you've bought into or you have your eye on waiting for the markets to fall? We had spoken earlier, you said you like Tips Industries, there's Netweb Technologies. Is there anything new that you are finding interesting in Indian markets, apart from the spaces or themes that you spoke about?
Well, I'm very interested in the whole semiconductor area, and I noticed there's been more and more activity in that sector. As you know, Modi has recently inaugurated, I think, 3 major investments in semiconductors. And there have been a company like Micron has come into India with $1 billion+ in investment. Those sectors are going to be very, very interesting, and we have to keep an eye on them.
Have you been investing in the primary markets? We've had an IPO boom in India, Mark. Some are saying perhaps it's not a boom, maybe it's heading towards a bubble. What have you made of the IPO action? And have you been participating?
Well, when you have such a bullish market, obviously it's a great opportunity for people to list their stocks because you can get a good price, a high price. In my view, it's not a good idea to pile into these IPOs unless you're very, very certain about their earnings growth. And as you know, many of these IPOs, their earnings growth is questionable at best. So I think you have to be very, very careful in a bull market to buy IPOs.
And would you say the same for new age companies? Would you buy into something like a Swiggy, Hyundai? Those are the 2 big names that we are watching out for now.
Not yet. I'd be wait. Usually, what I like to do is let an IPO go to the market, let it get some experience in the market in terms of the buying and selling that takes place after the IPO, and when things settle down, then that's the time to buy.
Okay. Mark, we spoke to you a lot about stock-specific ideas and sectors as well. What are you reading now, and what is your next destination for traveling? 112 counting in terms of countries visited. What's on your radar?
Well, India is on my radar. I'd like to get back to India. As you know, I took a month and a half last year in India, and I want to take a longer trip to really see all parts of the country. You know, it's an incredible country with so many states and so many different situations and cultures. We have to see more and more of India going forward.
You've got to promise us a studio visit when you come to India next, Mark. It's always a pleasure chatting with you. Thank you very much for your insights. That's Mark Mobius, investment guru, emerging market guru, market veteran. We'll slip into a very short break. We'll come back and talk about individual stocks in India. We'll put the spotlight on PB Fintech and Paytm and find out why they're buzzing in trade.
But we still haven't come and raised the money.
And that will happen according to you?
I think it's inevitable. I mean, that's what capitalism is, right? That demand for paper will create the supply.
And we're a long way off from that climax or whatever.
I hope I'm not proven wrong next week, but I think this has legs to go.
This has legs to go. PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But people, defense, etc., right? That part, it looks like we're starting to rotate. People are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done, or is just like a pause and refresh case
again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate.
Right.
And then the excesses which happened in that period made them complete pariahs. So if 4 years ago, we were on a show and Ramesh and I remember we would talk about PSUs and everyone was like sniggering, like what's wrong with these chaps? But because the correction had been so steep that it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return, and the what so-called poorest PSU may give you the best return. So it was a mean reversion trade which happened, and of course all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change, but you went from terrible to being good. So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically, these are not high return areas. By definition, if you make 25% IRR in an infrastructure business, the cost to the consumer, which is the average public, is going to be too high. So your money made is really on leverage, and therefore the return on equity comes in that business. So, and people are shy of doing leverage after again the last cycle. And the flip of it, to just complete, the leadership of the last cycle was all the high quality businesses in the last decade, which were all getting re-rated. Asian Paints, Page Industries, Kotak Bank,
consumers,
HDFC,
retail.
even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected, that Kotak, HDFC haven't performed for the last 5 years. Again, great companies, but it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move? And there are memes on HDFC doing the round the way it was for ITC. And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
so things like that tend to happen. I can't forecast what will happen in...
But you're very bullish on the financialization theme.
I am very much.
The magic one that everybody is talking about at this point in time is AI and what AI can do, and specifically generative AI. How do you see that linking back to the efforts on the healthcare side, the innovations that you're working on? I mean, how transformative is AI likely to be, or are we on the cusp of seeing that kind of transformation?
Usually when you get new technology, it's applied in the rich world for those who are well off. And what we'd like to do this time with AI is make sure, both in terms of discovering new interventions for nutrition or vaccines or drugs, and helping give people health advice, in voice in their native language, that we actually bring these AI advances to those most in need. I mean, after...
Welcome back. Let's talk about PB Fintech. Now, PB Fintech has said it will be a minority investor in the company via which the healthcare foray will happen, and investment will be up to $100 million. That's the word from Chairman and Group CEO Yashish Dahiya. They added that they're looking to bridge the trust gap between hospitals and insurance companies. Listen into that conversation.
PB Fintech is looking to make an investment subject to board approval in a separate venture, which actually is not a PB Fintech subsidiary. PB Fintech would probably be a minority investor between 20 to 35% equity holding, right? And this venture, for lack of a better word, let's just call it XYZ. XYZ has its own life beyond that, and PB Fintech's liability is limited to that first investment. It does not have any compulsion to keep investing into the future, right? And all this is subject to board approval. The model is essentially an HMO model. And this entity is obviously finalizing with its other investors and other partners. They could be healthcare companies, they could be insurance companies, they could be development finance institutions, they could be private equity players. There's a whole bunch of people that it will speak to. This hospital is going to be aligned to the insurance industry. We are not really thinking about what it does to the other hospitals. I do believe it will, if successful, set benchmarks for the others.
All right, that's the word coming in from PB Fintech. But let's move on. Paytm CEO Vijay Shekhar Sharma has said that he regrets not choosing the correct banker for the company's IPO. Remember, Paytm stock had tumbled 27% on its listing day on 18 November 2021, making it one of India's worst large IPO listings. Currently, the stock is down 69% from its offer price. Sharma added that Paytm did not attract VC investments in the initial 7 years since the inception of the company, and that he has been bootstrapped entrepreneur.
I have a regret now, not in the joining of entrepreneurship. I've been an entrepreneur for long enough now. I have a regret of not choosing the correct bankers for IPO. If you choose the correct bankers, जैसे भगवान के मंदिर में जाने के लिए आपको सही पुजारी चाहिए होता है, शायद हमने वो नहीं चूज करे तो उसका choose a right banker, my friends. अभी तो छोटी-छोटी IPO भी इतनी बड़ी हो जाती है. In Iran age, it was driver making a crore. In Paytm's case, I know 20 people who made ₹1 billion, 100 crores.
Excellent.
20 people. And many of them cashed out more than 100 crores. I'm a bootstrap entrepreneur who had to do a lot of cash generation by the business. And in that rush, I learned only one thing for ladies and gentlemen in the room. There's nothing called P&L. This profitability, which is a P&L, which is an opinion. The real truth is cash. Everything else is a trash.
That's the advice coming in from Vijay Shekhar Sharma, the lessons that he's learned and the difference in being a private company and public, and how the company had to focus on cash and improving its profitability metrics once it got listed. We'll slip into a very short break. We'll come back and focus on market technicals. Soni Patnaik from JM Financial Services joins in on the other side.
Of doctors, it's in developing countries. And so the foundation is leading the way by giving grants to various people and pushing this forward, even for a topic as complex as nutrition. The AIs are going to help us understand things faster than we would without it.
If you could do a startup all over again and focus on AI, what would the niche be that you would like to address?
Well, if you could go back to my school days even, and then I was saying, hey, how do we make software as smart as human beings? And I was constantly thinking about it. I underestimated how long it would take, but here we are on the cusp of that. And so now the lens I apply is the lens of the foundation. If I was somebody young, sure, I'd compete with, OpenAI and all these people. But, now I'm in the stage of saying, how do I help other people work in AI apply it to those most in need?
As far as India is concerned, the role and relevance and the significance of India, especially as far as the foundation is concerned, and what you're hoping to do on the innovation side.
So India's the country the foundation does the most in. Other than the US, that's our largest group. We have a great team there. We work a lot with the national government and many of the state governments. And not only do we see in areas like nutrition or using ultrasound to detect a difficult pregnancy, we're doing a lot of studies with our partners there, which will have a benefit for India. But also, because the digital infrastructure in India is so strong, we can try things out there and take them to other countries. The digital infrastructure itself is a great example where the leadership has laid that foundation, and now both India and Gates Foundation are going to Africa and other places and saying, hey, you should do the same thing.
Was there a specific learning from this trip to India for you?
Well, it was pretty amazing in Odisha to see how the digital approach was connecting with farmers, that they had categorized which farmers were in which location, what were they growing. And so when they would see crop disease outbreak, they could notify them. If they saw weather coming, they could notify those farmers. If the market prices were changing, they could help guide the farmers. And so the digital revolution, bringing that into that agricultural sector, that was the first time I saw that at work. And it's being scaled up in India. Now we'll take it to the rest of the world.
News which just came out, a government-to-government deal between US and India to set up a...
Welcome back. Well, the pressure continues. 277 points lower on the Nifty. The mid-caps are 2 down 250. And the Bank Nifty is the one which is taking it to the chin. That is the one which is underperforming with cuts of almost 670 points right now. So good time to get a technical check on the market. Soni Patnaik from JM Financial Services is joining us now. Soni, good morning. Thank you so much for joining in. Well, markets are at the day's low. Do you see some recovery, or do you think we could see further pressure from here on?
Hi, good morning, Sonal and Rima. Thank you for having me on your show. A much needed correction in Nifty. We've seen it heading, coming lower towards 25,900. However, it is very much close to its support area of 25,800. So there could be another 50 points of pain on intraday basis, but then it can recover from those support points and again retest 26,050 to 26,100. This can be the sideways range as this is a truncated week and Nifty may remain in this range not for long. Any break below 25,800 can cause another raise, another caution and raise another alarm for a further correction up to 25,600 odd levels. So I think 25,800 should act as a strong support and one can place the stop loss around those levels. What is important right now to watch out for is Bank Nifty, which is just at its support of 53,200 to 53,000 level. There could be a bounce back from Bank Nifty. It can head higher again towards 53,500 to 53,700. So I think that's the level to watch out for when it comes to indices.
Okay. What about individual stocks? What would your trading ideas be? And a particular mention on Reliance Industries and what's happening?
Certainly. So the first buy stock would be from the metal space, JSW Steel, which has seen a very fresh breakout today, backed with strong rollover volumes seen in October series. So one can buy in JSW Steel futures with a stop loss of 1015 and a target of 1060 to 1080 can be seen. The second buy pick would be from the cement space, Grasim, which has also seen a good option chain breakout today above 2,800. So one can buy Grasim futures around 2,835 at current levels, keep a stop loss of 2,800 and a target of 2,870. A further target of 2,900 can also be seen. If we talk about Reliance, we can see that the stock is holding on to a good support level, above its 3,000 odd level. So I think Reliance is just at the cusp of its support. Any bounce back can be seen from lower levels of 2990 to 2980. One can continue to hold longs. The stock can test 3,100 in October series.
Okay, all right. Thank you, Soni, for joining in today and getting us your technical picks. That's a technical check on the markets. Time for a short break now. We'll get you more on the markets on the other side. Stay tuned for that.
Unit in the country. Right. There are elements of technology transfer, etc. That's the cutting edge. Semiconductor and sort of plans to localize production. Right. I just wanted your thoughts.
I think it's great. I would love to, India's quote a non-aligned nation, and I don't think we should be asking to align, but I think it's great that we're reaching out to each other, helping each other, investing in each other, and I would love to see far more of that. And this has two elements. One is the national security part, which of course all countries have an interest in. And the second is just, a better economic relationship.
Over the last 2-3 years, we've seen the rise of the so-called industrial policy across the world. Yeah. National security is being prioritized, as you said. Do you see this as part of that in the context of that?
Yeah. So industrial policy, I'm a little cautious about. I think to combat some of these things and to do things in your country's own interest, which are hard to do economically, you're going to need some economic policy, industrial policy, like the United States has, for rare earths and things like that, and lithium. Every country is different. So the national security needs of India are going to be more around energy. I think for everybody it's going to be semiconductor chips. So I do think that's industrial policy. I would caution industrial policy when it's used for regulations, bureaucracy, politics, votes, social, and it doesn't have, the twin of permitting. It's not going to work. So you got to be a little cautious when you use it. But yeah, we're going to have some. And like I said, I think it's very important that America and India have a great economic relationship.
Would you agree, though, that in the former part of what you described, industrial policy is kind of taking the lead. Businesses and who you align with, who you want to do business with, building supply chains. A lot of that is now, it seemingly is led by that. I mean, what governments really want to do. Well,
no, it's two different. Governments have always negotiated economic arrangements, stuff like that. If you look at the United States, the industrial policy is a very teeny part of the economy. So it isn't like it's taking over the economy. Right. I think in other parts of the world, it's obviously a much bigger part of the economy. So But yeah, nations, because of national security and because of what some people might consider unfair competition, there will be forms of industrial policy. If I was a government, I'd be very, very careful. It should be very targeted, very specific. It shouldn't be to protect local industry. It shouldn't be to just create jobs. It should be for a very specific reason. But you're going to see it, and hopefully it's well done.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down. Inflation is coming down. And relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality. Yeah.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more?
I'm not. So my caution is all geopolitics, which may determine the state of the economy. Okay. But it's really the geopolitics that these things, they're investing.
Welcome back. You're still tuned into Trading Hour. While the benchmark indices, they are seeing a lot of pressure, a lot of moving parts in the broader markets that we should be talking about. Naveen Fluorine is the stock that I'm tracking today. A lot of analysts, they visited the vast facility, the CDMO facility of the company, and there were some takeaways, important ones from that one as well. Management expects strong growth in the CDMO on the back of the Fermion contract that the company has entered into, and company is targeting 40% of their CDMO revenues to come in from the late stage molecules by the end of FY25. They invested a lot in there, and now they are seeing some growth come by in that particular segment. It is one of the 2 suppliers for the intermediate product going into Bayer's darolutamide. That is where the Fermion contract is helping them. So the revenue potential from this intermediate is $25 million, and it could rise to $75 million by FY29. The company says they can actually benefit from 50% of revenues coming in from this huge contract in FY29. And the 540 crore specialty chemicals plant, it is expected to commission by October end. The fly in the ointment is the recovery that we are seeing in the specialty chemicals business. They were expecting it in the second half, but there is no clarity on that. They are still talking about some demand visibility which is remaining clouded. Because of which Jefferies is an underperform with a target price of 3,000. They say continuous channel destocking and Chinese aggression, they are posing some pressure on their intermediates portfolio. Morgan Stanley has an underweight as well. They say near-term earnings are not yet fully de-risked, so upgrades are still some time away. It's all about the specialty chemicals business, which is making a lot of these brokerages nervous. Nirmal Bang, on the other hand, says they have upgraded the stock to a buy. The target price has been raised to 4,000, but that is on a rollover. They say, yes, while Chinese aggression and demand is still a problem, they see margin improvement from here on. That is why they're bullish on the stock. But overall, the street is still divided on whether this chemicals recovery would come by or not.
Okay, thank you very much for that. Let's talk about the two-wheeler industry that's also in focus on the back of fresh brokerage notes. Vinny is here with the details. Vinny.
Good afternoon. So yes, talking about the two-wheeler space, we have UBS that has come out with a note, and they do like TVS Motors, Eicher Motors, while they maintain their sell on something like a Hero Moto and Bajaj Auto. Now, what they're highlighting specifically in terms of trends for two-wheelers, they believe that the discounting that one is seeing for two-wheelers, that started seeing a further increase. Now, in passenger vehicles, we're already seeing that increase. Two-wheelers, that is also a trend that seems to be continuing, and festive season, they expect this trend to continue. So yes, e-commerce platforms especially are indicating a very high discount. They're there's a sharp discount in these platforms, and that is because of increased competition as well as in terms of inventory pressures. They expect this discount through the season of festive season that will be starting just around this week, next week, to continue till the end of the year because of the festive season. So yes, discounting for Hero Motor, that's in the range of 11 to 18%. Bajaj Auto is on the higher end as well, 12 to 16%. So high discounts are being given by two-wheeler makers to actually attract customers. And while in terms of electric two-wheeler vehicles, the pricing is still below the ICE motorcycles or scooters. So that is why TVS Motors is gaining share, while we are seeing a bit of a loss coming in terms of market share from Hero MotoCorp, and that is why they're maintaining a sell on Hero and Bajaj Auto, while TVS and Eicher continues to be their buy pick.
Okay, so the two-wheeler industry continues to be in focus. We have the auto sales numbers, which are expected tomorrow as well. Thank you, Winnie, for joining us with all those important details. Let's slip into a break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Valuations are one standard deviation above overall market, and in certain pockets it's crazy. Look at the SME part of the market; it's in a different frenzy altogether. 65 times the index is up over the last 5 years. So I think what I would suggest to most of your viewers and the investors in the market, this is the time to go back to basics of investing. Make sure that the quality of the company you are investing is not compromised, and make sure that the portfolio is resilient enough that whenever there is a drawdown, the portfolio stands tall. So these are the few things which is under your control, which you can do. On the themes, I think power demand and electricity could be a slightly medium to longer term theme, and energy transition. And look at some of the data points. After 15 years, US is starting to see increase in demand for electricity, led by data centers, EVs, and so on and so forth. You will be surprised to know that CY19 to CY22, out of the top 10 air conditioning installation markets, 8 were out of Europe. Who would have thought that Europe will install ACs far more than any other country? And 8 cities out of the top 10 are from Europe because of global warming. So I think there are 4 important points: global warming, data center, which is AI, electric vehicles plus bitcoins and cryptos, and the constraint on transmission and ESG, which is leading to the entire energy transition and increase in demand for power. I think this could be played through various things: distribution, transmission, or generation, and the ancillaries to that. So I think it's a mega trend. Valuations could be something which is prohibitive right now, but keep a close watch on this trend over the next 5-10 years.
Welcome back. It's below 25,900 on the Nifty, but names like Dr. Reddy's are trying to stage a bit of a recovery. Dr. Reddy's is up close to about 0.3%. Even the cuts on the PSC index, the Nifty PSC index, are getting trimmed to some extent. So ONGC is up close to about 0.7%. That's recovered nearly 2% off from the day's low. But it's time now to talk commodities. Manisha is here to tell us more about crude oil prices. Manisha.
Well, like all industrial commodities, we're looking at the crude oil prices as well, coming back a bit after 3% decline in the previous week. Well, there are 2 or 3 reasons why you have seen support come back in case of crude oil prices. One is that Israel really seems to be stepping up attacks on Iran-backed forces. Second is that the China stimulus is anticipated to support prices and demand, not immediately, but at least in the final quarter of this calendar year, we might see the impact of these stimulus start to show. That has been supportive as well. Third is the Hurricane Helen, which has forced 25% of output from Gulf of Mexico yet to be stalled again. That is adding premium to prices as well. And then the markets do believe that in the month of November, when the US Fed sits for another monetary policy, there is a 57% chance of a 50 basis point rate cut and 43% chance of a 25 basis point rate cut. So it really is a divided house, and 50% really seems to be aiding higher. The markets also keep an eye on Saudi Arabia, which is going to increase production by the end of this year. Remember, OPEC is also increasing production by 180,000 barrels per day from the month of December. So this increase in production, whether or not it coincides with better demand going forward, is something that's keeping the markets uncertain right now. And then it also has to do with the US presidential elections in the month of November. So there's a whole host of things that the final quarter of this year will bring about. In the meanwhile, for this week, it is going to be about the US Fed Chair Powell testimony in this week. You also have important data like inflation coming in from Eurozone, employment and retail sales from Japan as well. So there's going to be a lot of choppiness and reaction to these as well.
All right, Manisha, thank you so much for joining us with those important details on commodities. By the way, for the markets, Rima just mentioned Nifty is below the 25,900 mark. Bank Nifty is the one which is leading to that. HDFC Bank and Kotak Mahindra Bank. Watch out for these two. They are at the day's low, so some pressure coming in from these two big names, and that is something we'll be tracking very closely. HDFC Bank is at the day's low. It's down almost 1.5%, and Reliance Industries is the other one which is leading to a lot of pressure that we are seeing on the Nifty today. We'll keep tracking markets for you, but for now, it's a wrap on Trading Hour today. Stay tuned. Halftime report is up next.
This takes me back to a conversation that I remember having with Mr. Murthy about starting Infosys. And I said, like 7 of you, of course, he was the first among equals. But I said, how did you get a decision made? Because, and especially we are known as argumentative Indians for a particular reason. What was that like? And he told me, he said, look, it was very simple. We had a sort of unwritten rule that in God we trust, everybody else brings data to the table. What was it like for you?
So we started with a smaller group, as Pramath was saying, Sanjeev, Pramath, myself, only a couple of others. It was a small group. And I think we spent a lot of time. So even as a precursor, we used to meet one Saturday a month at my old office, and we would have conversations. And this happened for a couple of years. So I think that helps with alignment. And then ultimately we said, we want to build a liberal arts and sciences, an interdisciplinary university. So everybody was aligned. This was going to be
and some people did get off the ship.
Yeah, because some people wanted something else. So we were very clear that Indian higher ed had become too specialized, that we needed a new institution that really provided breadth and depth, that was interdisciplinary and holistic, and that gave students choice. So we agreed on the principles. We agreed on some of the disciplines we would cover and what we wouldn't cover. And we also said that we have to hire the best in the world to come, and the pedagogy has to be exciting. We'll primarily be undergraduate to start with.
Right.
And then over time, we'll build out a very strong PhD program. We won't have a very big master's program. So I think we spent a lot of time. So we were aligned on what the broader purpose is, the vision, broadly what the strategy is. And then we were able to bring in many other people. So we also had a governance model where we said, even if you put in a lot of money, you still have one vote. And you operate through...
How did that conversation go?
Well, I think a lot of it depends on, Sanjeev and I were initially the two largest contributors. And we'd said, we're going to do this. So it just became the norm. And we just went to everybody. When actually there was someone who wanted to put a lot of money in, wanted more than one vote, we turned that person down. So it's just a principle you stick to as you build it out. But we never realized when we started that we could end up becoming the largest, we think, collective philanthropy project in India.
Right.
We've raised about 3,500 crores, Shireen, in pure philanthropic money. We've had people like HDFC Group to Axis Bank to the Bajaj Group support Ashoka at scale. Individuals, RK.
Stocks see a broad sell-off with declines far outstripping advances. Realty, auto, financials are the big losers, even as metals and consumer durables eke out some gains.
PB Fintech's top brass tells CNBC-TV18 they will make a one-time only investment of up to $100 million for a 20 to 30% stake in a health venture to set new cost benchmarks, as most can't afford hospital room rates at 78,000 rupees per night.
Giving relief on GST to Infosys on the hefty rupees 32,000 crore demand is a policy call for the government to take. DGCI's principal Anil Gupta tells CNBC-TV18 in an exclusive chat. He adds that further action by the DGCI in this matter is only expected after Infosys responds to the pre-show cause notice.
Chinese stocks soar after an inline manufacturing PMI print on stimulus-driven recovery hopes, with lenders asked to cut mortgage rates by end of October. But Japanese stocks dip after monetary policy hawk wins the race to become the next prime minister. A very good afternoon. You're watching Halftime Report on CNBC-TV18. I'm Ekta Batra, and with me is Manglam Malu. Well, it is turning out to be a session where we are seeing a soft start to the week. So currently we have the Nifty, which is down around 1% We have the Bank Nifty, which is marginally underperforming, so down around 1.4%. And the mid-caps, which are marginally outperforming on a relative sense, so down around 0.4%. Maybe it is the mixed picture in Asia, which is probably weighing down on us. We have China, which rallied after that better than expected PMI, but the Japanese markets, which are under pressure. Otherwise, I just want to point out the advance decline ratio is weak, so let's see whether there's any kind of marginal improvement as we close towards the day. But as of now, it's favoring the declines. Hi, Manglam.
Hi, Ekta. It is indeed favoring the declines. But, even as we're declining in the frontline indices, the Nifty Bank is the key culprit in today's trading session. The last two trading sessions, the Nifty Banks actually corrected over 1,000 odd points as well. What's interesting is today, we don't have to struggle to find pockets of green. Metals, for instance, for the 8th day running, the index is in the green. A bunch of stocks are doing well. Even in the broader markets itself, you have, some of these consumer durables doing extremely well. Whirlpool, for instance, is up around 4%. We're seeing some traction in names like Alembic Pharma, Dalmia Bharat, IDFC as well. And down the barrel, if you look at it, a lot of these cash stocks also putting on decent gains. Reliance Infra has been on an upward trajectory for the last many trading sessions. And now the stock has rallied about 65% in the month of September itself. SJS Enterprises, another, company seeing some traction, up around 8% with decent volumes. And giving it company on the way up is Saregama, which is up around 10% as well. All these stocks gaining with decent volume. So we'll keep an eye out on a bunch of these stocks which are buzzing around. So it's down for the frontline indices, not particularly out for the broader markets itself. The Midcap index down by about 1/3%. But many stocks in focus today. PB Fintech will be one of them, a minority investor in the company which via which healthcare foray will happen, and the investment would be no more than $100 million. That's the word coming in from the group chairman and CEO Yashish Dahiya. They're looking to bridge the trust gap between hospitals and insurance companies. So that's the word coming in. Remember, the stock was in focus all of last week after our colleague Yash wrote the story about them looking to enter the healthcare space, and thereafter there was a bit of a decline, but now some more details emanating from the management commentary to CNBC-TV18. So let's hear him out.
PB Fintech is looking to make an investment subject to board approval in a separate venture, which actually is not a PB Fintech subsidiary. PB Fintech would probably be a minority investor between 20 to 35% equity holding, right? And this venture, for lack of a better word, let's just call it XYZ. XYZ has its own life beyond that, and PB Fintech's liability is limited to that first investment. It does not have any compulsion to keep investing into the future, right? And all this is subject to board approval. The model is essentially an HMO model. And this entity is obviously finalizing with its other investors and other partners. They could be healthcare companies, they could be insurance companies, they could be development finance institutions, they could be private equity players. There's a whole bunch of people that it will speak to. This hospital is going to be aligned to the insurance industry. We are not really thinking about what it does to the other hospitals. I do believe it will, if successful, set benchmarks for the others.
All right, that's about PB Fintech, the stock on our radar. But let's get to the most important discussion that we've lined up for you in the show today. It's latest monthly drug alert list. The Central Drugs Standards Control Organization has declared 53 drugs as of not standard quality. Ekta, how has the pharmaceutical industry responded, and what exactly is the extent of this issue?
Well, yes, I'll take you through the details. Well, after the Central Drug Standard Control Organization, or the CDSCO, flagged 53 commonly used medicines for failing quality tests, several pharma companies have defended the quality of their products. In its August 2024 report, the CDSCO declared over 50 drugs as not of standard quality, or NSQ, including essential medicines by major companies like Alkem's Clavim 625 and Pandi, Sun Pharma's Pantocid and Palmosil, and Glenmark's blood pressure drug Telma H. Now, Sun Pharma, Glenmark and Alkem have responded, stating that the flagged batches were spurious and not manufactured by them. Torrent Pharma issued a similar statement regarding Shelcal 500. The Indian Pharma Alliance, which is IPA, represents around 23 pharma companies, including the likes of Sun Pharma, Lupin and Cipla, stressed that NSQ and spurious drugs should not be mixed up, as it wrongfully implicates legitimate manufacturers. NSQ drugs may have labeling issues or incorrect ingredients, while spurious drugs are fake copies. The IPA warned that linking spurious drugs to legitimate companies could damage reputation and harm India's standing as a reliable drug exporter.
Meanwhile, experts like activist Dinesh Thakur suggest that the CDSCO publish investigation details to determine if flagged drugs are counterfeit or genuine, and is easy to access this kind of data as pharmacies are required by law to have records of all drugs. Now, the outcome of the investigation would be crucial, according to experts. As experts point out, spurious drugs on our hands would be a far greater problem to solve. According to a 2022 study by ASSOCHAM, around 25 out of 100 drugs are fake, counterfeit or substandard in the country. In fact, the latest case making headlines has been antibiotics supplied to the government hospitals in Maharashtra were actually just talcum powder mixed with starch. Meanwhile, the government and companies have been taking important steps to curb the spurious drugs menace. For example, all large companies have incorporated unique features and QR codes in its packaging to ensure genuine products are differentiated from fakes. The government has also been active. For example, they revoked licenses of 18 pharma companies in December 2023, increased quality checks and increased inspections as well. However, experts point out the need of the hour might be greater vigilance and possible tightening of regulations and implications around it as well. Okay, well, on that note, we'll take a short break, but up next, we'll continue to focus on the space and connect with Rajeshwari Hariharan, who's a counsel at the Delhi High Court, and Mr. Reddy, the MD and CEO of MedPlus Health Services, for their perspective.
Mr. Jhunjhunwala, Rakesh Jhunjhunwala, many others have contributed. 200 founders have contributed towards building this institution because they believe it's an important project for the country, that India needs a new institution. That's a new form of education for India.
What is the Ashoka differentiator?
Where when we first dreamt of Ashoka, we had no idea that students from 40 countries would be applying to our university. Now our aspiration is, why shouldn't it be one of the best in the world?
We are the best option for anyone wanting to do high quality scholarly academic work in India.
You firmly believed in was that this must be an institute that's also inclusive.
We are perceived as being elite. I think that's largely because we do get very good students, and some of them from the very best schools. So I do think we're serving the country in one way, which is we're preventing the dollars from going outside. Individuals, R.K. Damani, Jhunjhunwala, Rakesh Jhunjhunwala, many others have contributed. 200 founders have contributed towards building this institution because they believe it's an important project for the country.
So we see Ashoka's mission to really be able to serve the country in solving these problems with the cadre of young people that we are feeding into the workplace.
If you want to maximize EBITDA, you'll be a teaching shop. You'll ignore, why would you run a PhD program? It's pure cost, no revenue. Right?
So how do you look at ROI then as far as Ashoka is concerned?
It's impact. We eventually will term out, and alumni, once they have matured, will take our place. We have no owner. There's no one family that backs this place.
The myth is that, if you study history or philosophy or political science or English literature, where will you get a job?
I'm a classic example of that. I studied philosophy and guess where I am. So
we have students who've turned down Berkeley, who've turned down Duke, Urbana-Champaign, London School of Economics, to come to Ashoka.
The valuations are berserk over there. I mean, again, great companies, but and again, I usually don't talk about stocks, but just to put some sense. And again, don't get me wrong, I'm not disputing valuations or anything, but just to give the Infosys example. Let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. let's say it's a 30p by then because it'll be a fairly large company. So it needs a $4 billion PAT, profit after tax.
Welcome back. You're still tuned into Halftime Report. Well, let's continue our discussion with regards to spurious drugs, the difference between that as well as not of standard quality, and the latest August 2024 report by the CDS CEO. We have with us Mr. Reddy, the MD and CEO at MedPlus Health Services, and we have Rajeshwari Hariharan, who is a counsel at the Delhi High Court, who will be joining us shortly. Well, Mr. Reddy, let's start with you. You have around 4,400 pharmacies that you run across India. Give us a sense in terms of whether you all have tackled this spurious drugs problem at your pharmacies, and how does one recognize it?
Let me just take a quick minute to tell you how I started the company. I'd actually written a business plan in Wharton in 2005 when I came across an article which said that 30% of all fake drugs in the world are made in India. So the plan, I set up the company in 2006 primarily to give a USP or to make sure that everyone got genuine medicines, had access to genuine medicines. So we have been looking at this problem from the time we started, and the way we tackle it is we work directly with the companies in procuring the products. A lot of times, small retailers who can't have access to the distributor or the CNF agent end up buying through wholesalers and small third-party sellers from where they end up actually getting these fake drugs. So for us, given that we buy directly, we have not seen that problem at all.
Okay, so you haven't seen the problem arise at all till now. But we do have Rajeshwari, who's from the Delhi High Court, joining in to discuss this as well. Rajeshwari, thanks very much for taking the time out from a busy day. But if you could just give us a sense in terms of how serious this issue is, which the CDS CEO has flagged off about these 53 drugs, many of them from very legitimate companies such as Sun Pharma and the rest.
So there are two issues here. The kind of drugs that the CDSO has now banned is a different category altogether. These are drugs which are combinations. So what has now been banned is a combination of an existing drug. So this is not necessarily a spurious drug. Now, when you talk about spurious drug, that's a completely different category. Spurious drugs are those where the drug is either adulterated or the active ingredient is completely different, or it is somehow mixed. It's not the actual thing which is promised to be. So, for example, if they're supposed to be selling antibiotics, then the drug in the container will not actually contain antibiotics. It might just contain something else, or it might be adulterated with something, or it might just have completely different ingredients, or it might have been expired. That is the category of spurious drugs. The ones that the CDSO has now banned are drugs which are of good quality, but they are in the market for some time, but people have made combinations. So they've made a combination of maybe an antibiotic with some other cough drug or something like that. So it's just a combination which the CDSO has banned. There is a lot of history to this, because in the past also the CDSO had banned certain drugs. Then the Supreme Court had come down very heavily on them and said that, all right, you want to ban the drugs, then you need to have a rationale as to why you will ban it. You have to study the drugs. You have to establish a committee. The committee will go through it. If the committee finds that this is an irrational combination, or finds that the combination is maybe not good.
I just want you to help us differentiate between what is a not for standard quality drug, because that could be even just labeling issues, and what is the penalty for, say, manufacturing a spurious drug?
This penalty for manufacturing a spurious drug is quite drastic under the Act. In fact, if you are caught having spurious drugs, then the Act provides for criminal action. In fact, your director can be behind the bars. So it's that very serious. Your factory can be seized, it can be locked. So there are very serious consequences of selling spurious drugs. So spurious drug is one which is not of a standard quality. It differs from the standard, either because it's expired or it has adulteration, something like that. That is spurious.
All right, we take that point. Let's go back to Mr. Reddy. Mr. Reddy, of the sales that you do, what are the overlaps between, say, something like not of standard quality, and how do you tackle that menace? I mean, one understands that spurious drugs can be taken care of by buying directly from the company or authorized dealers from the company, which someone like you with over 4,000 stores are able to do that. But of drugs which are of not standard quality, or say, as Ms. Hariharan was saying, that some of these combinations which may not be, approved, how do you tackle that? And what proportion, according to you, would be that in the overall market?
So again, the differentiation is between fake, which is outright fake. Some XYZ company makes a drug and basically sells it off as a Sun Pharma or a Dr. Reddy's or whatever brand out there. Very easy to do that because, today packaging industry has come a long way. It's very difficult to make out what the drug is inside that. And the fact that there are 10,000 odd manufacturing companies, I'm pretty sure a lot of them really don't have significant business. A lot of these guys will fall prey to this, will go and basically make it for someone, and it's very easy to actually get that done. So that is a different, quality class of drug altogether. That's the fake drug, right? We don't let that ever come into our system because we're buying directly from the company. One. On the not for standard quality, that's a different story altogether. It's almost impossible to tell. And I'm assuming that any of the top brands out there will always be of standard quality. I don't think there's any, problem at all. The top brands, they make these in the best qualities, best kind of settings possible. They have standard operating procedures out there. We ourselves have seen that a lot. We ourselves get our own drugs made in the same factories in which these guys get them made. I don't think there's any problem out there. But once in a while, there could be something out there, and those are easily recalled. And not of standard quality could mean, let us say the dissolution profile is not exactly right, or maybe the assay is not showing the exact amount of quantity of drug which is required. 95 to 105% is the amount of API required in a drug. So it could be slightly lesser. And so someone could, on a random check, pull it. But I haven't seen any instance in which a top brand has been basically pulled up for NSQ. Now, it is possible that someone has found the drug and said this, this top brand is actually not of the right quality, but that in my mind is probably because that company never even made the drug. Someone else made it and passed it off as this company's drug.
So just on that point, Mr. Reddy, I just wanted to understand that you all have a private label that you all sell drugs through as well. So now how do you ensure that there's no kind of contamination, no kind of spurious drugs coming through? Do you have a QR code which you implement on all of your drugs? Or is it, going against the ethos that you want to keep your costs low? So how exactly do you ensure this?
See, for us, when it is our own drug, it is the most tightly integrated supply chain, right? We are going directly to the company. We're making sure they're making it the right way. We are testing it. After they test it, we also test it. Then it goes into our system and it is sold only in our stores. So the MedPlus drug is not sold anywhere else at all. So if you are buying a MedPlus drug from the MedPlus store, there is absolutely no chance of it being a fake. And as far as quality is concerned, we are getting them made in the same factories in which all the top companies are getting them made. In fact, we actually 90% of our stuff is just made in around 4 factories, and these are 4 of the best contract drug manufacturing companies in the country, on par with anything else in the world. So we get all of these made, so we're very, very sure about the quality, and we're not selling elsewhere. No one else is selling MedPlus drugs, so you can be sure if you're buying a MedPlus drug, it is guaranteed to be genuine.
Okay. Just before we wrap this up, Rajeshwari, that ASSOCHAM report indicates 25 out of 100 drugs in India are spurious. Can you give us a sense, how do we curb this menace? Do you need to sort of strengthen your penalties when it comes to spurious drugs? Where does one need to sort of strengthen the supply chain?
So we have to, I think, tackle it on both fronts. One, of course, we need to have more stringent laws, and as soon as we find a counterfeit or a fake drug, obviously we need to take extremely stringent action. Second, with regard to the drug per se, so that the consumer is able to be, able to find out whether it is a fake or not, probably you need to have some more stringent, maybe on the packaging, you need to have some kind of, not holograms, but some kind of an OTP system, some kind of systems maybe, some kind of technology integrated systems. So the consumer will be able to know that, okay, the drug which I am purchasing, the liquid which I now have, the package or the product that I now have purchased is actually a genuine one. And you should be able to authenticate it in some way, either by way of, hologram which cannot be taken out, or some other technological intervention should be there so that we are able to, the consumer is able to find. Ultimately, it is the consumer, who is affected by this, and consumer is the one who is going to suffer. So that's the reason why at both ends to tackle it, and perhaps this should also become part and parcel of the law. And I believe the drug controllers and the pharma companies are working towards that, because pharma companies want the consumer to get genuine drugs. I don't think there's a single pharma company, good pharma company, who wants really, bad drugs to come to people.
Take that point. Thanks a lot, Ms. Hariharan and Mr. Reddy, for joining in and throwing light to this important topic. The key takeaway from here on is buy from, trustworthy chemists and buy from trustworthy companies as well, and perhaps look for marks on the packaging which may perhaps tell you about the genuinity or, not so genuine products that are coming in the market.
Yes, I think that would probably be the key issue, because the key issue here is that, spurious drugs are making their way into bigger brands as well. So how do you ensure that even if you go to a chemist which is reputed, and you need to basically probably solve the problem on the larger level of curbing spurious drugs.
All right, take a short break, come back, talk about the F&O space in the market, especially given the sort of sell-off, extended sell-off that we're seeing on the Nifty right now, currently testing that 25,900 mark.
So when we say melt up, I just want to sort of finish that point. It usually we are talking about like a frenzied move in the very short term, but that's not what you mean. You think
it makes a major long-term top, which is not a great thing. So it's great that we are going up on a wall of worries in a way, that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets don't climax at periods like that. And this seems to be more like the 90s bull market, where small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. And B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up, where the entire market goes up 10x in a decade. And then you don't see that prices for maybe next 10 or 20 years. So I'm hoping we don't get a melt up, and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4 level supply. The big guys haven't yet come. And in the bigger ones, if I take the top 10 companies, no one is supplied. Having said that, the owners of those companies, whether it's BAT selling down ITC or Singtel selling down Bharti, that's happened. But it's not like the Reliances or the Tatas or someone has come with massive issuances, which I think is around the corner. It should come.
I mean, bankers we speak to tell that over the next 12 to 18 months, about $25 billion worth of IPOs should happen. But that is, I'm not sure how much of the...
So, Prashant, 25 also, I'm saying, is a small number now. It's a $5 trillion market cap. So if you don't do 50 billion, is 1%. So issuance is, the government ought to be doing 25 billion. The larger groups easily can take 25 to 50 billion. And this is combination of primary and, of course, QIPs and so on. We've seen promoter selling, we've seen PE selling, we've seen MNC strategic selling, and it's gone from across the world, right? If GE of US has sold, Whirlpool has sold, BAT has sold, Sumitomo from Japan has sold, Singtel has sold, and now Hyundai is approaching the market. So all these chaps are getting it right. But we still haven't come and raised the money.
And that will happen according to you?
I think it's inevitable. I mean, that's what capitalism is, right? That demand for paper will create the supply.
And we're a long way off from that climax or whatever.
I hope I'm not proven wrong next week, but I think this has legs to go.
This has legs to go. PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But defense, etc., right? that part, it looks like we're starting to rotate. People are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done, or is just like a pause and refresh case here?
Again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate.
Right.
And then the excesses which happened in that period made them complete pariahs. So if 4 years ago, we were on a show and Ramesh and I remember we would talk about PSUs and everyone was like sniggering, like what's wrong with these chaps? But because the correction had been so steep that it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return and the what so-called poorest PSU may give you the best return. So it was a mean reversion.
Welcome back. You're watching us here on Halftime Report. Perfect time to get you the FNO update at midday itself, with the Nifty breaching that 25,900 mark, being at the low point of today's trading session. Let's look at all the key indices. Market at day's low with the Nifty Bank as well. The Midcap index, however, is marginal outperformer, but the advanced decline ratio would have you believe otherwise, with more stocks declining than the number of stocks which are advancing. Having said that, we do have a bunch of sectors which are doing extremely well. There are islands of green. So case in point, something like the metals space, you have 1.5% for Tata Steel, almost 3% for JSW Steel, a bunch of other stocks in the metal space doing extremely well this afternoon as well. But we do have, some of these other cash stocks which are buzzing around as well. So not all is lost for the market right now. Say Saregama is up 9%. We have Reliance Infra, which is up nearly 65% this month, and a bunch of other stocks which are seeing decent gains with a fair amount of volumes too. But for the frontline index itself, the fact that we've broken below that 26,000 mark has gotten a lot of these bears excited at the 26,000 level itself, where the call has seen a lot of writing. 26,100 looks like the next leg of congestion on the way up, though 25,900 put writers are equally active as well for about 100 rupees. The Nifty is at 25,900, so maybe 25,800, 25,750 could be the next leg of support. The fact that we've also rallied so much is visible in the 20-day exponential moving average for both the Nifty as well as the Nifty Bank. So we'll keep an eye out on these levels for the frontline indices, were they to break below today's support levels as well. The one stock I'm watching out for today is Hindustan Copper, may enter FNO ban on day 2 of October series itself. So keep an eye out on that. On that note, we'll take a short break, come back, get you more on the markets and a lot of stock-specific action on the other side.
And of course, all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change. But you went from terrible to being good.
Yeah.
So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically these are not high return areas. By definition, if you make 25% IRR in an infrastructure business, the cost to the consumer, which is the average public, is going to be too high.
Yeah.
So your money made is really on leverage, and therefore the return on equity comes in that business. So, and people are shy of doing leverage after again the last cycle.
Even
the flip of it, to just complete, the leadership of the last cycle was all the high quality businesses in the last decade. Which were all getting re-rated, Asian Paints, Page Industries, Kotak Bank,
consumers, retail.
even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected, that Kotak, HDFC haven't performed for the last 5 years. Again, great companies, but it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move? And there are memes on HDFC doing the round the way it was for ITC. And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
so things like that tend to happen. I can't forecast what will happen in...
But you're very bullish on the financialization theme.
I am very much.
The magic one that everybody is talking about at this point in time is AI and what AI can do, and specifically generative AI. How do you see that linking back to the efforts on the healthcare side, the innovations that you're working on? I mean, how transformative is AI likely to be, or are we on the cusp of seeing that kind of transformation?
Usually when you get new technology, it's applied in the rich world for those who are well off. And what we'd like to do this time with AI is make sure, both in terms of discovering new interventions for nutrition or vaccines or drugs, and helping give people health advice, in voice in their native.
Welcome back. Well, AstraZeneca has completed 45 years in India. Over the last 45 years, the company has brought in 50 new innovative medicines to India, and they aim to continue to bring in those kind of medicines as well as expand the indications of their existing drugs. I caught up with Dr. Sanjeev Panchal, who's the country president and MD of AstraZeneca India, to talk about their 45-year journey and the way forward. Listen in to this particular exclusive conversation.
We are really celebrating 45 years in India, and very, very proud to say that our mission of bringing innovative medicines to India and delivering life-changing medicines to our country and, of course, to the globe has been the key purpose of our organization. We've been continuously pushing the boundaries of science, and we have achieved significant feat over the last 45 years. It started in 1979 when we started operations in India. And over the time of 45 years, we have brought in 50 new medicines to India, innovative medicines to India. But also over time, we have changed from not only a manufacturing entity, but also from a commercial organization and also from a clinical trial perspective in last 45 years. So we have now two entities. Earlier, we were a listed company only, which is AstraZeneca Pharma India Limited. We now also have AstraZeneca India Private Limited, which is bringing the Global Innovation Center into our country and including technology, data, AI, but also rare disease, R&D, also GBS, Global Business Services Capability Center, into the organization. So very proud of two things. One is we all are driven by the purpose of bringing innovative medicines and life-changing medicines to our country. Over the 45 years, we have strengthened our footprint not only from commercial, but also to a global capability center, a technology center, and bringing RD, clinical trial, and also a GBS capability into India. So that has been a great footprint. As we look forward, we are looking to even bring innovative medicines faster to India so that Indian patients can benefit from it. And number two, we are quite passionate about sustainability, really taking care of people, the society, and the planet of our country. So that has been our journey, and very excited that what we can go ahead and do for our people in India and the society and the planet of our country.
Well, you also received permission recently from the CDSCO for sale and distribution of Imfinzi, which is basically an additional cancer indication for this particular drug, which is also already being sold for lung cancer at this point in time. Can you just tell us, the sales we understand is already around 200 crores for this particular drug. What would this bring to the table for AstraZeneca in terms of incremental sales?
Again, let me answer this question by the purpose. So, overall, our overall purpose for cancer is we're really leading the revolution of transforming cancer cares across the world. And what is happening is the science is changing so fast. You would see that today's cancer is not limited to stage 4 cancer. So we are looking at bringing early screening and diagnosis, and also bringing treatment as early part of lung cancer. So this additional indication is an effort towards a broader mission and vision to eliminate lung cancer as a cause of death. Now, this additional indication is for non-small cell lung cancer, who with this study which we got approval for was an AGN study. This gives an additional improvement and transform patient outcome for the patients. So it's already sitting in a form of a cancer, but this additional indication further broadens our therapy and outcomes for patient in a different form of cancer, which is non-small cell lung cancer for the patients.
AstraZeneca has done well. In the previous fiscal, you did revenue growth of around 29%. In the quarter gone by, your revenue growth was around 31%, but your margins were lower at around 10-odd%. So give us a larger scale guidance that we can work with. Will this double-digit growth continue? Will it be above 25% growth in terms of revenue? And where will margins and profitability stand?
Again, I'll give you a broader perspective. As I said, that our mission to bring innovative medicine faster to India is the important thing. And you could see that how We have launched new indications, new assets. We have entered into a new therapy area, which is rare disease. Overall put together is helping us as an outcome of the growth for our company. We won't be able to give exact numbers what it would be, but what we can clearly say that we said last year about 15 new medicines and indication we want to bring. We have already got approval of 9 out of them, out of 15, which we want to bring up till 2025. So I think as we progress and bring new medicines, you would see a continued strong growth for AstraZeneca. I won't be able to give you exact number, but you could continue to see a strong growth for AstraZeneca as we bring the new indication and new assets to the company.
You're planning to exit your manufacturing site in Bengaluru. What is the status behind that? And would that be the only non-core asset that you would look to probably exit?
As we're very clear that we want to be a specialist organization, a specialist disease area organization. So we are present in cancer, which is oncology, rare disease. We are in respiratory, we are in biopharmaceutical. Our overall strategy is to become a more specialist-led organization and improve access for our medications, both in bringing drugs and early assets. So the factory is also a global manufacturing strategic review which has happened. We have said that we were looking for a CMO, and that process is over. Now we are going to the next step as we go ahead. But our main objective is to ensure that we continue uninterrupted supply for our patients. But it's a larger two parts. One is the global strategic review, but at the same time, we also want India to be a more specialist disease area-led organization with the innovative medicines.
Just a quick last question, Mr. Panchal. You know, you all recently partnered with Mankind Pharma for asthma treatments in India. Can you share more about this partnership? How much is it probably generating in terms of sales, and what can we expect in future partnerships with Indian companies, which probably have a better distribution base than you all, and that's probably the reason for the tie-up?
So as we said again, that AstraZeneca India focus is to ensure we bring innovative medicine faster as possible. At the same time, we also want to improve access to our current medications, where we can improve by partnering. And Mankind was a very good example. We have budesonide formoterol as a molecule which is there, and the device was absolutely great, a simple device, and it can reach. We wanted to reach to more number of patients. So this is one example which we want to do. We focus to ensure that we bring innovative medicines. At the same time, we also want to ensure that we improve access for our medications. So it's an important strategy for us to do both things at the same time, bring innovative medicines where we are strong, at the same time we improve access for our medication. And Mankind was an exclusive distribution deal which allows our partners to improve the access for our innovative medicines.
That we actually bring these AI advances to those most in need. I mean, after all, where's the greatest shortage of doctors? It's in developing countries. And so the foundation is leading the way by giving grants to various people and pushing this forward. Even for a topic as complex as nutrition, the AIs are going to help us understand things faster than we would without it.
If you could do a startup all over again and focus on AI, what would the niche be that you would like to address?
Well, if you could go back to my school days even, and then I was saying, hey, how do we make software as smart as human beings? And I was constantly thinking about it. I underestimated how long it would take, but here we are on the cusp of that. And so now the lens I apply is the lens of the foundation. If I was somebody young, sure, I'd compete with, OpenAI and all these people. But, now I'm in the stage of saying, how do I help other people work in AI apply it to those most in need?
As far as India is concerned, the role and relevance and the significance of India, especially as far as the foundation is concerned, and what you're hoping to do on the innovation side.
So India's the country the foundation does the most in. Other than the US, that's our largest group. We have a great team there. We work a lot with the national government and many of the state governments. And not only do we see in areas like nutrition or using ultrasound to detect a difficult pregnancy, we're doing a lot of studies with our partners there, which will have a benefit for India. But also, because the digital infrastructure in India is so strong, we can try things out there and take them to other countries. The digital infrastructure itself is a great example where the leadership has laid that foundation, and now both India and Gates Foundation are going to Africa and other places and saying, hey, you should do the same thing.
Was there a specific learning from this trip to India for you?
Well, it was pretty amazing in Odisha to see how the digital approach was connecting with farmers, that they had categorized which farmers were in which location, what were they growing. And so when they would see crop disease outbreak, they could notify them. If they saw weather coming, they could notify those farmers. If the market prices were changing, they could help guide the farmers. And so the digital revolution, bringing that into that agricultural sector, that was the first time I saw that at work. And it's being scaled up in India. Now we'll take it to the rest of the world.
Welcome back, and joining us on the show now is Paul Bartholomew. He's Senior Analyst at Metals at S&P Global Platts. Paul, hi, thank you so much for joining us. And what a month of September we've seen when it comes to metal prices, ferrous and non-ferrous both, and especially with China throwing up so many stimulus measures. The sentiment clearly has been taken in. Much of the price is already factored in. Going forward from here, when do you start to see all of these stimulus measures actually start to support demand, actually start to show up in the economy and demand pick up?
Yeah, hi, Manisha. Well, I think obviously we saw the stimulus measures last week aimed at trying to shore up the property sector, which we think is still under a lot of pressure in China, and is very much hanging over steel prices, but not just steel, but aluminium and other prices related to copper. So I think we saw a bit of a reaction for some of the prices, particularly the ones that are very driven by futures. But then again, we saw I think the physical prices kind of really reacting back or going closer to fundamentals in the subsequent days. So I think there's still some very strong sort of structural challenges around sort of China property. So I think, we're not S&P, I think as a company is not really expecting huge stimulus measures like we saw during the financial crisis, for example. But I think that I think it's going to be very hard to kind of move the dial on some of these metal prices, particularly things like steel that I look closely at because of the property sector.
Paul, are you still expecting that China would come up with something more in sense of measures when it comes to property as a sector?
Possibly. I think, the people that we talk to in the market are expecting something else this year. I think that obviously that tomorrow's the China holiday, the Golden Week holiday, so they're all going off for a week. And I think some of the sort of chatter that we've been hearing in the market suggests that there could be more stimulus measure. But I think also there's a bit of a sense of quite a sort of sanguine kind of approach to what we're sort of seeing in the market, because it hasn't. Some of the measures that we've seen this year, some of the government meetings, the plenary meeting, etc., they didn't really kind of move the dial all that much on prices, at least not for very long. I think as I say, the market has got some very big fundamental challenges, and I think they quickly revert to those once some of the noise around the futures dissipates.
Paul, when I look at the previous week, and that is when we saw most of the China stimulus measures come in, almost everything is on the positive side. Copper is up 7% up, aluminum up 6%, zinc is up 8%, iron ore prices gained up by 11% in the previous week. The only thing that did not move so much was the steel prices. So going forward from here, if somebody had to buy, invest on the long side for metals, what would you recommend?
Yeah, well, I mean, because we're not sort of equity analysts as such, but I think, look, we look at sort of see nickel, aluminium, copper. I think we look at them, the prices are kind of, I think, determine a little bit what we're seeing in macroeconomic factors. Obviously, we've had that US rate cut now as well, and also fundamentals, what's going on supply and what's happening with the LME. For example, I mean, I think we're possibly seeing perhaps a bit more sort of upside sort of going into next year. But I think a lot of the sort of macro external factors have proven to be very, very kind of stubborn. Trying to shift that high inflation. We thought that would probably improve by now this year, but now probably looking into next year before we see a bit of an improvement. And I think, yes, we have seen some price sort of jumps, but I think, once the market comes back from that October Golden Week holiday, it would be quite interesting to see whether it comes back in a sort of bearish mode or whether, there's a bit of upside. I think, perhaps going in towards the end of the year and looking ahead to Chinese New Year next year, when we might get a bit of restocking, which should support coking coal, iron ore prices, for example.
Paul, as we get into the final quarter of this calendar year, what is it that you would be watching out for? Is it going to be China yet again for stimulus measures, or is it going to be Fed rate cuts, including other global central banks as well, the US presidential elections as well? Well, that comes in the month of November. So what is it that you are keeping in your eye on? What moves the needle?
Yeah, well, I mean, with the US presidential election, obviously there's a change, and there's talk a lot about tariffs around Chinese manufactured goods that could have a big impact on metals prices. I mean, China's already kind of struggling a little bit. I noticed that the manufacturing PMI data was down again today, the S&P one. Again, I think some of the external sort of challenges. It's harder to export Chinese manufactured goods. Obviously, it's been exporting a lot of steel around the world. So I think we're definitely looking at the US presidential election, and also to see whether some of those there are more rate cuts, whether that starts to flow through to business investment, consumer spending, to start trying to sort of pick up, I think, some of those manufacturing goods again. Because so far it hasn't really happened. It's really all been about supply rather than demand, particularly on the ferrous side. So I think, going into next year, we'd like to see kind of auto coming back a bit, manufacturing being supported, which could help support, some of these prices. But then again, I think the property sector in China, which is, very important, it does have some structural weakness. And I think that's, going to be trending down even more probably next year.
Paul, when it comes to steel, really, and as I said, that is the one that's really underperforming the overall sector right now. What is your sense on what demand, what kind of global production numbers, Asia demand for that matter? How are you calculating all of that?
Well, I think one of the things we're seeing a lot at the moment is these very high level of Chinese steel exports. We're expecting a return to 100 million metric tons this year, which is the first time really since 2015, which was probably the real nadir for the global steel sector. So, for example, you're seeing China exporting quite a lot into India, which is having a knock-on effect on Indian steelmakers, and also you're seeing India or countries like Vietnam exporting a lot into places like Europe. So I think it's all having a kind of knock-on domino impact really of these high finished steel exports from China. So I think that's putting a lot of downwards pressure globally. Allied with what I mentioned earlier, there's that lack of kind of recovery in some of those demand sectors as well. So I still think quite a bit of downwards pressure, I think, on steel prices, and until there's more of a meaningful production cuts in China. Not just China, Europe's producing a lot of steel as well, but especially China. I think it's going to put a lot of pressure on global prices, and that could put a bit of pressure on prices and companies going into next year.
Paul, also, as you mentioned, India, what's your sense on the Indian demand going forward? Within Asia, India really seems to be shining slightly brighter than what China seems to be doing. So with all that steel imports that we're looking at and various other metals as well, how do you look at India production itself and then Indian demand growth?
Yeah, well, I mean, looking sort of a bit further out, we've got, huge demand growth, steel capacity growth in India. It's the real kind of, I guess, in terms of new capacity and production, it's the real bright spot in the world. Southeast Asia to a lesser extent. But of course, I think, the most important thing is that the domestic economy, the Indian economy really is strong enough to absorb, all those new tons of steel coming into the market. I mean, at the moment, we've seen a bit of India's been quite slow to restock things like coking coal. I think after monsoon, we're still waiting for a bit of a sort of pickup there. But of course, if India's got a bit of Chinese steel coming into the market, it makes it a bit harder, I guess, to keep steel production at high levels. But certainly, we do see India. You look at the demographics. It's probably one of the few countries where the manufacturing sector has been performing pretty well. And I think, once you start seeing a bit more of that infrastructure and some of those other projects really starting to gain some traction, there's a lot of upside, of course, for India, which I don't think we can really say. I think China has pretty much kind of worked its way through the gears a bit at the moment, and I think it's more a case of just stability really, rather than the kind of growth that we've seen in years gone by in China. But yeah, certainly a lot of upside in India.
Fair point that, Paul. Thank you as always for joining us. So, well, in metals, when it comes to iron ore, copper, aluminum, all of them have been trading on the higher side. And as Paul tells us, that India is a shining star within Asian markets, where we have seen the demand growth continue quite on the stronger side. But with that, it's time for a short break. We come back with more.
News which just came out. A government-to-government deal between US and India to set up a semiconductor fab unit in the country.
Right.
There are elements of technology transfer, etc. That's the cutting edge. Semiconductor and sort of plans to localize production. Right. I just wanted your thoughts.
I think it's great. I would love to, India's quote a non-aligned nation, and I don't think we should be asking to align, but I think it's great that we're reaching out to each other, helping each other, investing in each other. And I would love to see far more of that. And this has two elements. One is the national security part, which of course all countries have interest in. And the second is just, a better economic relationship.
Over the last 2-3 years, we've seen the rise of the so-called industrial policy across the world. Yeah. National security is being prioritized, as you've said. Do you see this as part of that, in the context of that?
Yeah. So industrial policy, I'm a little cautious about. I think to combat some of these things and to do things in your country's own interest, which are hard to do economically, you're going to need some economic policy, industrial policy, like the United States has, for rare earths and things like that, and lithium. Every country is different. So the national security needs of India are going to be more around energy. I think for everybody, it's going to be semiconductor chips. So I do think that's industrial policy. I would caution industrial policy when it's used for regulations, bureaucracy, politics, votes, social, and it doesn't have the twin of permitting. It's not going to work. So you got to be a little cautious when you use it. But yeah, we're going to have some. And like I said, I think it's very important that America and India have a great economic relationship.
Would you agree, though, that in the former part of what you described, industrial policy is kind of taking the lead? Businesses and who you align with, who you want to do business with, building supply chains. A lot of that is now, it seemingly is led by that. I mean, what governments really want to do.
Well, no, it's two different. Governments have always negotiated economic arrangements, stuff like that. If you look at the United States, the industrial policy is a very teeny part of the economy. So it isn't like it's taking over the economy. Right. I think in other parts of the world, it's obviously a much bigger part of the economy. So, but yeah, nations, because of national security and because of what some people might consider unfair competition, there will be forms of industrial policy. If I was a government, I'd be very, very careful. It should be very targeted, very specific. It shouldn't be to protect local industry. It shouldn't be to just create jobs. It should be for a very specific reason. But you're going to see it, and hopefully it's well done.
Let's talk about the big event from last week, which is interest rates coming down. The Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, stock markets are at all-time highs, I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down, inflation is coming down, and relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality. Yeah.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
So my caution is all geopolitics, which may determine the state of the economy. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries get involved. You have a lot of war taking place.
Welcome back. You're watching us here on Halftime Report. The market is extending its cuts. The Nifty down almost 285 points below that 25,900 mark. The Sensex down 1,000 points. And the Nifty Bank down about 1.5% as well, closing in towards that 53,000 mark as well. More importantly, on the obverse side, we have the Chinese indices doing extremely well. Hang Seng is actually at the high point of trade after seeing a near 18% rally this month, including today's gains. And we have the Shanghai index as well, which is sitting with a gain of almost 8%. So we'll keep an eye out on all of these as they play out, even as our ticker team tells us that even as the frontline indices are lower, we do have a bunch of stocks which are buzzing around. There you have it. Hang Seng at the high point of trade with the Nifty at the low point of trade as well. On that note, we'll take your leave on this edition of Halftime Report. Come back, we'll have the management, or rather we have the team of Business Lunch taking all the market action ahead.
American warships being attacked almost every day in the Red Seas. That's my biggest caution. The economy fluctuates. I don't worry that much about the fluctuation of the economy, and obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy. But we are spending a lot of money, and in my view, that spending the money causes growth. It also causes inflation, and whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm put me on the cautious side of that one.
US has been trying to reduce its dependence on China. India has been and is expected to be a big beneficiary of it. Do you think we are sort of using that full potential right now, or there's a long distance to go?
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation look at it and say, we can't rely on someone who might one day be an adversary, that doesn't make them an adversary today, for supply. Just like JP Morgan's always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like if countries are aiding and abetting industries to dominate global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. The semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. a huge opportunity for India. People call it the China +1 strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got US elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that. I mean, in that sense, what's happening is in a way irreversible. The break in relations, sort of a Cold War.
I think you have to be very specific in this one.
Stocks here brought sell-off with declines far outstripping advances. Realty, auto and financials are the big losers, even as metals and consumer durables are eking out some gains.
PB Fintech top Ross tells CNBC-TV18 they will make one-time only investment of up to $100 million for a 20 to 35% stake in health venture to set new cost benchmarks, and most can't afford hospital rooms at rupees 78,000 per night.
Giving relief to Infosys on GST on the hefty 32,000 crore demand is a policy call for the government to take. DGGI's principal Anil Gupta tells CNBC-TV18 in an exclusive chat. He adds that further action by the DGGI in the matter is only expected after Infosys responds to the pre-show cause notice.
Chinese stocks soar after an inline manufacturing PMI print that shows stimulus-driven recovery hopes, with the lenders asked to cut mortgage rates by end of October. But Japanese stock dip after monetary policy hawk Shigeru Ishiba wins the race to become the next prime minister.
And the equity returns under NPS in the current year as high as 37%, while the equity returns since inception are 14.5% per annum. PFRDA chairman tells CNBC-TV18 on the occasion of NPS Divas on the 1st of October, the pension regulator is also launching a new product called Life Cycle Balance Fund. Good afternoon. You're watching Business Lunch here on CNBC-TV18. I'm Hormas Fatakia. With me is Vinny Motiwala on what is a very red-looking screen on top of our heads. It's not a very good start for the week for the benchmark indices. It's the last trading day of the month. It's the last trading day for the quarter as well, but it is the start of a very important week for our own markets. And the Nifty, as you can see, has slipped to the lowest point of the day now, below that mark of 25,900 as we speak. And leading the losses are the banking stocks. The Nifty Bank too is now trading with losses of well over 750 points as we speak. That too is down to the lowest point of the day, continuing to see profit booking after the fall that it had witnessed on Friday. So almost 1,300 points now shaved off on the Nifty Bank in the last two trading sessions. What is also leading the losses though are auto stocks led by Hero MotoCorp, the realty indices, and where the only index that is holding on to some bit of gains is the Nifty Metals Index. But the index that has recovered though is the PSU Index, and if you can pull up that intraday chart, and you can see that the PSU Index, the Nifty PSE Index, has recovered from the lows of the day, and that is another index that is holding on to the gains. Look at that recovery that it has seen, a 0.5% higher for the PSU Index. But Vinny, good afternoon. It does not look like a very good afternoon for most of the market.
Absolutely doesn't look like a very good afternoon for the most of the market. You mentioned a lot of names. Let's not forget, Reliance, that heavyweight, when such a fall comes in, obviously you see that pressure coming in as well. And a lot of individual names, especially two-wheeler names, they're not doing well. Let's look at something like a Hero Moto. That's down and out in trade. TVS Motors under pressure. Also, let's pull up Ola Electric and see what that is doing in trade. Seems like that was the one which was managing to hold on to some bit of a green there. So Ola Electric is what we're keeping an eye on, because that was the only one which was managing to hold on to some bit of a gain. But yeah, that also has fallen off from the day's highest point as well, trying to make a recovery, but as of now also down almost 3% in trade. A lot of pharma names that we're keeping an eye out on today as well. So yes, watch out for something like a Biocon, Jubilant Pharmova. Then we also have Piramal Pharma that is managing to hold on to some bit of a gain, and Angel One also managing to hold on to gains. We did have those changes in terms of transaction costs that will be adjusted by NSE and BSE, so keeping an eye out on Angel One as well. But one stock that we're keeping an eye out on specifically, last week also we spoke about it, is PB Fintech.
That's what we're focusing on. Now, today, we saw PB Fintech actually recover in trade as well. At one point of time, it went to the red, like you can see on your screens as well. But after that, also recovered. Intraday, it has gained as much as 3% as well. Now, focusing on that, PB Fintech management actually spoke to us, and they said that PB Fintech will have a minority investment in this new company, which is via the healthcare foray, which they're talking about. And that will happen, and they will be investing around $100 million, says the chairman and group CEO Yashish Daya, and adds that they are looking to bridge the trust gap between hospitals and insurance companies. Let's listen in.
PB Fintech is looking to make an investment subject to board approval in a separate venture, which actually is not a PB Fintech subsidiary. PB Fintech would probably be a minority investor between 20 to 35% equity holding, right? And this venture, for lack of a better word, let's just call it XYZ. XYZ has its own life beyond that, and PB Fintech's liability is limited to that first investment. It does not have any compulsion to keep investing into the future, right? And all this is subject to board approval. The model is essentially an HMO model. And this entity is obviously finalizing with its other investors and other partners. They could be healthcare companies, they could be insurance companies, they could be development finance institutions, they could be private equity players. You know, there's a whole bunch of people that it will speak to. This hospital is going to be aligned to the insurance industry. We are not really thinking about what it does to the other hospitals. I do believe it will, if successful, set benchmarks for the others.
Important clarifications coming in there from PB Fintech. The stock is up in today's session after a 5-day fall. But moving on to a CNBC-TV18 exclusive, earlier today, Anil Gupta, the Principal Director General at the Directorate General of GST Intelligence, spoke on the GST demand notice issued to Infosys. Listen to what he had to say.
So this demand is pending, and still because Infosys is to file a reply. Infosys is yet to file a reply for this remaining 4 years. Once they file the reply, only then we'll examine, because it's a pre-Shoka notice. In the GST law, for issuing a Shoka notice, you issue a pre-Shoka notice and then give an opportunity to the company or the taxpayer to file a reply. Once the Infosys files the reply, we'll examine, then accordingly decide on the matter. Whether our case is strong or not, that I will say we only book cases which are legally sustainable and as per the GST law prevalent at that time. So whatever DGI has done, it is as per law. There is nothing wrong in that.
Also, CNBC-TV18 also asked the DGGI on the probe into the 20,000 crore rupee tax evasion by the general insurance companies. Listen in.
So coming to the insurance services, recently notices were sent to as many as 20 general insurance companies operating in SEZ units for alleged evasion of about 20,000 crore rupees as unpaid dues for services furnished before the employees of industrial units within these zones and their families. Companies such as HDFC Ergo General Insurance, Star Health and Allied Insurance, Cholamandalam, MS General Insurance, etc. They were issued notices for IGST dues alleging misuse of provisions that exempt certain SEZ services under Section 16 of the IGST Act. What is your view on this? Is there an intent in the government to clarify this issue? Or again, as I said, are you going ahead with this demand to plug this leakage of 20,000 crore rupees, making these insurance companies pay back?
Yes, basically these are the supplies which insurance companies have made to the units located in SEZs, and normally a supply to SEZ is exempted, and that is what the insurance companies have taken the benefit. But however, when we found and went into details investigation of these insurance companies, we found these were not actually supplies to the SEZ units by the insurance company. It was in fact a supply for ensuring the life of the employees and their families, employees of the SEZ units and their family, which is not a supply per se to the SEZ unit, which is exempt. So this is clearly a taxable supply for which insurance companies are liable to pay, And let me place on record that some of them, insurance companies are already paying tax on GST on this kind of a supply. And we also found that some of the insurance companies, while paying in one case, were not paying in another case. So this is, as per the GST law, it is a clearly taxable supply, and for which we have, our Mumbai Zonal Unit has investigated cases and issued show-cause notice to various insurance companies.
Important comments coming in from the DGGI as well on some very important issues. Now, ahead of the NPS Divas, which is due to be celebrated tomorrow, speaking exclusively to CNBC-TV18, the PFRDA chairman stated that the equity returns under the NPS in the current year are as high as 37%, while equity returns since inception are 14.5% per annum. Listen in.
Equity return that since inception, annual returns are about 14.5% per annum. Of course, last year, even the current year running, the equity market has done pretty well, and the return that the pension NPS has given is about 37%.
Oh, really?
This year.
Then you have done better than many of the private sector pension funds. They have all given between 30 and 34.
And the interest rates are also coming down on the debt side. See, this year the GSEC portfolio in the NPS is also giving about 11.2% annual return. So they're pretty good return across debt and equity segment this year. And if you take, for example, the government scheme, which is a very conservative scheme, with equity about 15%, balance is debt. So that has, since inception for central government, has given an annual return of 9.6%.
Okay.
And of course, you look at the market and you can judge for yourself.
You can catch the entire conversation with the PFRDA chairman Deepak Mohanty today at 4:30 p.m. live on CNBC TV18. But on that note, we're going to slip into a very short break. Don't go anywhere. We'll be back with more news and updates after the short break.
National security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aid and abetting, China's kind of on the other side of America in that one, so that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about disconnecting.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com. CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand.
Welcome back. You're watching Business Lunch on CNBC-TV18. Let's move on. The market regulator, SEBI's board, will meet today in what is the first official meeting of the board since Hindenburg raised allegations against SEBI's chairperson, Madhvi Puri Butch. Shivani Bajaj is joining with us to tell us what's on the agenda today.
Yes, SEBI is holding its first board meeting today since the conflict of interest allegations surfaced against chairperson Madhvi Puri Butch by the Hindenburg research, which was followed by a series of scathing attacks by the opposition, and also the first time after close to 300 SEBI employees wrote to the finance ministry about an alleged toxic work culture at the organization. Although these acquisitions aren't formally the part of the agenda, sources suggest that the board is likely to take cognizance of the issues, especially the conflict of interest allegations against the SEBI chair. On the formal agenda, several key proposals are up for discussion today. SEBI may discuss easing regulations for rights issuances and allow promoters to transfer their rights and entitlement to select investors. Also, the new asset class could be introduced aimed at bridging the gap between mutual funds and portfolio management services with investment limits, as we know, between 10 lakh to 50 lakh rupees. SEBI is also likely to deliberate on the mutual fund light regulations today. Remember, a consultation paper was floated on this a few months back. This was aimed to encourage more passive funds participation in the industry. One of the things that was expected but is not likely to be taken up in today's meeting is the rules for future and option trading. The meeting is critical today because it is coming amid many controversies and a lot of interest there today. What we are also learning from sources is that there is no press conference expected today, only a press release by the regulator on the discussion and decisions made today. The press release is expected to be out later in the evening today. Back to you.
Okay, thank you so much for that update there. But yes, it's 30th September. Tomorrow's 1st October. What do we keep an eye out on? Auto sales numbers on the 1st of every month. Now, key data that we're watching out from the auto sales wholesale numbers this time in the month of September. Festive season, yes, that will be something that will be benefiting the auto sales numbers. Volumes, they're expected to be mixed. While two-wheelers are expected to do well, PVs are expected to be a bit subdued in terms of the demand trend. Let's not forget, we've seen good monsoon, so rural sentiment, that's turning positive. That could work out well, specifically for two-wheelers as well as in terms of the tractor segment. Monsoon, that was about the 6% above the normal mark as well. So interesting to watch out for there. In terms of commodities, and what Nomura is also highlighting certain points, they believe that, discounts may be something that could be higher, and even advertising spends that could continue to be higher. Now, today we had a note from UBS as well that highlighted similar points that yes, discounting is something that is higher even in two-wheeler vehicles. So yes, watching out for that. Specifically, commodity costs, that's largely flattish during this month, so not much of an impact in terms of margin pressures on OEMs that we're watching out for. Two-wheelers specifically, let's watch out for industry volume likely to be in double-digit growth. Rural sentiment is positive. Bajaj Auto is expected to see a 14% growth. Eicher's Royal Enfield is expected to see 4%. Hero Motor 9%, while TVS also expected to see 14% growth. Maruti, let's move on to the four-wheeler vehicles. Now, Maruti expected to see a muted growth. So all this range of passenger vehicles that you can see is in 1 to 9%. No one is actually managing to reach that double-digit mark. Ashok Leyland is the best among that right now that we're watching out for. That's not a pure play passenger vehicle name that comes in there. Lastly, tractors. M&M as well as Escorts are both expected to see a mid-single-digit to low single-digit growth. So keeping an eye out on that. Mixed set of numbers, Hormaz, that we're expecting this time from the auto sales.
Mixed numbers, but the screen is projecting a lot of red for the auto companies this afternoon. A bit of a speed bump that these stocks have hit this afternoon. But take a short break. Up next, we get you the latest from West Asia. More updates continue on the other side. Stay tuned.
foreseeing change, growth and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Valuations are one standard deviation above overall market, and in certain pockets it's crazy. Look at the SME part of the market. It's in a different frenzy altogether. 65 times the index is up over the last 5 years. So I think what I would suggest to most of your viewers and the investors in the market, this is the time to go back to basics of investing. Make sure that the quality of the company you are investing is not compromised, and make sure that the portfolio is resilient enough that whenever there is a drawdown, the portfolio stands tall. So these are the few things which is under your control, which you can do. On the themes, I think power demand and electricity could be a slightly medium to longer term theme, and energy transition. And look at some of the data points. After 15 years, US is starting to see increase in demand for electricity, led by data centers, EVs, and so on and so forth. You will be surprised to know that CY19 to CY22, out of the top 10 air conditioning.
Welcome back. Now, geopolitical conflicts continue to flare up in West Asia as Israel continues to move against its enemies across the region. CNBC's Dan Murphy brings us the latest from there.
In the last 24 hours, we've seen Israel continue to strike Lebanon and Yemen. The Israeli Defense Forces saying they've conducted strikes on Ras Issa and Hodeidah. You'll be familiar with them because Hodeidah is a major port city in Yemen. It serves as one of Yemen's primary entry points for about 70% of the country's imports. It's also a lifeline for humanitarian aid. The Israelis say they've been targeting these sites in order to take out infrastructure that they believe the Houthis are using to transfer weapons and supplies from Iran. So this is an emboldened Israel taking advantage of the momentum that it has seen off the back of that strike on Friday that took out the Hezbollah leader. Of course, in Lebanon right now, Israel has also claimed to have killed another Hezbollah figure after the killing of leader Hassan Nasrallah. Of course, he is the longtime leader of the group. What's been interesting as well is to track the reaction on the ground in Lebanon. Of course, He was seen as a terrorist to some, a resistance fighter to others. Interesting to see a number of countries around the region naming mourning periods off the back of this. And of course, in Israel as well, also celebrations on the ground. So it really depends on who you ask when it comes to assessing the overall reaction and next steps here. Of course, the primary focus right now, though, is what's happening in Iran as well. Iran, of course, backs Hezbollah. It's vowed to avenge his death and says his killing will not go unanswered. As for the international community, President Biden in the United States already ordering an enhanced defensive posture for US forces in the region now as well. And of course, the primary fear at the moment is that we could also see an Israeli ground operation in Lebanon. Many analysts asking now exactly how far is Israel willing to go and how will it take advantage of the momentum that it has seen off the back of this extraordinary weekend in the Middle East.
Thank you so much for that update there. But with that, we're absolutely out of time on this edition of Business Lunch. Goodbye from Omaz, myself, as well as the team who put this show together. Don't go anywhere. Midcap Radar up next.
Eight were out of Europe. Who would have thought that Europe will install ACs far more than any other country? And 8 cities out of the top 10 are from Europe because of global warming. So I think there are 4 important points: global warming, data center, which is AI, electric vehicles plus bitcoins and cryptos, and the constraint on transmission and ESG, which is leading to the entire energy transition and increase in demand for power. I think this could be played through various things: distribution, transmission, or generation, and the ancillaries to that. So I think it's a mega trend. Valuations could be something which is prohibitive right now, but keep a close watch on this trend over the next 5-10 years.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra, and with me today is Mangalam Malu. Mangalam, good afternoon. You're joining us on a day when markets have seen a pullback. A little bit of that, actually not a little bit, a lot of it. Nifty is below that 25,900 mark. Mid-caps, they're actually outperforming the markets generally, but of course it's still a fall. The Bank Nifty is the one which is putting a lot of pressure.
Absolutely. For the last two trading sessions, we've seen the Nifty Bank fall almost 1,500 points. And, the Nifty itself from the top has seen a correction of nearly 500 points. So what we'll do is we'll take note of all the top stories that we're tracking this afternoon and get cracking on the market moves and get you perhaps some corporate conversation as well. A broad-based sell-off is what we've seen in the stock market, with declines far outstripping advances. Realty and auto are the big losers, even as metals and consumer durables eke out some moderate gains. Mid-caps relatively outperform in the way that they do not fall as much as the frontline indices.
PB Fintech's top brass tells CNBC-TV18 they will make a one-time only investment of up to $100 million for a 20 to 35% stake in health venture to set new cost benchmarks, as most can't afford hospital rooms at 78,000 rupees per night.
Bagel Projects gains over 6% as it forays into data center segment by securing its first order for an upcoming private data center service provider company to construct and design a new substation in Navi Mumbai.
Avantel gains over 7% after receiving purchase order worth 45 crore rupees from L&T for domestic order for supply of SATCOM systems, order to be executed by March 2025. Okay, all right. Those are the top headlines that we are tracking for you for the markets. Continues to be a down day, of course. The Sensex is down 1.3%. We do have the Nifty, which is sitting with cuts of around 300 points. The Bank Nifty is the one which is putting a lot of pressure. So we have an 850-point cut on the Bank Nifty today. HDFC Bank, we have Kotak Mahindra Bank, all of them contributing to the losses that we are seeing right now. Markets are at the day's low. That continues to be the case. The only green that we are seeing on the screen is coming in from Nifty Metals, and that index, it's the 8-day running that we are seeing that index in the green because of whatever is happening in Chinese markets as well and the stimulus that has come by. But of course, that has come off from the highs as well. So lots happening in the broader markets, and looks like this was something which was expected after markets touching that record high levels.
Looks like this was something which was expected. What wasn't expected, however, is the broad-based sell-off that we're seeing. More so in the Nifty Bank, perhaps the risk of a double top out there. We have, Reliance, ICICI Bank, HDFC Bank, Axis Bank, all of them dragging the indices. Meanwhile, when we were talking about the headlines, there was some news at the bottom of your screen with regards to the Aurobindo Pharma stock as well, which is currently sitting at the cut of almost 3%. We had US FDA observations, close to around 10 observations coming in for one of their facilities, and we'll get to details of that in just a bit. Maybe those flashes come back for you on the screen. There was a sharp knock as those details of the US FDA issues for some of their plants did come by. 10 observations is what we've flashed. We'll get to the nature of those observations in just a bit, but given the sharp reaction on the stock price, it tells you that the nature perhaps may not be very benign. Keep an eye out on a couple of these two-wheelers as well. All of them declining as we speak. We have TVS Motors, Hero MotoCorp lower in today's trading session. There was a weak brokerage note coming by as well. And Bajaj Auto 2 currently sitting with a cut of almost 2.5% off its 52-week high. But let's talk about a lot of the other mid-cap movers and shakers. Hormaz joins in with a list of stocks that are moving around. Hormaz, there still are pockets, or rather islands, of green in the market.
There still are, but then predominantly the color of the screen is indeed red. And we'll start off with the losers within the broader market space, besides those that you guys just mentioned. And Bharti Hexacom is one of them, seeing some bit of profit booking after the surge that it has seen from its IPO price, 4% down there today as well. Some of the other high flyers in recent times, Kalpataru Projects, Indian Hotels also not having a good day, shaving off another 3.5% each in today's trading session. Real estate is the top sectoral loser in today's trading session, and that continues from where it left off on Friday, and almost all the real estate stocks are trading with losses today. Sobha is down to the lowest point of the day, as is Macrotech, was down 7% on Friday, down another 4% in today's session. But that one pocket of green that is still managing to hold on despite coming off the highs of the day is the metal names. NMDC, after the iron ore price recovery, is up 4%. Nalco, JSPL also doing fairly well for themselves. And stocks finally that are doing well on the back of very strong volumes in today's trading session, you would find Saregama, that has been on a tear in recent times. After a 2-day drop, the stock is back above 10% today. Whirlpool is having a very good day, as is AstraZeneca, now at the highest point of the day, 6% higher with very strong volumes. Back to you guys.
All right, take that point. Thank you so much for that. Saregama, Whirlpool, Kirloskar Brothers, and a bunch of other stocks, AstraZeneca as well, doing well. Important to point out, Aurobindo Pharma as well. Aurobindo Pharma currently sitting with a cut. We do have, we'll shortly get Ekta joining in on what exactly the observations for their API unit is, and this is for their API unit of the subsidiary Apitoria Pharma, and 10 observations for the API unit at Sangareddy in Telangana itself. What we'll do is take a short break, come back on the other side, get you, all the details on Aurobindo Pharma with Ekta, and also we'll have the management of Sri Renuka Sugars, Atul Chaturvedi, who's the executive chairman, joining in to discuss the possibility of a potential hike in ethanol prices.
This takes me back to a conversation that I remember having with Mr. Murthy about starting Infosys. And I said, like 7 of you, of course, he was the first among equals. But I said, how did you get a decision made? Because, and especially we are known as argumentative Indians for a particular reason. What was that like? And he told me, he said, look, it was very simple. We had a sort of unwritten rule that in God we trust, everybody else brings data to the table. What was it like for you?
So we started with a smaller group, as Pramath was saying, Sanjeev, Pramath, myself, only a couple of others. It was a small group. And I think we spent a lot of time. So even as a precursor, we used to meet one Saturday a month at my old office, and we would have conversations. And this happened for a couple of years. So I think that helps with alignment. And then ultimately we said, we want to build a liberal arts and sciences, an interdisciplinary university. So everybody was aligned. This was going to be
And some people did get off the ship.
Yeah, because some people wanted something else. So we were very clear that Indian higher ed had become too specialized, that we needed a new institution that really provided breadth and depth, that was interdisciplinary and holistic, and that gave students choice. So we agreed on the principles. We agreed on some of the disciplines we would cover and what we wouldn't cover. And we also said that we have to hire the best in the world to come, and the pedagogy has to be exciting. We'll primarily be undergraduate to start with.
Right.
And then over time, we'll build out a very strong PhD program. We won't have a very big master's program. So I think we spent a lot of time, so we were aligned on what the broader purpose is, the vision, broadly what the strategy is. And then we were able to bring in many other people. So we also had a governance model where we said, even if you put in a lot of money, you still have one vote. And you operate through...
How did that conversation go?
Well, I think a lot of it depends on, Sanjeev and I were initially the 2 largest contributors. And we'd said, we are going to do this. So it just became the norm. And we just went to everybody. When actually there was someone who wanted to put a lot of money in, wanted more than one vote, we turned that person down. So it's just a principle you stick to as you build it out. But we never realized when we started that we could end up becoming the largest, we think, collective philanthropy project in India.
Right.
We've raised about 3,500 crores, Shireen, in pure philanthropic money. We've had people like HDFC Group to Axis Bank to the Bajaj Group support Ashoka at scale. Individuals, R.K. Damani, Mr. Junjunwala, Rakesh Junjunwala, many others have contributed. 200 founders have contributed towards building this institution, because they believe it's an important project for the country, that India needs a new institution. That's a new form of education.
Investing.
Welcome back. Let's talk about Aurobindo Pharma. The US FDA has issued 10 observations for their API unit of a subsidiary called Apitoria Pharma. Ekta joins in with more details of that one. Ekta.
Well, yes, Aurobindo Pharma is in focus because the US FDA has issued 10 observations to the company's Unit 2 API manufacturing facility in Telangana. It was inspected from the 23rd of September to the 27th of September. The company has said that these observations are procedural at this point in time and will be addressed in stipulated period of time. Now remember that Aurobindo does come from a background of regulatory issues. Most recently, what we did here in August is that their arm Eugia Specialities Unit 3 was issued a warning letter by the US FDA, and also the Eugia Unit 2 was classified as an official action indicated status in the same month. So on the back of that, now in the month of September, we've seen that they've been issued 10 observations to their API plant. Though the company says they are procedural, we will need to see the details of the observations.
Okay, all right. Thank you so much, Ekta, for joining us with those important details. The stock that was down 3% has recovered from the lows as well. We'll put spotlight on the sugar sector. The government is mulling hike in ethanol prices. Do note, ethanol prices are not hiked since 2022-2023. Ethanol supplier and MSP has remained unchanged since Feb 2019 at 31 rupees per kg. To discuss this and a lot more, Atul Chaturvedi, the executive chairman at Sri Renuka Sugars, is joining us now. Mr. Chaturvedi, thank you so much for joining in. Earlier government lifted restrictions on ethanol production. Now the buzz is that there could be an increase in ethanol prices. What are the expectations with respect to price hikes here?
No, we are expecting the moon. In fact, last year in December, when the government banned the making of ethanol from cane juice and B-heavy molasses, it actually came as a bolt from the blue. And in fact, recently, about a month or so back, that the government came up with the notification that now the ban has been lifted. So we were expecting some kind of an action to happen as far as price revision and opening up of this cane juice ethanol is concerned. And in fact, the other day at the ISMA conference, I was also there. The minister actually said that they are seriously working on this, and we can hope to have some price revision coming before the start of the crushing season. We are expecting that. Yeah.
So how much are you expecting this revision to be, and what could the resultant impact on your revenue and margin be because of this revision?
No, I would say that we don't know what the revision would be, but the demand of the industry has been that there's no reason why ethanol made from maize be purchased at close to 72 rupees, and from cane juice, which has a pretty good ecosystem in place and which had been at the forefront of this ethanol campaign, why should it remain at 60 rupees for B-heavy and about 65 for? So what we are expecting is it should be closer to about 72 or closer to about where maize ethanol is. But we still don't know what the number would be. And in terms of the impact on our revenues, I will just share with you that last year was a disaster in terms of distillery capacity utilization. A normal utilization is in the region of about 20 crore liters, but last year was a disaster. It was about just about 4 crore liters or thereabouts. So I think this is news. This news, if and when it comes, is going to be manna from the heaven as far as we are concerned.
Okay, so 4 crore liters is what you did last year. Then what is the target for this year, Mr. Chaturvedi? How has the ramp up been in ethanol production? The earlier indication was 20 crore plus liter production this year. Is that on track?
No, I'm sure we should be in a position to utilize our capacity to the extent 100% or more. And if and when the government comes up with this revision in prices, which we are expecting should be there in the first week of October, because crushing season is going to start in the later part of October. So I think it should be coming now. And there's no reason why we should not be in a position to fully utilize our capacity, which is close to about 1,250 kiloliters. And when we are running on juice, it actually becomes something like 13 to 1,400 KL per day.
So, if we get that math right, say assume this, closer to 70 sort of revision comes by in October itself, your target for this year is 20 crore litres. Assuming you've done about 10 in the first half of this year already, you are left with around another 10 to do in the remainder of this year. So 10 into 12 would give you an additional revenue of 120 crores, 100 to 120 crores. Would that be a correct way to assess this?
I won't say that would be the correct way to assess it. In fact, the revenue would depend on how much of the ethanol is actually physically moved out, because that alone is going to impact our sales. But on a rough basis, our contribution from ethanol, we expect to be about 40% of our total revenue. And our revenue stream is from two sources. One is the port-based refineries, and the other is the crushing plant. What I'm giving you rough number is from the crushing plant. The export from refineries is a separate subject altogether. Yeah.
Okay, all right, Mr. Chaturvedi, we get that point. Thank you so much for joining in with your insights as always and telling us what to expect when it comes to ethanol price hike and a lot more with the company as well. We'll slip into a short break. Up next, we'll focus on Z Media. That stock has been up and away. This is our Midcap Spotlight segment. We'll tell you all about what's happening here. Stay tuned.
What is the Ashoka differentiator?
Where when we first dreamt of Ashoka, we had no idea that students from 40 countries would be applying to our university. Now our aspiration is, why shouldn't it be one of the best in the world?
We are the best option for anyone wanting to do high quality scholarly academic work in India.
You firmly believed in was that this must be an institute that's also inclusive.
We are perceived as being elite. I think that's largely because we do get very good students, and some of them from the very best schools. So I do think we're serving the country in one way, which is we're preventing the dollars from going outside. Individuals, R.K. Damani, Jhunjhunwala, Rakesh Jhunjhunwala, many others have contributed. 200 founders have contributed towards building this institution because they believe it's an important project for the country.
So we see Ashoka's mission to really be able to serve the country in solving these problems with the cadre of young people that we are feeding into the workplace.
If you want to maximize EBITDA, you'll be a teaching shop. You'll ignore, why would you run a PhD program? It's pure cost, no revenue. Right?
So how do you look at ROI then as far as Ashoka is concerned?
It's impact. We eventually will term out, and alumni, once they have matured, will take our place. We have no owner. There's no one family that backs this place.
The myth is that, if you study history or philosophy or political science or English literature, where will you get a job?
I'm a classic example of that. I studied philosophy and guess where I am. So
we have students who've turned down Berkeley, who've turned down Duke, Urbana-Champaign, London School of Economics to come to Ashoka.
The valuations are berserk over there. I mean, again, great companies, but and again, I usually don't talk about stocks, but just to put some sense, and again, don't get me wrong, I'm not disputing valuations or anything, but just to give the Infosys example, let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. Let's say it's a 30p by then because we're a fairly large company. So it needs a $4 billion PAT, profit after tax.
So when we say melt up, I just want to sort of finish that point. It usually we are talking about like a frenzied move in the very short term, but that's not what you mean. You think
no, I mean it makes a major long-term top, which is not a great thing. So I mean it's great that we are going up on a wall of worries in a way that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets don't climax at periods like that. And this seems to be more like the 90s bull market where, small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. And B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up where the entire market goes up 10x in a decade. And then you don't see that prices for, maybe next 10 or 20 years. So I'm hoping we don't get a melt up and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4 level supply. The big guys haven't yet come. And in the bigger ones, if I take the top 10 companies, no one is supplying.
But just pull up the intraday chart of Sri Renuka Sugars. The commentary of the management seems to have spurred the stock price, and currently it's recovered a goodish 3.5–4% from the lows at the high point of trade. For most part of today's trading session, Sri Renuka Sugars was absolutely flat, and then as the management did tell us about the possibility of an increase in ethanol prices, there has been an up move in the stock price as well. But another stock which has been buzzing around for a while, over 70% gains in the very recent past, is Zee Media. The stock locked at 10% upper circuit today as well. Mind you, just a 22–23 rupee stock. It's the one which has the spotlight on today on Midcap Radar. Vamakshi tells us why exactly the stock has rallied over 60% in the last 7 days. Vamakshi.
Well, absolutely, Mangalam. This stock has been surging over the last couple of trading sessions. Like you rightly pointed out, the stock is up over 73% in the last 6 sessions. And in fact, in the month of September itself, it's up almost 63%, which is, the best ever monthly gain that the stock has seen on record. And these gains are largely being supported by very strong volumes as well. The average daily traded value over the last 3 trading sessions is at 153 crores, while the free float of the company is at 1,015 odd crores. Now, on an average, therefore, nearly 15% of the free float market cap was traded daily over the last 3 sessions. The potential trigger could be the fundraise that the board approved. They've approved a fundraise of almost 200 crores via issue of 13 crores of warrants. The warrant holders additionally have 18 months to convert their warrants into equity shares. But that said, there are some important risks, the key risks that should be kept in mind. The company has been reporting a net loss every quarter since quarter ended September 22. Additionally, the overall debt profile for the company stood at 135 odd crores as at 31st of March 2024, which includes around 2.5 crores of long-term debt, and the remaining is short-term debt. On the other hand, the cash generated from operations for FY24 was at around 62 crores, which is much lower as what the company had generated in FY23. In July 2024 as well, Care Edge downgraded their rating on the counter. They also changed the outlook on the long-term rating to negative from stable, and they cited moderation in the operating and financial performances, as well as, more importantly, the continued uncertainty on the ability of the company to generate adequate cash flow from operations relative to the sizable debt repayment obligations in FY25. And finally, the promoter holding in the company is also very, very low at only 0.42%. As on June 30th, 2024. So definitely the stock has seen a very large surge in the trading session, but it is important to be mindful of all the risks surrounding this counter.
Absolutely. Thank you so much, Vamakshi, for putting all those risks on table for the investors to gauge upon as well. That's Z Media, but as Vamakshi said, there are a lot of risks associated with the company. So the stock up around 70% in last 7 trading sessions already. With that, we'll take your leave on this edition of Midcap Radar. Stay tuned, your stocks when we return.
That the owners of those companies, whether it's BAT selling down ITC or Singtel selling down Bharti, that's happened. But it's not like the Reliances or the Tatas or
They've
someone
tapped
has
for
come
the new businesses
with massive issuances, which I think is around the corner. It should come.
I mean, bankers we speak to tell that over the next 12 to 18 months, about $25 billion worth of IPOs should happen. But that is, I'm not sure how much of the...
So, Prashant, 25 also, I'm saying, is a small number now. It's a $5 trillion market cap. So if you don't do 50 billion, is 1%. So issuance is the government ought to be doing 25 billion. The larger groups easily can take 25 to 50 billion. And this is combination of primary and of course QIPs and so on. We've seen promoter selling, we've seen PE selling, we've seen MNC strategic selling, and it's gone from across the world, right? If GE of US has sold, Whirlpool has sold, BAT has sold, Sumitomo from Japan has sold, Singtel has sold, and now Hyundai is approaching the market. So all these chaps are getting it right. But we still haven't come and raised the money.
And that will happen according to you?
I think it's inevitable. I mean, that's what capitalism is, right? That demand for paper will create the supply.
And we're a long way off from that climax. Or
I hope I'm not proven wrong next week, but I think this has legs to go.
This has legs to go. PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But people, defense, etc., right? That part, it looks like we're starting to rotate, people are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done, or is just like a pause and refresh case here?
Again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate. And then the excesses which happened in that period made them complete pariahs. So if 4 years ago, we were on a show and Ramesh and I remember we would talk about PSUs and everyone was like sniggering, like what's wrong with these chaps? But because the correction had been so steep that it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return, and the what so-called poorest PSU may give you the best return. So it was a mean reversion trade which happened, and of course all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change, but you went from terrible to being good. So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically these are not high return areas. By definition, if you make 25% IRR in an infrastructure business, the cost to the consumer, which is the average public, is going to be too high. So your money made is really on leverage, and therefore the return on equity comes in that business. So, and people are shy of doing leverage after again the last cycle. And the flip of it, to just complete, the leadership of the last cycle was all the high quality businesses in the last decade, which were all getting re-rated. Asian Paints, Page Industries, Kotak Bank,
consumers, retail.
even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected, that Kotak, HDFC haven't performed for the last 5 years. Again, great companies, but it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move? And there are memes on HDFC doing the round the way it was for ITC. And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
so things like that tend to happen. I can't forecast what will happen in...
But you're very bullish on the financialization theme.
I am very much.
The magic one that everybody is talking about at this point in time is AI and what AI can do, and specifically generative AI. How do you see that linking back to the efforts on the healthcare side, the innovations that you're working on? I mean, how transformative is AI likely to be, or are we on the cusp of seeing that kind of transformation?
Usually when you get new technology, it's applied to in the rich world for those who are well off. And what we'd like to do this time with
A very good afternoon. Welcome to Your Stocks in the Mumbai News Studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a day where we are definitely under pressure at this point in time. So we have the Bank Nifty, which is the key culprit, down around 1.5%. But we have other frontline indices which are under pressure as well, frontline stocks rather. So, for example, we have Hero Moto, which is down around 4%. We have Axis, which is down around 2.7%. Bajaj Auto, along with Reliance, both those stocks are showing cuts of over 2%. So, overall, it's a weak market. Some profits being taken off the table. It was a mixed close for Asia. While China rallied, we had Japan, which was under pressure. So, maybe there is a little bit of fear and trepidation coming in on account of the volatility there. Hi, Vinny.
Hi, Ekta. Good afternoon. Not much of an exciting day across the board. Mid, small cap, nothing exciting today that we're seeing. And a bit of a Nifty at the day's lowest point. Individual stocks also not much of an excitement, especially look at the heavyweight Reliance. That's down and out in trade. Two-wheeler names like Hero Moto, TVS Motors, all of them under pressure as well today that we're seeing specifically in terms of a sector we're watching out for is going to be auto as well. Tomorrow we do have the auto sales numbers that will be in focus. PB Fintech is a separate stock that we should be keeping an eye out on today as well. We did have the management talk to us about the healthcare foray, the investment plan that they have over there in terms of $100 million investment will be what they will be looking to make. It's a one-time investment, so not much of a worry on that. PB Fintech today, after 4 or 5 days of consecutive fall, we're seeing PB Fintech managing to see some bit of a green there. But on that note, let's get started with all your stock-related queries. You can always email us your queries, and to solve those queries, we have two experts joining in with us today. We have Asta Jain from Hem Securities as well as Richard Jain from 5paisa.com joining in with us. Asta as well as Richard, good afternoon, and thank you so much as always for joining in with us. Let's start with the first query. We have Nikat, who's writing to us from Mumbai. She's holding 50 shares of BHEL at a price of 323 rupees per share, as well as 48 shares of Hinz at a price of 518 rupees per share. So yes, in terms of was Hinz, she's making a profit, but BHEL, there's a bit of a loss that she's making over there. She wants to know what is the future prospect of this investment in the long term. So, Asta, I'm going to come to you. What's your word for both these stocks?
Hi, good afternoon to all of you. Now, talking about, first of all, BHEL, I think the order book is quite strong. They have the order book of more than 350 billion, and they are L1 and various orders. So, we are expecting this to continue, the surge in the order book to continue. So the order book is the main focus in this companies, and on that basis we are positive on the counter. My idea here is to stay invested in the counter. Initial price target which can be set for the BHEL at present moment of time is around 320 to 330 odd levels. Now talking about Hindustan Zinc, here also we are positive on the counter, and if I talk about their targets of Hindustan Zinc, it is somewhere we are giving it to around 585 odd levels to be very precise. Now talking about the Hindustan Zinc as well as, first of all, the idea is to hold and looking after the surge in the metal across the world. We are seeing that definitely will help this company in showing strong performance along with the strong industry tailwind which this company is enjoying. We are expecting Hindustan Zinc to post strong side of numbers in the quarter coming also. So I think keeping all these points together, it creates definitely a recommendation should be hold for this counter, and it creates that case. So a hold is recommended for this counter with a price target of 585.
Okay, all right. But Ruchit, what about you? What's your recommendation on both these counters? Hindustan Zinc has done better than BHEL, but for both of them, what's your call?
Yeah, hi, very good afternoon to all of you. Well, BHEL I would recommend to hold, although it's a short-term correction because the momentum readings were quite overbought when the stock rallied towards that 330, 320 kind of range. But the long-term trend is still not negative. So I think there could be some time-wise correction in the stock before resuming its uptrend. But yes, if the view is for more than 6 months, I think the stock has potential to rally again towards 327, which would be the next technical resistance. So hold on at current levels. When the stock comes around at 327, 330, one can take a review again at those levels. Hinz also has corrected since last few weeks. So primarily now if you see last 3 or 4 trading sessions when the metal stocks have seen a good rally, this is one stock which has not yet participated. Now the stock should give a breakout above 550 kind of levels for any trended phase. Otherwise 550 to 470. I think this is the range where some consolidation could be expected. So because the sectoral move is positive, I would advise currently to hold on. but also to keep a strict stop loss below 470, because if 470 gets breached, then I think that underperformance is likely to continue.
Okay, all right. So that's on Hindustan Zinc and BHEL. We now have Munira Julu, who writes from Chittoor. He wants to invest in Piramal Pharma and EPAC Durables and wants to know the entry levels for the longer term. So two stocks looking at investing. It's more of an investment question. So Astha, I'm going to toss it over to you. For both these counters, what would you recommend? Because EPAC has seen a strong run-up, but Piramal Pharma as well has seen a good run-up, and it's quite bullish on the future prospects as well.
Yes, so talking about first of all Piramal Pharma, since we know that this company operates in the three segment with CDMO being the major one, and in fact complex hospital generics and consumer healthcare are the other two segments in which the company is operating. Now we are positive on this counter. The main core behind this, strength in the company is that what we believe that company's management has given a very strong guidance, especially for FY30. They have guided for a very strong growth, and in fact they are guiding for doubling the revenue. So it makes a strong case to remain invested or to make a new investment in the counter. Along with that, the strong EBITDA margin of around 25%, which the management has guided for the future. I think that is also keeping us very much positive on this counter. So we are positive on this counter, and we are recommending buy also, as well as a hold strategy can also be implied if anyone has this counter in their portfolio. Price target which we would like to give to this counter at the initial level is 255 to 260. Now talking about EPAC Durable, here also we are positive and we are recommending buy, but we are mentioning here that buy on dips is a better strategy for EPAC Durable. Talking about this counter, it is like 80% of their revenue is coming from RAC, residential air conditioner segment. Now the company is looking to diversify their product portfolio, and I think in the coming 2 to 3 years down the line, this RAC segment will constitute 65% of the total revenue, which is presently standing at around 75% to 80%. Since the other part is a high margin generative part, so we believe that this counter will also giving strong numbers going ahead, and that's why we are positive on this space as well. Recommending a hold and buy on dip strategy can be applied. Price target can be set at around 450 odd levels to this counter.
Okay, so Astha, you are positive on both of them. But Ruchit, what are the technicals looking like for both these stocks, right? Like Ekta was also highlighting before, because both of them have seen a run-up. Whether you look at 6 months or 1 year, we're seeing a good uptick in these stocks. So technically also, would you have a positive view on this?
Yeah, so there's no doubt about the trend for the stock. For both the stock, the trend is positive because the price move that we have seen recently have also been supported by very good volumes. So usually such outperformance can last for a longer period of time. So I would suggest buy and dips for both the stocks. Piramal Pharma has good support base around 200 to 210 range. So in case if we see any dip towards that 200, 210, one can use that as a buying opportunity. And even EPAC have seen a good price up move recently. So good thing is about the volumes which I spoke. When the volumes are high, generally that outperformance continues. So 340 is the support, 340 to 350 range. And if I look at the charts considering the previous breakout levels, so any dips towards that support range of 350, 340 should be used as a buying opportunity.
Okay, all right. Well, we have another query now. We have Suresh, who writes to us from New Delhi. He holds 30 shares of Maharashtra Seamless, which he's bought at 630. He's a long-term investor and wants to know the target for this particular counter. So he's sitting on a just about broken even on this particular counter. Do you think that there's upside in terms of the technicals, Ruchit?
So I think there could be some short-term consolidation in the stock, but the stock has also seen a correction since the start of this year. In the month of January, it was trading around 1100, from where the stock has corrected towards this 640, 650 kind of levels. Now, I think the price-wise corrective phase may be behind, because this entire correction has seen 61% retracement of the previous uptrend. So there could be some time-wise correction in the short term, where the stock would consolidate within the range of 730 to 560, 550. So I think it seems that could be some consolidation. Need a breakout above 730, then you can expect levels around 800 where an exit strategy should be placed. So for now, I would recommend to currently hold on, but not from a very short-term perspective. In the near term, I think the stock should see some sideways movement only.
Okay, so hold on to it. But Astha, what's your view on the fundamentals as well? Q1 was not much of an excitement that came in for Maharashtra Seamless. But now on the fundamentals, are you also going to be just waiting out and watching out for the earnings and everything to pan out?
Positive in the fundamental is the valuation, because now the stock is trading at a price to earning multiple of around 9.7 or 10. So I think looking after that, it might be looking a strong candidate for the investment. But I would really like to see the results, because in the quarter gone by, as you have rightly mentioned, there was a degrowth of around 60% in the bottom line year-on-year basis as compared to last quarter one of FY24. So I think that is the major concern for the company. Otherwise, valuations are fine. The company's balance sheet is in the healthy position. They have not so much of high debt. In fact, I should say the debt is almost at the zero level. So balance sheet is at the good condition. But looking after the growth in their financials, we really want to give any view. Right now, it's a hold, but no new entry is recommended by our side for this counter.
Okay, sure. No new entry is what we're watching out for right now at this level for Maharashtra Seamless, both Ruchit as well as Asta saying that. Let's move on to the next query. We have Sagar, who's writing to us from Bangalore, and he wants to know, he's holding 2,500 shares of NLC India at a price of 266 rupees per share. So yes, making some bit of a profit there. Needs advice in terms of overall investments for the long term. So Asta, I'm going to come back to you. How is it looking like for NLC?
So Niveli Lignite is looking okay to us. We are positive in this counter, but from the long-term perspective, in the short term, we are expecting some sort of a dips, because we really need to see the margin profile of this company and the coming quarter results. So on that basis, I'm just recommending a hold, not recommending a new entry or a new buying in the stock. So we are recommending a hold on this counter. Initial price target can be set at around 310 rupees.
Okay, all right. It's given 18% returns, say, in the past quarter odd. Ruchit, what's your recommendation on NLC? Any target price, stop loss?
So the stock has formed a good support base around 255. Whenever we see corrections in the stock, the 89 days EMA technically acts as a good support. And in fact, if you look at last 1 month, it has tested that level twice or thrice but has not broken. So I mean, 250 should be a reasonable stop loss for this counter. So I would recommend to hold on, since the broader trend is not negative and consolidating in the range, but above its support. So hold on to the stock with stop loss below 250.
Okay, sure. On that note, let's just take a quick break, but we will be answering more of your stock-related queries on the other side, so stay tuned in.
Is make sure, both in terms of discovering new interventions for nutrition or vaccines or drugs, and helping give people health advice, in voice in their native language, that we actually bring these AI advances to those most in need. I mean, after all, where's the greatest shortage of doctors? It's in developing countries. And so the foundation is leading the way by giving grants to various people and pushing this forward. Even for a topic as complex as nutrition, the AIs are going to help us understand things faster than we would without it.
If you could do a startup all over again and focus on AI, what would the niche be that you would like to address?
Well, if you could go back to my school days even, and then I was saying, hey, how do we make software as smart as human beings? And I was constantly thinking about it. I underestimated how long it would take, but here we are on the cusp of that. And so now the lens I apply is the lens of the foundation. If I was somebody young, sure, I'd compete with, OpenAI and all these people. But, now I'm in the stage of saying, how do I help other people working in AI apply it to those most in need?
As far as India is concerned, the role and relevance and the significance of India, especially as far as the foundation is concerned, and what you're hoping to do on the innovation side.
So India's the country the foundation does the most in. Other than the US, that's our largest group. We have a great team there. We work a lot with the national government and many of the state governments. And not only do we see in areas like nutrition or using ultrasound to detect a difficult pregnancy. We're doing a lot of studies with our partners there, which will have a benefit for India. But also, because the digital infrastructure in India is so strong, we can try things out there and take them to other countries. The digital infrastructure itself is a great example where the leadership has laid that foundation, and now both India and Gates Foundation are going to Africa and other places and saying, hey, you should do the same thing.
Was there a specific learning from this trip to India for you?
Well, it was pretty amazing in Odisha to see how the digital approach was connecting with farmers, that they had categorized which
Welcome back. You're watching Your Stocks on CNBC-TV18. We're still continuing with all your stock-related queries, and we do have our experts with us, Asta Jain as well as Richard Jain. Let's move on and talk about the next query. This one is on Tata Tech. Now, Srinivas is writing to us from Karnataka. He holds 38 shares of Tata Tech at a price of 1,038 rupees per share, so making some bit of a profit there. Wants to know whether he should continue to hold or maybe look to sell this. Richard, what's your word on Tata Tech?
So I have limited data post listing, no recent price action indicates that the stock has a good support around 1,050, 1,040 range near the buy price. So I think at current levels should take a chance because the stock has already corrected post listing, and it's trading above its short to medium term support. So hold on, but keep a stop loss below your cost price. I think 1,030 should be a good stop loss to hold on to this name.
Okay, well, Tata Tech not given that much return on the technicals, but what about the fundamentals, Asta?
So as we all know, the company has a strong strength in ICE to EV conversion. In fact, they have a strong strength in the plant engineering, robotics, AI implementation, etc. In fact, they have seen a strong addition of the clients in the last few months also. So I think looking after all these, it's a hold from our side. 1175 is what we are recommending as a short-term target for this counter, because we really need to see the results pan out to be for the Q2 of FY25. So before that, I think one can remain invested in the counter and again can review their query. But as of now, a hold with a price target of 1175.
Okay, all right. Now we do have Ajit, who writes to us from Pune, holds 50 shares of Bandhan Bank, which is allotted during the IPO in March of 2018 and the price band of around 375 odd. Wants to know what to do, whether to hold or sell. So currently sitting on a loss in terms of this particular investment. What would your recommendation be, Asta? Would you recommend staying on and waiting for any kind of recovery, or maybe booking losses?
So we recommend staying on this counter because the quarter gone by was a good quarter. The company has shown a decent performance, maybe due to the lower provisions the company has made. But one important point is that, in fact, the product mix has changed and it is more tilted towards the secured loan. In fact, the asset quality has shown the improvement. So I think Q2 of FY25 will going to be a decent quarter for this bank, which we believe it is to be. And hence, we are recommending a hold. 230 can be set as a price target for this counter.
Okay, 230 is the target price that you're keeping an eye on with a hold. But Richard, what's your word coming in for Bandhan Bank? How are you looking at it on the technicals? Should one continue to hold? Maybe I look to add some more.
So I think the stock has seen a long underperformance compared to other private sector banks, but off late, post that last quarterly results which are announced, we have seen a good price volume action where the price up moves have been supported by good volumes, where on corrections now we are not seeing any volume-based sell-off. So I think these are usually signs that the stock should bottom out somewhere in this range of 180 to 190 from a bit 180 to 190 from a midterm perspective. So price-wise correction seems limited from here on now. So you can keep a view of maybe two or three quarters more, then can expect an up move from current price levels. So my recommendation would also be to hold on to this name.
Okay, hold on to Bandhan Bank. That's a word coming in from both our experts. Let's move on, and Dheeraj is writing it to us from Delhi. He's holding 100 shares of Bharat Dynamics at a price of 1,120 rupees per share, making a bit of a profit. I don't think anyone is making a loss in Bharat Dynamics or any of those defense names in the recent time, but wants to know whether you should continue to hold this or look to sell. Richard, coming to you first on the technicals, Bharat Dynamics after the run-up, should one continue to hold this?
Yes, I would recommend to hold because in last few days the correction has been there, but the stock is now in oversold territory. So one can expect at least a pullback move from a short-term perspective towards 1170, 1190 kind of range. So hold on for now towards for a target potential around 1190 in the near term. And once that level comes, then can take a review again there.
Okay, and Astha, what about you? Bharat Dynamics?
Yes, we are also recommending hold because we know that it is one of the leading PSUs in the defense space, and the results were not that encouraging in the quarter gone by. But believe that going ahead, because we have seen some certain sort of negative bottom line in the Q1 of FY25 if I extract all the other income and exceptional items. So that is a concern for us at this present moment of a time. But looking after the strong industry tailwinds, we are recommending hold as of now, although our price target is 1180 at the current levels.
Okay, all right. We now have Indira, who writes to us from Mumbai, who has 450 shares of RVNL, which is bought at 259. She wants to know whether she can hold or exit this particular counter. Again, it's one of those, sitting on a very strong profit when it comes to RVNL. What would you recommend in this case, Ruchit? Do you think that one should probably take some profits off the table, or maybe even add on to these levels?
Well, I would recommend taking partial profit off the table, not full. The overall trend seems to be very strong, but post the recent run-up, the monthly readings are in overbought zone. So such overbought setups get cooled off either with some consolidation or a time-wise correction or some price-wise retracement of the previous up move. So I think it's better to take some profits off the table and leave rest of the positions to see the next extended phase once this consolidation is over.
Okay, all right. Well, on that note, maybe we can just get a quick recommendation in from Astha also on RVNL.
Yes, in fact, the company's focus is on high-speed rail projects, but the results were not coming in that manner. So we are not very much positive from the result front of view, and hence even I'm recommending to book partial profit at the current junction.
Okay, book partial profits for RVNL. Already seen such a good run up, right? So no harm in that. But with that, we'll wind down this edition of Your Stocks. Thank you so much, Astha, as well as Ruchit, for joining in with us. And viewers, remember, you can always email us your queries and we'll address all of them with our experts. Just quickly marking the Nifty as well as the Sensex almost near the day's lowest point is what both these are trading at. But don't go anywhere. Closing bell will take the action forward through the last hour of trade.
Location, what were they growing? And so when they would see crop disease outbreak, they could notify them. If they saw weather coming, they could notify those farmers. If the market prices were changing, they could help guide the farmers. And so the digital revolution, bringing that into that agricultural sector, that was the first time I saw that at work. And it's being scaled up in India. Now we'll take it to the rest of the world.
News which just came out, a government-to-government deal between US and India to set up a semiconductor fab unit in the country. Right. There are elements of technology transfer, etc. That's the cutting edge semiconductor and sort of plans to localize production. Right. I just wanted your thoughts.
I think it's great. I would love to, India's quote a non-aligned nation, and I don't think we should be asking to align, but I think it's great that we're reaching out to each other, helping each other, investing in each other. And I would love to see far more of that. And this has two elements. One is the national security part, which of course all countries have interest in. And the second is just, a better economic relationship.
Over the last 2-3 years, we've seen the rise of the so-called industrial policy across the world. Yeah. National security is being prioritized, as you said. Do you see this as part of that in the context of that? Yeah.
So industrial policy, I'm a little cautious about. I think to combat some of these things and to do things in your country's own interest, which are hard to do economically, you're going to need some economic policy, industrial policy, like the United States has, for rare earths and things like that, and lithium. Every country is different, so the national security needs of India are going to be more around energy. I think for everybody, it's going to be semiconductor chips. So I do think that's industrial policy. I would caution industrial policy when it's used for regulations, bureaucracy, politics, votes, social, and it doesn't have, the twin of permitting. It's not going to work. So you got to be a little cautious when you use it. But yeah, we're going to have some. And like I said, I think it's very important that America and India have a great economic relationship.
Would you agree, though, that in the former part of what you described, industrial policy is kind of taking the lead? Businesses and who you align with, who you want to do business with, building supply chains. A lot of that is now, it seemingly is led by that. I mean, what governments really want to do.
Well, no, it's two different. Governments have always negotiated economic arrangements, stuff like that. If you look at the United States, the industrial policy is a very teeny part of the economy. So it isn't like it's taking over the economy. Right. I think in other parts of the world, it's obviously a much bigger part of the economy. So, but yeah, nations, because of national security and because of what some people might consider unfair competition, there will be forms of industrial policy. If I was a government, I'd be very, very careful. It should be very targeted, very specific. It shouldn't be to protect local industry. It shouldn't be to just create jobs. It should be for a very specific reason. But you're going to see it, and hopefully it's well done.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down. Inflation is coming down. And relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue.
The Taiwanese index is down 0.75%.
The supports here below the 40 hourly come in at 53,500.
You're seeing that the stars are aligning for this one.
PB Fintech would probably be a minority investor.
Very important signals that I think markets have been waiting for.
85,300 on the Sensex.
The month of September is headed on a stronger note.
CBA was investigating this case since 2020.
Things are getting a bit painful for our markets now.
We are now on a long-term bull market for India. The real truth is cash, everything else is a crash.
The CDSCO declared over 50 drugs as not of standard quality.
Nifty is below that 25,900 mark.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, that is the day so far, and it has essentially been a down and out day. This is Closing Bell, last hour coming up. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Rima here. And good to have Rima back after a bout of illness. So good to see you back on the show. And of course, Nigel is joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon. And I think Nigel is the bright spark in an otherwise gloomy sea of red, right? Because we're not used to days like this. Near 400-point drop on the Nifty now.
I mean, yeah, absolutely. I have to first, sea of red and bright spot also. I agree with both points. I mean, it's down, isn't it? I mean, about 1.5% lower on the Nifty right now. There's 1.5%, and market breadth is weak, and it's actually market breadth is not that weak. So it's like actually large cap kind of weakness. Broader markets are not doing all that well either. But a lot of the weakness is in the slightly larger names here. So pockets, if you want to look at real estate, auto, private banks seem to be the most under pressure. We've also, by the way, slipped under 26,000. So 26,000 came last week, and then 26,200 came last week. So there was a bit of a big move that we had, and today there's that pullback which seems to be happening. Where do supports come in? The 20-day on the Nifty, I think that's the major support. Hourly averages, etc., have all sort of disappeared. So the 20-day, now you got to look at that one, which is 25,500. This is, as of yesterday's close, slightly different as if you look at it now. That is one. And the Nifty Bank 20-day moving average comes in at about 52,480. So these are the two broad numbers on the Nifty and the Bank Nifty, which perhaps should act as a support level. And of course, unless and until you've been hiding under a rock, the big story over the last 6-7 days has been China. And the Chinese markets continue to rally 10% on mainland indices, that is Shenzhen, Shanghai Composite, and the Shanghai property market. Because remember, we've been detailing what's happened over the last last Wednesday, Thursday, Friday in terms of measures. Over the weekend as well, there were measures, and specifically with regards to some large cities in China relaxing property restrictions, which we discussed in the morning. And I just found this anecdote interesting. The property index there, the Shanghai property index, has hit a 52-week high today, but it also hit a 52-week low just 2 weeks ago. That is essentially how fast this rebound, fast and furious this move in China has been. So a lot's happening globally as well, with I think Japan down 4-5%. But here there is some pressure coming through. Rima.
And at the day's low now, it's 25,800 on the Nifty. At no point through the day have we seen any kind of a recovery pull back. It's been a one-way sliding lower kind of a market and a day. A couple of factors at play. One, even rising Middle East tensions. They've been on the boil over the weekend. So that is another factor at play. Secondly, perhaps money is moving out of China, moving into China and Hang Seng away from India. Look at the way this month, the Chinese markets are up 15-20%, while India is only up 2.5%. So maybe the rotation's taking place. China, remember, was under-owned. There was a high shot, there were lots of shots in the market there. So the positioning was negative. And in the last few days, we've seen that flurry of money going into China. And then maybe there is some nervousness ahead of big events this week. It's just the start of the week. We've got the Jerome Powell speech towards the end of the week. We'll cap it up with, the non-farm payroll data. So the labor market will be active and expectations will be watched closely.
Absolutely. I'll be quite keenly watching the institutional flows today and to see what the FI number is going to be like, because we had a sell number even on Friday. But this is big. This is sort of a big, clear, large cap selling, and it's across the board. It's not as if any sector is really providing any sort of a meaningful counter. Bank Nifty is down 1.5%. And look at the other side, the red side of the screen. There is a Hero Moto. There is a lot of auto, actually. M&M, Bajaj Auto, all those names, banks we've discussed. IT has failed to provide any sort of comfort or any sort of cushioning. There was an attempt in the morning, but none of that has worked. If you look at stocks like TCS, Infosys, no meaningful sort of upside. In fact, the IT index also at the lowest level of the day. The only thing that's seeing buying in the large cap space is metals. That continues to be a global story. And a little bit of pharma and FMCG, so-called safe havens. Other than that, it's an all-out down day on the large cap screen. And the big question is whether FPIs, who are anyway neutral to slightly underweight on India, but if they're holding positions in India and sitting on fantastic gains, would they want to book some profits and shift that money elsewhere, at least a tactical trade, get into China? So let's see how the FPI numbers shape up in the coming few days. But large caps selling. What about mid caps, Nigel? What's on your radar?
Well, I'll tell you what, for a market that's down 1.5% or effectively 375 points odd, if you said that the breadth of the market is 2:3 in favor of the declines, you'll say it's not too bad, right? If you're seeing the headline index fall to this manner, even the Nifty Bank is down 1.5% or thereabouts. So I don't think the breadth of the market is that bad. And there are select stocks that have seen a good recovery from the low point of the day. Let me just pull a couple of them up. Maharaja, I recall the stock was down 2% earlier today. That's seen a 4% recovery from the low point of the day. Let's just pull up the intraday chart out there. Coforge is the other one that's seen a good bounce from the low point. And Dalmia Bharat, we had made this point on Bazaar a few days ago, that it was showing signs that, in fact, it would want to take support at crucial technical levels and bounce back up. So Dalmia Bharat as well, these are pockets of strength in otherwise a weak headline market. But the one that I'll track very, very closely is HDFC Bank. It's holding at around 1,730, beg your pardon. But the 20 DMA is at around 1,690. So HDFC Bank is the one that the bulls could turn to. Let's see how this one shapes up. It's been a bit of an outperformer in the last 2-3 weeks or so. And I think the 1,690 odd mark, that's crucial from a bullish perspective for the stock and for both the key indices as well. So keep an eye out on that one. Well, let's get in Mitesh Thakkar onto the show. Hi, Mitesh. Good afternoon. Well, it's been a bit of a down day today. But what's your take? You were talking about the 25,800 level. We're there right now. Would you initiate a long position, or would you want to wait by and then get in at a lower level?
Good afternoon. So on the index, I don't think so. I still am watching and hoping that this level holds because this is an important level for me. But on select metal names, I think, and sugar names is where I'm looking for long positions purely because of the fact that both metals and sugar in the last 3-4 days have come into an outperformance mode. So I think they will fall less, and in case the market rebounds, they'll move faster on the upside. So that's where I think, some fishing can be done. I have one buy and one sell call right now. SBI Life is, turning slightly negative. So a sell here with a stop just above levels of 1870, 1871, or look at a target of around 1800 or below that. And on the metals name, Vedanta is something which I would be comfortable taking a long position with a stop at 500 for targets of 535.
Okay, Mitesh, thank you very much for that. Let's talk about the auto sector. The Nifty Auto Index, it's down more than about 2%. Individual two-wheelers like Hero MotoCorp down more than 4%. Bajaj Auto is sulking by nearly 3%. And there are some reports which suggest that discounting in two-wheelers in particular has gone up ahead of the festive season. Vinny joins in for more. Vinny.
Yeah, so we have a brokerage note that's coming from UBS on two-wheelers specifically this morning, highlighting that the discounting, especially during festive season, has gone up for two-wheelers. We have seen this come in as a trend previously in passenger vehicles. Now, two-wheelers seems like that's following suit, and especially when you look at it in terms of e-commerce platforms during festive season, we have seen this discounting trend increase. Let's talk about some of the high discounting. One is higher discounting is coming in from Hero MotoCorp. It's in the range of around 11 to 18%, while also in terms for Bajaj Auto, it's in the range of 12 to 16% as well. On the other hand, electric two-wheeler vehicles, they are significantly below the pricing in terms of ICE bikes, or motorcycles that you're looking at. So yes, that is something that we are watching out for. Other than that, TVS Motors, that's managing to gain share, while Hero Moto is actually losing their market share. So yes, Hero Moto is the one that is under pressure, and UBS is maintaining a sell rating on Hero Moto as well as Bajaj Auto, while a buy rating for TVS Motors and Eicher Motors.
Okay, thank you very much for that. There's no sort of buzz, right, ahead of the festive season, any kind of pre-buying. Tomorrow we'll get the monthly sales numbers for the month of September. Sudeep Bandopadhyay from Indie Trade Capital is now with us on the show. Sudeep, two-wheelers have had a pretty good run, but now there are reports of increasing discounting, which is visible. Do you like two-wheelers? Have you done any channel checks?
We do like two-wheelers, and we were all expecting that post-monsoon and recovery in rural demand, we will see pickup in demand in the festive season. And one of the beneficiaries was expected to be Hero MotoCorp. But I think the channel checks are not showing a pretty picture. There is a lot of discounting happening, and there is a lot of inventory in the pipeline. So we'll have to wait and watch. I don't think I will like to venture into any of the two-wheeler companies at this stage. If somebody is aggressive, they can still take a bet on Hero MotoCorp. That's what I feel. But otherwise, it's better to be a little careful on the two-wheeler, considering what's happening in the market. As far as four-wheelers are concerned, I think Mahindra is one stock where we are still positive. We believe that pickup in tractor demand in the festive season can take the script to a different level.
Okay, all right, got that. By the way, I was just taking a look at the move on AstraZeneca, and Ekta, of course, had a chance to catch up with the management as well. And AstraZeneca is absolutely a rocket move right now. Not a stock that we discuss too often, but it's a major one. And look at I saw it up about 8.5%, 9%. It's already up 12%. So I just want to highlight some of the key takeaways from the commentary and the conversation that Ekta had with the AstraZeneca management. Remember, the move started last week when they got the approval to import one of their key cancer drugs and sort of have a wider use here in India. The management went on to tell Ekta that they are looking at bringing in 15 new medications into the country. They have approval for 9 out of the 15, and they're hoping to get more. And then on the back of this, they're expecting great growth in the Indian market in areas like oncology, of course, rare diseases, respiratory diseases, and ailments. So it's sounding quite optimistic on this one stock. Just very quickly, so the Pharma also is hitting the right notes, right? The market mood is changing from overly aggressive to a bit more defensive, a bit more sort of granular. So AstraZeneca, in case you've had a look at the company at all, or any other pharma stock that you would watch out for or that you like?
Well, we did look at Astra, and I think because of the reasons you mentioned, they've got a slew of approvals for introducing some of the very critical drugs in India. And I think that's a very, very good news for this company. But I think the impact of this is going to be for a very short period of time, at least the price impact. And I think the stock has already run quite a bit. So I don't think I will recommend a fresh buy there. But one can start looking at the large Indian pharma companies which have got a significant presence in US. The generic pricing pressure, which was very much there in US, is to an extent receding, and the numbers of Sun and others clearly reflect that. So, one can start taking position in Sun, both on the basis of their US business as well as domestic business. Domestic business very clearly across the industry is growing at a 25% CAGR. So companies having significant domestic business are going to do well over a long period of time. So Mankind Pharma is our favorite for quite some time. So one can keep looking at Mankind Pharma, Sun, and some of the other names, including Cipla.
Hi, good afternoon. I wanted to ask you something about the metal space. Everyone's talking about the...
Okay, I think Nigel, I think we'll just go back to Nigel in a bit. Seem to have a bit of an audio issue with him. But the other sort of story that we are tracking today, beyond all the stock moves, is the all-important SEBI meeting. The SEBI board will meet today. And this is the first official meeting of the board of the stock market regulator, the securities market regulator of the country, since Hindenburg raised allegations against SEBI chairperson Madhvi Puri Buch. We have our colleague Shivani Bazaz here with a heads up and a possible peek into what could be on the agenda. Shivani, take it away.
Yes, SEBI is holding its first board meeting today since the conflict of interest allegations surfaced against chairperson Madhvi Puri Buch by the Hindenburg research, which was followed by a series of scathing attacks by the opposition, and also the first time after close to 300 SEBI employees wrote to the finance ministry about an alleged toxic work culture at the organization. Although these acquisitions aren't formally the part of the agenda, sources suggest that the board is likely to take cognizance of the issues, especially the conflict of interest allegations against the SEBI chair. On the formal agenda, several key proposals are up for discussion today. SEBI may discuss easing regulations for rights issuances and allow promoters to transfer their rights and entitlement to select investors. Also, the new asset class could be introduced aimed at bridging the gap between mutual funds and portfolio management services with investment limits, as we know, between 10 lakh to 50 lakh rupees. SEBI is also likely to deliberate on the mutual fund light regulations today. Remember, a consultation paper was floated on this a few months back. This was aimed to encourage more passive funds participation in the industry. One of the things that was expected but is not likely to be taken up in today's meeting is the rules for future and option trading. The meeting is critical today because it is coming amid many controversies and a lot of interest there today. What we are also learning from sources is that there is no press conference expected today, only a press release by the regulator on the discussion and decisions made today. The press release is expected to be out later in the evening today. Back to you.
Okay, thank you very much for that. So no press conference, only a press release. And as Shivani has picked up, perhaps the SEBI will not deliberate upon tighter regulations for futures and options. But you never know, right, till it's done and we have greater clarity.
So, Arima, the F&O bit, right, it apparently does not need to go to the board.
Okay.
So it won't be taken up. So it's very unlikely, what we're given to understand, that it will be announced today.
Okay.
Because the market was down like this. A lot of people were speculating where maybe the F&O rules are coming and hence the market is down. But that is not, I'm only saying not today.
Not today.
But I think it's imminent.
Considering the pace at which they keep coming out with these reports of 91% lost money and 93% as the latest number, lost money in F&O, and institutional investors are the only ones gaining. Never say never.
All I'm saying is not today.
Not today.
But I think, I mean, if you to put my neck out, I think this week. So we'll see.
Okay.
Yeah.
You know, in fact, when we chatted with Mark Mobius earlier and we asked him about the risks, right? Because he's very bullish on India. And the only one that he highlighted was, tighter regulations by SEBI on F&O. And that also, he said, will cause a temporary correction. He doesn't expect a big pullback, a big correction on the back of that, but it will hurt sentiment. In fact, let's get you the CNBC-TV18 exclusive Mark Mobius of Mobius Emerging Opportunities Fund. He's very bullish on India's long-term structural story. He expects Sensex to hit 1 lakh level by the end of this year.
Now, the problem facing India, as SEBI has pointed out recently, is derivatives have become too big. There are too many people gambling on derivatives. and that could put a damper on the market. So we have to watch what measures SEBI is going to take in terms of the derivatives. When that happens, you'll probably see a downturn in the market, just temporary downturn, but you'll see some correction in India. Nevertheless, we are now on a long-term bull market for India, and I see the Sensex index going up to 100,000.
Okay, interesting comment there. Sudeep, sorry, I think now I'm back with you. Sudeep, on the metal space, what do? You know, that one, valuations aside, once it gets its momentum, then we see metal stocks do well. Now, from today's high, a few of these stocks have already slipped. Nalco is almost into the red. Vedanta dipped into the red. And these stocks have had a good run. And they have, combated that Supreme Court verdict that we saw with regard to the retrospective taxation that could be deployed on it. And also sentiment was quite weak. What do you do and what do you like from the space? If you've made a good 10-15% in the recent past, will you take some money off the table or do you look to ride on this?
As far as metals are concerned, Nigel, at this stage, I will not like to take my money out. I think, the China stimulus and China excitement is real. They are finally trying to do quite a lot of things and all at one shot. Everyday measures are getting announced. Even the weekend, the measures were being announced. So for some time, I like to wait as far as metals are concerned. Little bit of turbulence here and there, I will withstand that. But if you're talking about medium to long term, I think my bet is on aluminum. And I think I discussed this. I believe there is a structural shift to aluminum from many other metals. Whether you look at the entire EV chain, you look at the entire electronic goods chain, and many, many other industries, the use of aluminum is increasing by leaps and bounds. And the aluminum manufacturers, the entire aluminum value chain will benefit over a long period of time due to this shift. So, Nalco, Hindalco, Vedanta has been my favorite as well, can definitely be picked up for a medium to long-term perspective.
All right, Sudeep, we'll leave it there. Thank you very much for joining us, and it's great speaking with you. Appreciate your time here on CNBC TV18. We are down 370 points, which means we're at about 25,800 on the index. So not very much different from when we started the show at 2:30. We'll take a break. Sunil Kaul from Goldman Sachs will be joining us on the other side. That's coming up in just a bit.
Both with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality. Yeah.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
So my caution is all geopolitics, which may determine the state of the economy. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries getting involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest question. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy, but we are spending a lot of money. And in my view, that spending the money causes growth, it also causes inflation, and whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm put me on the cautious side of that one.
US has been trying to reduce its dependence on China. India has been and is expected to be a big beneficiary of it. Do you think we are sort of using that full potential right now, or there's a long distance to go?
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously, every nation look at it and say, we can't rely on someone who might one day be an adversary. That doesn't make them an adversary today. for supply. Just like JP Morgan's always have multiple diverse supply chains. We don't rely on anything. The second one is around disagreements around policy, like, you know, if countries are aiding and abetting industries to dominate a global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, you know, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. The semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. A huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
You know, we got U.S. elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that. I mean, in that sense, what's happening is in a way irreversible. You know, the break in relations, sort of a Cold War.
I think you have to be very specific in this one.
Welcome back. We're right there, almost like, you know, the tick is pasted on the tape. I mean, 370, 380 lower, 25,800, not budging so far. Incrementally, that is. Sunil Kaul is Asia Pacific Equity Strategist at Goldman Sachs. Sunil, good afternoon. Good to have you back on the program. Thanks for your time.
Glad to be back.
So, two things, right? One, of course, is a lot of talk of whether tactically money is moving to China. Is that at play at all? What are you hearing from your regional desks, if you can? And second is, we just thought this large cap rally was starting, and you know, you got what you got today. How would you look at it? I mean, I think about what 40-50%, maybe more of large cap stocks. I mean, Nifty stocks are just about 10% away from all-time highs.
Yeah, and that's true.
Just your thoughts. Yeah, go on.
Yeah, Prashant, I think on the China bit, I would say, look, I mean, the fact is that they are seeing a very coordinated response on the policy, both on the monetary side as well as on the fiscal side. I think from some of the client conversations we have been having last week, including some of the flows from the desk, I would say people are a little bit sort of skeptical about China on Tuesday, when we had the monetary easing announcements by PBOC in there. And I think the tone at that point was that you need sort of more fiscal push for growth to stabilize. And then I think on Thursday, we actually had the Politburo meeting wherein they sort of pledged to have more sort of fiscal support. And then there were some media reports which are still unconfirmed, but saying that there could be as large as 2 to 3 trillion RMB stimulus, which could come through in terms of recapitalizing the banks, sort of consumption stimulus, infrastructure stimulus. So I think so I think the clients we have been sort of speaking to late last week have been also sort of getting a little bit more comfortable with the fact that if this indeed comes through, it could mean sort of stabilization in China growth, which should be good for the markets overall. Having said that, I think the market had a very strong rally last week. MSCI China was up 17% from the lows. But I think if you put that in context, we had the market coming in from deeply oversold levels, right? I mean, we were seeing valuations at 9 times China in China, and now that's kind of gone from 9 times to 10.5 times. So we still think that it can sort of go to sort of 11 times plus. And so there could still be a bit of tactical rally continuing in China. Positioning from what we are hearing, both from long onlys, but also from the hedge funds, long short managers, is that things have kind of gone from positioning in the bottom half of the decile to like 14-15% in terms of the overall positioning, but there is still some more room for that to improve. So I would say I think you could still see next couple of weeks China momentum continue. The critical thing would be to see whether there is any improvement in the higher frequency data for the month of September, which comes out in the middle of October. So I think in a couple of weeks, the market will start to see if we are seeing some stabilization in the data.
Throw in India there as well, in terms of that feedback. Sunil, point taken, but throw in India into the mix there as well, in terms of flows and what you're hearing. Is it, I mean, so if China momentum continues, does it have to be at the expense of some selling here? Will it be? What's your sense?
So far, we haven't seen, Prashant, anything like that in the data. I mean, last week, I mean, there was kind of flattish flows in India, even though kind of China had a very strong rally, as I mentioned. I would say a couple of things. One, if you just historically went back and looked at China's flows correlation to the rest of the markets, even during the times China has had strong inflows or over the past sort of 10 years or so, I think there is generally a positive correlation to most of the markets in the region, meaning that when there is kind of decent backdrop for the overall region, you start to see flows coming back everywhere in the region, including China and India as well. So I don't necessarily think that flows, therefore, is a zero-sum game, that China inflow means that you have to have outflows from India. I think a large part of that should be based on underlying fundamentals. The other sort of anecdotal or more sort of historical episode I will point to, I think we had two recent episodes somewhat in terms of very strong rally in India. One was a rally in China. One was in January this year, kind of January to May, that 4 month of rally. China was up 30%. During that time, I think India had less than $1 billion selling in terms of FII outflows, and the markets were still 10% higher because of the domestic flows. And then obviously there was that late 2022, early 2023 China reopening rally, which was kind of a 60% bounce in China. Even then, India, I think peak to trough was only less than 10% down, and then quickly bounced back in the next 3-4 months. So I would say that in general, our sense is that India probably still stays resilient overall. You might see a bit of weaker foreign flows, which is not just because of China. You also have US elections coming up. You have state elections in India. So there's lots going on, because of which you could see kind of tepid foreign buying in general. But our sense is that you probably will still continue to have support from the domestics, and overall, because fundamentals still look decent, market should be able to hold its gains.
Just to complete that point on flows, while your point on passive flows is very well taken, right? And we've had a lot of guests saying exactly this. We were in conversation with Mark Mobius earlier. So the point on passives is fine, because that money will come into emerging market funds. It will come to India also. But what about active fund managers? And this might not start just yet, but what's the chatter you're hearing? Is there some sense to book profits on the active side? Book profits in India, where the markets had a roaring rally, and tactically move that money to China?
Look, there could be a bit of that rotation that could happen, but I think there are a couple of points I would mention here. One is that if you generally, I mean, our view on the overall sort of India positioning side of things has been that overall foreign positioning is still decently light in India, and because a lot of the price action has been in because of domestic flows, as we know, and so when you sort of look at the India's overall foreign ownership, that's still at 11-year lows or close to that. So it's a multi-year low still in terms of foreign ownership. When you look at the EM fund positioning or Asian fund positioning, the fact that India's weight in the emerging market benchmark has gone from 8 to 10%, which was the case about 10 years back, to nearly 20% now. People have been sort of chasing that move, and so at the margin, emerging markets are like less than 100 basis points overweight, which is much lower than what they had historically. And Asian mutual funds are actually slightly underweight India based on the numbers you track, right? So my broader point being, it's not that people have been super overweight India to begin with. And yeah, there could be a trimming of some allocations, which we have seen in the past. But a lot of the overweights we see technically have also been in banks, which have obviously derated quite a bit and underperformed quite a bit. And so beyond banks, we don't see a lot of concentrated overweight positions in a lot of the names within the FII bucket. And so therefore our sense is that even though there might be some sort of rotation, we don't expect a large foreign selling in Indian markets.
Sunil, hi, afternoon. You know, getting back to that point on China, the two recent episodes you indicated in January of 2024 and even towards the end of 2022, when we had those sharp China rallies of 30 and 60% respectively, they were short-lived. They were tactical in nature to some extent. Is it going to be the same this time too? That, you know, that up move in Chinese markets continue, but it's not that like we're at the start of a structural bull run in China. So do you think the measures also that have been announced so far, the coordinated response, is enough to get them out of a slump and start a bull run for the Chinese equities?
Look, I mean that's a great question. Our sense still is that you got structural challenges in China in terms of slowing growth and sort of weakening demographics. I mean the property overhang is real. I mean what they are doing is a lot of the supply side measures in terms of putting more hands in people, more money in people's hands, and then at the margin easing some measures in terms of people sort of buying properties. A lot of the austerity measures they have put on property, they have kind of the Chinese policymakers are removing that. But I think it still needs to be seen whether that's enough for stimulating demand, right? I mean, these are kind of more measures on the supply side. There hasn't been enough that has been done on, but so far what had been happening is that growth estimates had been coming off. All the higher frequency data was continuing to weaken, and there was a downside risk to a lot of the numbers on the street in terms of government not able to meet even their 5% GDP growth target, which they had. And I think what these measures are doing, they're at least putting a floor on those numbers, and hopefully they should be able to at least meet those numbers. So I think to your point, we don't think it's the start of a structural bull market in China. We still think that there are structural challenges to the growth. But I think a lot was priced in the markets already, with both positioning and valuations at cyclical lows. And so I think what's happening here is that you're kind of taking out the left tail risk out of the market, which is why the market's now re-rating from very low levels. And so that momentum, as I said, could sustain. But then I think the market will need more evidence that A, higher frequency data is indeed kind of stabilizing, if not improving, and B, you should start to see, hopefully, that in the corporate earnings side of things, because I think the reality still remains that if you look at the second quarter numbers, like the June quarter, or for the first 6 months of the calendar 2024, the aggregate China universe, which is around 6,000 odd companies, the aggregate profit growth was 0%. So we had no aggregate profit growth. Obviously, dispersion within sectors, but literally no profit growth for the first 6 months of the year. And most of the sectors, barring internet and a few pockets, were actually still seeing earnings downgrades. So I think we need to sort of move from higher frequency data still weakening, earnings still sort of seeing downgrades, to hopefully things kind of stabilizing. And I think that will give markets some comfort. But I think we are far from calling it a structural bull market in China at the current levels.
All right. Hi, Sunil. Good afternoon and good to see you. Well, that's the reason that India trades at a sharp premium in comparison to China, right? We have earnings growth, political stability out here, and, things have been looking up out here. So better stability, it could be one of the factors that, that's why we are commanding those valuations. We've spoken enough about China. Let's focus on, sectors and themes. Now, we're talking about global-facing themes, and two of them stand out. One is metals, where I think you all had a neutral stance. So with this kind of rally, and if China's going to come back into play, then will you all want to change that stance out there? That's on metals. And what about tech? You all were bracing yourself for a far better second half of the year. Holding on to that thought?
Look, I think on the metals, we still, Nigel, have a market weight stance there. Again, I think sort of if you circle that to the China discussion, also, we don't think this is a huge demand upside for the commodity complex at this point in time, as we spoke about the property market. So I think we still think that for the metals overall, some of the metals, whether it's steel, whether it's iron ore, they're kind of still structurally oversupplied in many of the global markets, including in China. And so I think keeping that in mind, we still think that that the neutral is probably the right stance in there, rather than being sort of overly bullish on metals. On the IT side of things, I would say we had been warming up on the sector, and kind of we had been not structurally, but we have been underweight for most of last year. And sort of coming into this year, we had sort of neutralized that stance largely on the fact that even though you have a couple of more quarters of weakness in near term, you could start to see inflection into the outer quarters. And I think that is starting to play out. But having said that, we still think it makes sense to be much more geared towards the domestic sectors in India overall. And we have a sort of mix of both cyclical and defensive sectors in our allocations. And I think one of the core views, which we just reinforced or reiterated in a detailed note published last week, is that overall we feel that India's profit growth is sort of its sensitivity to the external growth has been coming down. It's kind of much more geared towards domestic growth, and that is already kind of reflecting in the profit pools being shifted. So in the last sort of 8 to 10 years, most of the bulk of the profits were literally coming in from sort of financials and IT, and I think that's kind of shifting already towards some of the investment cyclicals, which includes kind of autos, real estate, power, some of the clean energy side of things, and that's where our sort of positive views have been around. And we do think that over the next not just sort of the next few quarters, but on a more medium-term basis, it makes more sense to be more geared towards the domestic cyclical sectors in the market, and that's where most of the profit growth will come from, and that's which will show up in the in the underlying stock prices as well.
Okay, so you're sticking to your sort of like for domestic cyclicals, and just another 20-30 seconds left on the conversation, Sunil. What about earnings? It's at the end of the day, earnings are the fuel that power sustained bull markets, right? We're getting into another season. How confident are you about the earnings delivery, and what's the range, say, for the Nifty 50? For your own universe, what's the rough earnings growth that you're still penciling in this year?
Yeah, so if you look at the last 5 years, Ruby, so we have been sort of, I mean, obviously a lot of volatility with the COVID drawdowns and all, but the last 5 years, MSCI India has basically compounded earnings at 16% CAGR rate. We are sort of penciling in. So the first 6 months of the year, we have around 14% earnings growth. So still kind of numbers coming through. And I think to Nigel's point, the view really is about macro very good, earnings delivery continuing, and then domestic flows kind of supporting the market. Our own sense is that going forward, you can still see mid-teen earnings over the next sort of few years until 2020, 2030, where we have sort of official forecasts out now. And we are up sort of penciling in around 14% earnings growth. So somewhat slower trajectory than what has been in the recent years, part to do with the signs of slowdown in the economy and sort of fiscal consolidation that the government is doing, which might sort of weigh on the growth. But in general, we still feel confident that you could see around 14% earnings growth over the next sort of 4 to 6 years, which sort of should drive markets higher, even with some multiple derating from current levels. So you could still see decent sort of early double-digit returns in the market on a sustained basis. We still have a 27,500 target on Nifty, and we are overweight the market in the context of the region.
27,500 by when, Sunil?
I mean, obviously the markets have been stronger, so that's a 12-month target technically, but it's basically kind of 7-8% upside, which is 13-14% earnings and a bit of multiple compression is how we get to that number.
Okay, Sunil, it's always good hearing your thoughts. Thanks a lot for speaking to us here on CNBC-TV18. China, it may be bouncing, but it still has structural issues. India will continue to see mid-teens profit growth, and maybe, in fact, we could see high single-digit to early double-digit returns on the index. Appreciate you joining in. Well, for the time being, the markets are at the low point of the day. I'll tell you what, we'll slip into a short break. You come back, we'll continue to focus on markets. We'll get back our technical experts as well.
National security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America in that one, so that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about disconnecting.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage.
Welcome back. Markets at the low point of the day, but it's a good time to find out what's going on in D-Street Chatter. Nimish can give us further insight about today's fall. Nimish, tell us, what are you picking up?
Hi, Nigel. It's largely the fall is led by the large cap names. And again, looks like there's a bit of geopolitical risk, which is a big concern there, a bit of nervousness out of the SEBI board meeting as well. And that's been largely discussed as well across all the dealing rooms. So maybe these are the few factors which has led to a sharper fall in the broader markets, in the large cap names today. Even in terms of flows, I understand there is selling pressure in select large cap names, which includes the large private banks, Reliance. There is selling pressure clearly from the larger FIs today. So that's the reason why you're seeing a big fall in the Nifty. But if you look at the breadth, that's not very weak. There is outperformance in select pockets. Like for example, metals have done really well. Out of the blue, cement stocks have done well today, and so are some of the mid caps as well. So it's not like there is across the board selling. The selling is largely in the large cap names today. That's the overall feedback. The other sector which has been relatively underperforming is the auto names. Across the board, autos have relatively underperformed, largely on profit booking because they've done very well. And now there are reports which are indicating that maybe there is the discounting is going up. There is a lot of inventory as well in the system. So the monthly data on autos will be very interesting to track in the next couple of days. But I guess today's big sell-off seems to be largely restricted to a few large cap names, including the large private bank stocks.
Got it. All right, Nimish, what about individual stocks? What are you picking up?
Well, so the first stock on my list is RBL Bank. There was a large block. 75 lakh shares got changed hands in the afternoon trade. I understand the FI was a seller in today's block, so disclosures could be quite interesting in RBL Bank. So that's the first name. The second stock is GAIL. Within the PSUs, GAIL stands out. It's been outperforming as well of late. I've been saying for a while now that select PSUs is seeing buying interest, and GAIL stands out on back of very strong buy flows today. So that's the reason for GAIL to outperform. And the third name is Varun Beverages. There was an initiating report as well from an FI brokerage, but there is a very large selling pressure in Varun Beverages at an FI. So it looks like at this level some bit of churn is happening within the larger portfolios, and Varun stands out in terms of sell pressure from a leading FI. So that's the reason why it's part of my charter list.
Okay, thank you very much for that. Interesting list as always, Nimesh. Mitesh is now back with us for a few BTST calls. Mitesh?
So I have a HCVT on HCL Tech with a stop at about 1810 and a target of 1775, 1770 on the downside. And a BTST on BPCL. In fact, it's the oil refineries, metals and sugar, which is doing well. So BPCL can be a BTST with a stop at 365 half, the targets of 376.
Okay, thank you very much for that. Anand Tandon is also joining in on the show now. Anand, what have you made of this collapse that we've seen? Not collapse, but this correction that's set in the large cap names. Anything that you've picked up from your conversations with other market experts?
Well, I try and stay away from what other people say. But broadly, I think, the right question would not be why it is falling. The right question would be why did it rise so far? And, that is something that I found a little difficult to justify, as you are well aware. I don't think that we should read too much into a one-day fall. We have to see whether the trend continues. You have been discussing on what are the issues regarding China, etc., and whether there is a flow out there. You have to keep in mind that, today you have an economy like China, which is 3 times the size of, or 5 times the size of our economy, trading at the same market cap as us. So, obviously the valuation gap is so huge that for anybody looking at it from the outside, China, if it becomes a stock market which is tradable again, given the penchant of the government to try and destroy it, if that thing has reversed, then clearly that will offer a lot more interesting opportunities than India does at this stage, purely from a financial investment point of view.
Right. No, got that. Anand, I think you put the entire market question in a philosophical framework. The question is not why we are down, but why did it rise so much in the first place? But point taken, and that's one way to look at it. Now, I just want your thoughts on PB Fintech, right? I mean, the stock fell quite sharply last week. We had the management with us. They're investing into a yet-to-be-formed company, and they're going to invest up to $100 million, one-time investment. So I'm going to play out the sound bites, and then I wanted your thoughts on how to think about something like this. Listen it. Okay, I think we don't have the PB Fintech soundbite. We should have it shortly. Maybe we can ask Anand for your view and then play out the bite if he'll have it ready by then. I don't know if you heard the interview. Basically, the concern is that they're going to build hospitals.
I did hear that that they are putting money into a healthcare business.
Yeah, go on.
So it is, frankly, whenever you have too much money, you end up doing things like this, right? So this is like saying that, Reliance should, since it was making textiles, it should now backward integrate into generating humans. There is no particular reason why you should be, as an insurance broker, be looking at doing anything other than insurance broking. It's a very large space. It continues to be a growth area. For most insurance companies, the opportunity is still very large. And there is no particular reason why you should be necessarily then saying that, I need to benchmark myself. This was, if you recall, some time back, Mahindra Group CEO had come and said that, we are trying to dip our toes into trying to understand banking. And I had commented at that time that for a company which had a Kotak Mahindra investment from the very beginning to say that they don't understand banking is a bit of a joke. I think PB Fintech, to my mind, is doing something similar.
Okay.
To be fair to them, we did sort of get into a lot of the details, Anand, to figure out how this is going to happen. And they did clarify that this will be through a strategic investment in a different entity, which will have its own set of investors as well. And PB Fintech will limit its investment to, a high of about 35% is what they're talking about, at least as of now. Let's actually listen into the management and the rationale behind looking at a differentiated asset-light healthcare foray.
PB Fintech is looking to make an investment subject to board approval in a separate venture, which actually is not a PB Fintech subsidiary. PB Fintech would probably be a minority investor between 20 to 35% equity holding, right? And this venture, for lack of a better word, let's just call it XYZ. XYZ has its own life beyond that, and PB Fintech's liability is limited to that first investment. It does not have any compulsion to keep investing into the future, right? And all this is subject to board approval. The model is essentially an HMO model. And this entity is obviously finalizing with its other investors and other partners. They could be healthcare companies, they could be insurance companies, they could be development finance institutions, they could be private equity players. There's a whole bunch of people that it will speak to. This hospital is going to be aligned to the insurance industry. We are not really thinking about what it does to the other hospitals. I do believe it will, if successful, set benchmarks for the others.
Okay, that's PB Fintech for you. Everything is down today except metals. The Nifty Metal Index has hit a new high. It's up for the 8th day in a row. And they're going to end September on a very strong note thanks to the China stimulus. Manisha is here to tell us more about what's happening with the base metals. Manisha.
Well, thank you for that. Absolutely. If you look at the last 1 week, the month of September or the current quarter itself, it all seems to be closing on a very, very strong note there. We have seen the most aggressive of China's stimulus since the pandemic there. So whether it has been about lowering borrowing costs or injecting funds into the economy or even easing mortgage repayments, China has done it all. The street does feel that China isn't stopped or done yet. It could be coming in more strongly when it comes to property sector, because that is one that still needs to be addressed right now. But at this point in time, the sentiments clearly on the positive side. The second thing is that while, of course, the one rate cut has been done, now for the month of November, it's a 55-45 probability that whether you're looking at a 50 basis point rate cut or a 25 basis point rate cut, and that in turn seems to be weighing onto the dollar and supporting the metal prices there. The street also believes that come the first quarter of 2025, the China restocking will come back. And even as China has been exporting whole host of commodities and metals, the absorption, especially from India and various other countries, has been on the stronger side as well. So those are very supportive factors. We have seen inventories for many of these metals decline as well. Is the reason when you look at the last 1 week, you are looking at 7% of gains in copper and another 8 to 6% of gains coming in for aluminum and zinc as well. For the month of September, the gains have been quite strong. 17% of a jump up coming in for many of these metals, 15% up for copper as well. And for this year until now, we have seen double-digit percentage gains come across board. Anywhere between 11 to 35% of strength is what the metals have seen, with an expectation that the last quarter of this calendar year could see this strength continue to build up on the higher side.
Okay, all right. Got it. Thanks very much for that. Metals indeed have been the shining spot over the last couple of weeks since we started seeing these stimulus moves in China. Let's take a break, come back with more market talk and more perspective on the other side.
Intelligence and in-depth reporting that make CNBC-TV18 India's #1 business news brand. Foreseeing change, growth and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour.
Welcome back. Well, the markets are going to be ending at the low point of the day with the Nifty Bank. In a couple of trading sessions, that's pulled back close to around 1,400 points or thereabouts. But we have Anand Tandon still with us. Anand, I wanted to ask you about a few of these themes that are still doing well today. Housing finance companies are doing well. Canfin Homes, that's up close to around 1%. And most of that move has come in the last few minutes in a market that's very wobbly. I think after Bajaj Housing listed, you have a lot of these other companies that have suddenly got some comfort on the valuation parameter. What do you like from the housing finance space?
Well, the sector has been something that I have been saying that is probably one of the better places to be investing in, because while real estate stocks have actually done very well, the reality is that their sales are beginning to ease off. On the other hand, there are still many more self-made houses, etc., which will still be under play, and therefore they will require loans. So probably a better way of playing real estate has been that. Of course, the fact I'm not commenting on the valuations at all. Those are really irrelevant given where Bajaj Housing now trades at. So all of them will look cheap compared to Bajaj, but the question is whether Bajaj should be the benchmark or not. It is a competitive space. It is a space where the margins are going to be somewhat under pressure. But despite that, at least the asset quality is, unless the management does something silly, is likely to be reasonably decent and can continue to grow.
Okay. By the way, I'm looking at the market right now. It's quite crunching the fall, and we are at the lowest level with no hint, no sign of buying coming in. And once again, the Nifty is struggling to even remain above 25,800. It dipped below that level. Look at that graph. Absolutely no hint of buying the lows today. Well, before the market closes out, let's quickly put the spotlight on IOC. The company has decided to withdraw the proposed rights issue of 22,000 crore rupees. Sonal is joining in with this important update. Sonal.
Well, it is important, negative, and something that was largely expected as well. Remember, the government is the promoter and was going to infuse this money into the company. Now, remember, the company has gone ahead. The board has decided to withdraw the proposed 22,000 crore rupee rights issue. That is because the Ministry of Petroleum and Natural Gas has conveyed to the company that the government is not willing to put in that money into the company. And this is because there was no capital support for oil marketing companies in this budget. For last 2 years, there has been no support. So this time it was expected that, yes, government could go ahead and withdraw that support completely, and now it's official. The release says, in view of non-participation of government, that is the promoter, it is withdrawn. And remember, it was approved last year in July 2023. Board has also approved around 18,000 crore rupees for BPCL in terms of rights issue. So I think BPCL will be the next company which could take that decision. Of course, we need the official data from them. But considering that there is no infusion of money coming in from the government, this could happen with BPCL as well. Now, Nuvama in a post-budget document had said that with no budgetary support declared, OMCs are likely to continue to bear losses on sales of LPG, because in their Q1 con call, oil marketing companies were still hoping there could be some support that would come by. But if it doesn't, they will continue to have losses in their LPG portfolio, and that would be a negative.
All right, Sonal, thank you very much for that. So that's the news flow on IOC and, of course, oil marketing companies, etc. as well. Anand, that SEBI board meet is today, and we were discussing this earlier. From what we understand, the F&O bit, which is the most keenly watched, that's not going to come up today. But I think it's imminent. That is imminent as well. Just your thoughts on, because a lot of the detail was out in terms of what was proposed. How much of it will be implemented is another matter. But will it have a market impact when it comes?
Obviously, the SEBI is trying to make a market impact. So I would imagine that if the first round of whatever regulations they pass doesn't have a market impact, the logical thing would be to tighten it further. So till it actually results in what SEBI is trying to achieve. So to that extent, you should be sanguine about the fact that, over time, volumes or liquidity will reduce in the market. And if that's the objective, the retail investors will probably find it more and more difficult to probably get in and invest through that. Whether that serves the overall purpose of making the market more stable is a different ballgame altogether. But if SEBI has decided to reduce the retail participation, it has all the tools it needs to be able to do that.
Anand, thank you for joining in. Counting down to what's been a painful day for our markets. The Sensex plunges 1,200 points. The Nifty ends down 350 points, but above the 25,800 mark. The bell is gone. It's 1.4% lower on the benchmark indices. Midcap index ends in the red, but the relative cut is a little less, so 0.4% gone in the mid-cap index with an advanced decline ratio, which stands at about 2:3. On the way down, it's two-wheelers like Hero MotoCorp, Bajaj Auto, Reliance Industries, ICICI Bank under pressure. Trent, BEL, the latest entrants, have started off on a weak note, so down about 3 to 4%. On the way up, it's only metals, the Nifty Metal Index ending in the green, with JSW Steel, Hindalco, Tata Steel all notching up gains.
Absolutely, and it's a tough day with 350 odd point cut. But the point is, we've also done. I mean, you basically given back the gains accumulated over the last 5 days, because last week Friday to Friday the index was up 1.5%, and today you're down about 1.4% or so. So that's the other kind of way to look at things. Outside of the Nifty, I just want to put out these names. Look at these names: Sterling, Wilson, and Solar down 5%. It's come off quite sharply from the highs. Lodha, which is macro tech developers, down 5%. There is Bharti Hexacom, which lost about 4%. Newgen down 5%. Kaveri Seeds down 5%. But it's not a very long list of volume-led losses today. Shoppers Stop down 5%. About 7, 8, 9 names with large volumes on the downside. That's about it. With market breadth numerically being, in favor of what was down. But if you look at gainers, it's once again a very long list of volume-led gainers that we had today. JM Financial, huge volumes and a 6% pop. Saregama was up 10, 11% on the flip side. So JM, Saregama, AstraZeneca, of course, we've been highlighting. Sequent Scientific is the fourth biggest volume-led gainer, 7% today. It was up on Friday as well, by the way. I think we highlighted Z Media. I mean, Religare is almost back at 300 levels, so it was a 6% gainer in trade. Power India, 5.5% gain coming through today. That's a big volumes on a 14,000 rupee stock. And I could go on, and volumes really on the side of what was up. Although, if you counted what was up and what was down, there were more down than what was higher in trade. So that's essentially the market, 350 lower on the Nifty. It's a wrap on this edition of Closing Bell from all of us here. Goodbye. Thanks for staying with us. But don't go anywhere. Rima and I'll bring you markets forward after a quick break.
At CNBC-TV18 weeknights at 7 p.m.
Valuations are one standard deviation above overall market, and in certain pockets it's crazy. Look at the SME part of the market; it's in a different frenzy altogether. 65 times the index is up over the last 5 years. So I think what I would suggest to most of your viewers and the investors in the market, this is the time to go back to basics of investing. Make sure that the quality of the company you are investing is not compromised, and make sure that the portfolio is resilient enough that whenever there is a drawdown, the portfolio stands tall. So these are the few things which is under your control, which you can do. On the themes, I think power demand and electricity could be a slightly medium to longer term theme, and energy transition. And look at some of the data points. After 15 years, US is starting to see increase in demand for electricity, led by data centers, EVs, and so on and so forth. You will be surprised to know that CY19 to CY22, out of the top 10 air conditioning installation markets, 8 were out of Europe. Who would have thought that Europe will install ACs far more than any other country? And 8 cities out of the top 10 are from Europe because of global warming. So I think there are 4 important points: global warming, data center, which is AI, electric vehicles plus bitcoins and cryptos, and the constraint on transmission and ESG, which is leading to the entire energy transition and increase in demand for power. I think this could be played through various things: distribution, transmission, or generation, and the ancillaries to that. So I think it's a mega trend. Valuations could be something which is prohibitive right now, but keep a close watch on this trend over the next 5-10 years.
Indian equities dropped sharply on the back of weak global cues. Sensex and Nifty record their biggest losses in 2 months as IT, financials, auto stocks drag.
Metal stocks outperform as China announces a slew of stimulus measures. The country lowers borrowing costs and injects funds into the economy, also eases mortgage repayments. China mainland indices jump another 10% after last week's big rally. Mark Mobius believes China may be in a new bull market.
PB Fintech's top brass tells CNBC-TV18 they will make a one-time only investment of up to $100 million for a between 20 to 35% stake in a new health venture to set new cost benchmarks in the industry. They say the motivation is essentially the fact that most cannot afford hospital treatment at very high rates. Hello and welcome to a fresh new edition of Markets Forward, your go-to program where we aim to get you everything you need to know as you gear up for the next trading session. Today was a red day. I'm Prashant. With me, my colleague Rima Tendulkar. Rima, hi.
Hi, a very tough day for our markets. We'll talk more about it in the next 20 minutes with all the big news, what happened on Dalal Street, top corporate voices, and what to track ahead. But first, the day's market action.
I mean, it was down and out, and I think in a single day we gave up 5 days worth of gains. I mean, with the Nifty was down 1.4% last week. Friday to Friday, we went up 1.5%. So, we've done a lot. Actually, we were saying this last week from the last election results, right? I mean, 4th of June was when election results were announced, the general election results. The Nifty is was up till last Friday, a clean 3,000 points. That is essentially about 12-13% on the index. And now you're running into elections again. That is state elections, which is, of course, on the 5th of this month. Huge outperformance. The big themes have been US and, of course, the AI theme there. And, of course, the other big theme has been India. So an asset class in itself. And there was a bit of a pullback here. You can assign various reasons and we'll get flows, numbers, etc. China is doing very well. So lots of people scratching their heads and saying whether maybe at the margin there is some reallocation, especially from the fast money, hedge funds, etc. to that market because perhaps valuations are very cheap. And over the next couple of days, flows will tell us that. You had a bit of a pullback. Hourly averages, etc. are all broken. So you need to look at the 20-day moving average for both the Nifty and the Bank Nifty. For the Nifty, that level is 25,550. That is as of yesterday's close. I mean, as of today's close as well, the number will not be very different. But the 20-day for both the Nifty and the Bank Nifty will be essentially markers on the downside. Remember, it's also a holiday shortened week. So markets are shut on Wednesday. So you come back tomorrow and then the day after is a holiday. China also, by the way, is shut from tomorrow all the way till the 11th, 7th to the 11th. So will this sort of China momentum continue with the mainland markets being shut? I mean, I think that's the other question to sort of ponder over and look ahead as we go forward. Rima.
The Golden Week holiday begins in China from tomorrow, but it's a news-heavy week, right? Today you've got Powell's speech. He'll be moderating. He'll be speaking at a particular event. Towards the end of the week, the non-farm payroll data, so labor data also in focus. But China really stole the spotlight today. The Chinese index, Shanghai, ended up with a gain of about 8%. taking its month-to-date rally to about 17.5% and pretty much reversing all of the underperformance that it had through the course of the year. In terms of sectors, autos down more than 2% at the index level. The Nifty banking index was down close to about 850 points, 1.5% gone. ICICI Bank under pressure. Heavyweight Reliance Industries cracked more than 3%. On the way up, I think the only place to hide was metals. The Nifty metal index holding up for the 8th day in a row. JSW Steel, Hindalco, Tata Steel, some of the other gainers. NTPC, Britannia too make it on the winners list. But here's a lineup of what we have for you on our show today. We start with the top movers and shakers of the day with Hermes. Metal stocks shine in trade on the back of the China stimulus measures. We'll put the spotlight on the key expectations for the September auto sales and also what led to Z Media zooming in trade. And finally, we'll prep you up for tomorrow with the key market events to watch. But on top of the show, it's Hormus with the top movers and shakers. Hormus.
Well, China may have already had a golden week before the golden week holiday, but you can't say the same for our own markets today. The last day of the month, the last day of the quarter, very much in the red are the markets. And it was led by a sector that led the market up in recent times as well. It was the banks. And you can see here all the index heavyweights, ICICI, HDFC, Axis, all of them who contributed to the Nifty upside towards 26,000, leading the losses today with anywhere between 1.5% to almost 3.5% on Axis Bank. The other sector on a weak footing today ahead of the sales numbers tomorrow was the auto sector, and some negative brokerage commentary also coming in for stocks like Hero Moto and TVS Motor as well. Hero ending almost at the low point of the day, 4% down on that, and Maruti and Bajaj Auto were no different as well. The only sector, as you mentioned, to hide today was metals. They are the ones that survived with some bit of gains even as they came off the highs of the day. But Welspun Corp was an outlier, ending 3.5% higher after another order win during the day, and most of the other stocks as well ending higher in today's session. A lot of news flow that also came in through the day, and Indian Oil Corporation was one such stock. It withdrew the proposed rights issue and the stock recovered to end in the positive after that announcement. Aurobindo Pharma, after the 10 observations issued, 3.5% lower. Shakti Pumps is going to consider a bonus issue, so a good move there. NMDC, the top performer among the metal names after the iron ore price rally, and of course PB Fintech had a very choppy day, but eventually ending down for the 6th day running despite the management clarification. And lastly, stocks that did well on the back of volume. Saregama was back in the spotlight today after 2 down days, another 11% higher today, and stocks like AstraZeneca and Whirlpool continue to build on to their gains with very strong volumes. Back to you guys.
Thank you very much for that. Shilpa Rao, Prabhudas Leeladhar and market expert Anand Tandon are with us on the show. Thank you for joining in. Shilpa, first, very weak, trading session, a tough one. Where do we go from here?
Of course, not the encouraging session that we saw today. The close also on a little weakish note. But the levels are yet not breached. Maybe just a day or couple of sessions of consolidation, because we've seen the rally soaring up so fast and so sharp. So this sort of little pause is also very well needed. So I would look at this as a buying opportunity. So as long as we are holding 25,500 on closing basis, we are still on the upside trend. Maybe a consolidation phase can happen, or a sideways market can be hover for a few more days. So for Nifty, 25,500 will act as a very strong support. Till that is held on, we are good to see again higher levels, but eventually. So talking about Bank Nifty, of course, is also showing little signs of worry, because it has now, give a close below 53,000, so which is little, worrisome from here. But maybe tomorrow, if we again sustain above 53,000, then we'll again talk about, higher levels coming in very soon. But for Bank Nifty, it's a wait and watch scenario.
No, absolutely. Got that. Anand, quick, you have any thoughts on the market itself?
Well, I mean, I don't think one can read too much into a day-to-day move. The market has been on a tear upwards. If it reacts one day downwards, it's not even enough for it to get back to a reasonable level. We are talking about markets which are kind of in inexplicable territory. So I don't think that it makes too much sense to correlate. Already we are making kind of correlations between, let's say, China doing well versus commodity versus metal stocks. I mean, that's like saying, Microsoft signed up a deal for nuclear power, BHEL should go up. I mean, there is no relationship. China is not going to build new houses or new roads. They are suffering from an over-construction. How will that impact anything to do with metals?
Okay, but let's talk about metals because that's the space where we had the big moves. In fact, the Nifty Metal Index was the only one which managed to close up in the green, and the index went on to hit a fresh high. This is after aggressive stimulus measures from China since the pandemic. So metals like copper, nickel, iron ore rallied. Silver hit a fresh 12-year high just last week. Manisha is here to get us up to speed with the latest rally in metals. Manisha.
Well, thank you for that. Well, on-ground demand for metals hasn't really picked up, but the sentiment clearly seems to have improved after China's most aggressive policy stimulus measures since the pandemic. So while we have seen China lowering borrowing costs, it also has injected funds into the economy and eased mortgage repayments as well. The markets do believe that all these measures perhaps will start showing on ground by the first quarter of 2025. This is also the time that China will come back from its New Year holidays. The restocking also usually begins from China in the first quarter of a new year. So that is what the street is anticipating. But for this right now, it also has to do with the dollar index holding just around at 100. And now we have seen the first rate cut of 50 basis point come in from the US Fed. And for the month of November, the probability is of a 55% probability of a 50 basis point rate cut and a 45 for a 25 basis point rate cut. So that is what the street is looking forward to now. Then it also has to do with the US presidential elections in the month of November and expectation that you could be hearing something from there as well. The markets also are looking at slightly better data from Europe, where the street has seen demand pick up. India infrastructure demand has been on the positive side. India has been importing a lot of metals as well. So those are some positives that you can see in metals. As said, September has been a great month for most of these metal prices, where we have seen nearly 15% of gains for copper, 9 to 10% of gains coming in for aluminum and zinc as well. It is a lot of data that the street will also watch out for. You have the Fed Powell testimony in this week, inflation, retail sales data coming in from Eurozone and Japan as well. So it is going to be a busy week in that sense. But at this point in time, markets playing on and holding on to those longs.
Thank you, Manisha, for that. Shilpa, any of the metal stocks that you like technically, where there is still some legs to this rally?
Yes, definitely. I believe NMDC is something that we can definitely look upon. NMDC above 250 will again see a very strong upside for targets of 270 to 280. Even on declines, now if the stock is, anywhere available around 240 to 238 zones, that also is a, good attractive level to go long.
Okay, attractive level to go long. Let's talk about the next sector, autos, basically. Tomorrow we will get essentially auto sales numbers for the month of September. And estimates suggest that volumes perhaps will be mixed. Nomura believes that higher discounts and advertising spends will continue for the industry. The index was down about 2%, I guess, in anticipation of that. And of course, with the broader market weaknesses well. Vinny is here with more. Vinny.
So yes, what we're expecting in terms of numbers for September this time, in terms of volumes, we could be seeing a bit of a mixed number coming in. Two-wheelers expected to do well, but four-wheelers there where we could be seeing some bit of a subdued demand and subdued volumes. Wholesale side, that would be seeing more of a benefit versus retail sales that we'll be seeing coming in because of the entire festive season. Let's not forget that rainfall, that's been normal as well, 6% ahead of the normal levels that you're watching out for. So rural sentiment, that has improved. That will support two-wheeler sales as well as in terms of sales that come in from the tractor front. UBS also highlighted about the higher discounting for two-wheelers, so that is something that one is watching out for, anything on those terms. And in terms of a note that came in from Nomura, they highlighted about commodity costs. Now this, for the month of September, commodity costs remain quite flattish, so not much of a worry in terms of pressures that we could see coming in on the margins for OEM companies. Two-wheelers likely to see double-digit growth in the industry level. Most of the companies are seeing healthy growth, except for when you're looking at it, Eicher Motors, Royal Enfield, that is expected to see a low single-digit growth of 4% on a year-on-year basis. But other than that, on a month-on-month basis, there's a double-digit growth aided by rural sentiment, which is much better than the urban demand. Other than that, in terms of CV demand, when you're looking at it, most of them are seeing a very subdued demand, low single-digit to maybe just in the range of high single-digit. The highest we are seeing is coming in from M&M Autos, that is 6%. But other than that, all of them are seeing a bit of a negative growth, and this is on a year-on-year basis. So pressure clearly there on the four-wheeler side, the passenger vehicle side, where we could be seeing a lot of pressure. Month-on-month basis, though, we are seeing an improvement there. Tractors, yes, owing to the good rainfall, we are going to see good demand there. M&M tractors, 5% growth is what we're expecting on a year-on-year basis, while escorts are 2% growth. And on a month-on-month basis, M&M tractors seeing a very, very sharp growth as well, 107% versus is what we're seeing, and escorts is expected to see 100% approximately growth as well.
Okay, thank you very much for that. Another mover today was Z Media, a small company, but stock was up nearly 10%, hitting fresh highs. In fact, in the last 6 trading sessions, that stock is up 70%. Vamakshi is here with more. Vamakshi.
Well, absolutely. The stock has been surging in trade over the last couple of sessions. In fact, in the month of September itself, the stock saw a surge of over 63%, which is the best ever monthly gain that the stock has seen on record. And this gain that we're seeing in this counter is also being supported by very strong volumes as well. Let's look at the average daily traded value over the last 3 days. It is at almost 153 crores. The free float market cap of the company is somewhere around 1,000 crores. So roughly around 15% of the company's free float market cap was traded on an average over the last 3 trading sessions. A potential trigger for this could be the fundraise that the company announced on Friday during market hours. The board approved a fundraise of up to 200 crores via issue of 13.33 crore warrants, and the warrant holders have 18 months to convert their warrants into equity shares. So that was one of the main triggers. But apart from that, it is also important to look at the kind of risk that the company has. Keep in mind that the company has been reporting a net loss every quarter since the quarter ended September 22. The debt for the company stands at around 135 odd crores as at 31st March 2024, out of which long-term debt is around 2.5 crores, but most of it is towards the short-term debt. But in comparison to this, the cash generated from operations in FY24 stood at only 62 crores, which is sharply low as compared to FY23. Another risk factor is that in July 2024, CareEdge has downgraded their rating on this counter. They've also changed their outlook on the long-term rating to negative from stable, citing moderation in operating and financial performances, and more importantly, continued uncertainty on the ability of the company to generate adequate cash flow from operations relative to the size of the debt repayment obligations in FY25. And lastly, another important risk factor is that the promoter holding in this company is very, very low at only 0.42%.
Thank you for that. Anand, comment on the entire auto space. So tomorrow we'll get the September sales numbers. Is there any play in the auto names? So two-wheelers have done, particularly Bajaj Auto has done very well. But passenger vehicles have been struggling a bit. The Vahan data also suggests that passenger vehicles have come under pressure in the recent month. Tractors are likely to do well based on the expectations. Anything that you like?
Well, this is a sector that has done very well, as you mentioned already, despite the fact that the volumes are still have to pick up. If you take the two-wheelers, for example, we are still about, I would imagine, about 10 lakhs less than what we were in 2018. Of course, there are segments within that which have done well, but overall, the volume still continues to remain somewhat tepid. The four-wheelers, the only thing that moves is the SUVs. Everything else has been very low. And as you mentioned, the market feedback is that discounts will be higher, as well as the fact that inventory build-up have been built up in the hope that the festive season will actually pick it up, but the early indications are not that bullish. So really speaking, you are not really looking at too much from the consumer side. Maybe the tractors, etc., may be a little better. SUVs certainly could do well. The fact that there will be a new listing will probably raise the valuations of some of the companies, but they are reasonably or more than reasonably pricing in whatever upside that there is from the performance at least.
Okay, thank you very much, Anand and Shilpa, for joining in. Need to get into a short break on that note. On the other side is our exclusive conversation with veteran investor Mark Mobius, his view on China from here on, and we'll also get you up to date on the key events to watch in tomorrow's trade.
investing.
Welcome back. You're watching Markets Forward, and it's time to get you all the top corporate voices that we had through the course of the day. So first up, and this is an exclusive, Yash Dahiya, Chairman and Group CEO of PB Fintech. He said the company plans to become a minority investor in a new healthcare venture. He also said PB Fintech may invest up to $100 million for a 20 to 35% stake in the new healthcare company, subject to the board giving its approval. He added the healthcare market is not a challenge due to rising demand. The company's foray into healthcare aims to bridge the trust gap between hospitals and insurance companies, particularly when it comes to addressing the challenge faced by many middle-class individuals who cannot afford a hospital bed for, 70,000-80,000 rupees a night.
Well, AstraZeneca's management told us that in the past 45 years, the company has introduced 50 new innovative medicines to India and aims to bring 15 new medications, having already received approval for 9. Management added that the recent sale of its Bengaluru site is part of a global strategic view. Partnership with Mankind Pharma seeks to expand access to asthma treatments. That essentially is AstraZeneca. Stock's been on a tear recently.
Meanwhile, Aadhar Housing Finance Management also reiterated their targets for FY25. They're talking about an AUM growth of 22 to 24%, and they also plan to maintain spreads at over 5%.
Well, to CNBC-TV18 exclusive, China may be in a new bull market. That is the word coming in from veteran investor Mark Mobius. He believes in the short run after the 25% kind of rally, there may be a bit of a pullback. That's temporary, but he's got strong views here. Listen in.
There'll be a correction, but I think we're now probably in a new bull market for China. In the last few days, China has outperformed the Indian market, but I think this is going to be temporary. There'll be a pullback. Nevertheless, it's a very, very positive situation, not only for China, but for all emerging markets. Why? Because, as you know, China represents such a big part of the index, of the emerging markets index. So you've seen China is now up tremendously, and that drags the emerging markets index as well, because India is such a big part of the index. Now, what happens? That helps all emerging markets, including India.
And speaking about India, he said that the Sensex may hit 1 lakh mark by the end of the year. However, he warns that too many people gambling on derivatives could tamper the markets if SEBI decides to intervene.
Now, the problem facing India, as SEBI has pointed out recently, is derivatives have become too big. There are too many people gambling on derivatives, and that could put a damper on the market. So we have to watch what measures SEBI is going to take in terms of the derivatives. When that happens, you'll probably see a downturn in the market, just temporary downturn, but you'll see some correction in India. Nevertheless, we are now on a long-term bull market for India, and I see the Sensex index going up to 100,000.
All right, this Mark Mobius, veteran investor there, talking about China and India. Well, before we wrap, let's quickly get you some of the key events to watch out for as we come back tomorrow. Vinny's here with that. Vinny, over to you.
So yes, tomorrow what we are watching over in the global market, there are 3 markets which are going to be shut: Hong Kong, China, as well as South Korea. There's a holiday there, so nothing much happening on that front. But USA, let's watch out for the jobs data. That's the job opening data that we're keeping an eye out on, as well as the S&P Global US Manufacturing PMI and the API crude oil stock data. That is a weekly data that comes in. That's important to keep an eye out on that. Moving on, we also have in the UK the PMI data that we're keeping an eye out on, as well as in the Eurozone, we're keeping an eye out on the CPI inflation. Global earnings that we should be watching out for, we have Nike that will be reporting its numbers, so keep an eye out on that. Domestic front, we have the HSBC manufacturing PMI data. So in India, that is important. Auto sales numbers for the month of September 2024, keeping an eye on that. And rate revisions and in the transaction fee for MCX BSE and NSE. That will be with effect from tomorrow. That's October 1st. So keep an eye out on that. Corporate action, IDFC and IDFC First Bank merger will be with effect from tomorrow, as well as there is a board meeting that will be happening from Godrej Properties as well as Reliance Infra for fundraising plans. So these are the key events that we're keeping an eye out on.
Thank you very much for that. And with that, it's a wrap on this edition of Markets Forward. Thank you for watching.
This takes me back to a conversation that I remember having with Mr. Murthy about starting Infosys. And I said, you know, like 7 of you, of course, he was the first among equals. But I said, how did you get a decision made? You know, because, and especially we are known as argumentative Indians for a particular reason. What was that like? And he told me, he said, look, you know, it was very simple. We had a sort of unwritten rule that in God we trust, everybody else brings data to the table. What was it like for you?
So we started with a smaller group. As Pramath was saying, Sanjeev, Pramath, myself, only a couple of others. It was a small group. And I think we spent a lot of time. So even as a precursor, we used to meet one Saturday a month at my old office, and we would have conversations. And this happened for a couple of years. So I think that helps with alignment. And then ultimately we said, we want to build a liberal arts and sciences, an interdisciplinary university. So everybody was aligned. This was going to be
and some people did get off the ship.
Yeah, because some people wanted something else. So we were very clear that Indian higher ed had become too specialized, that we needed a new institution that really provided breadth and depth, that was interdisciplinary and holistic, and that gave students choice. So we agreed on the principles. We agreed on some of the disciplines we would cover and what we wouldn't cover. And we also said that we have to hire the best in the world to come, and the pedagogy has to be exciting. We'll primarily be undergraduate to start with.
Right.
And then over time, we'll build out a very strong PhD program. We won't have a very big master's program. So I think we spent a lot of time. So we were aligned on what the broader purpose is, the vision, broadly what the strategy is. And then we were able to bring in many other people. So we also had a governance model where we said, even if you put in a lot of money, you still have one vote. And you operate through...
How did that conversation go?
Well, I think a lot of it depends on, you know, Sanjeev and I were initially the 2 largest contributors. And we'd said, we're going to do this. So it just became the norm. And we just went to everybody. When actually there was someone who wanted to put a lot of money in, wanted more than one vote, we turned that person down. So it's just a principle you stick to as you build it out. But we never realized when we started that we could end up becoming the largest, we think, collective philanthropy project in India.
Right.
We've raised about 3,500 crores, Shireen, in pure...
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. A sharp sell-off on Dalal Street as Sensex and Nifty record the biggest single-day fall in 2 months. 40 out of 50 Nifty stocks decline. Auto and metal stocks hit the hardest. Stocks in China mark the best single-day rally in 16 years as more stimulus measures lift sentiment. Veteran investor Mark Mobius says this probably is the start of a bull run in China, but also adds the outperformance could be temporary. SEBI board to meet today for the first time since the Hindenburg report leveled conflict of interest allegations against chairperson Madhvi Puri Buch. Sources say that the board is likely to take cognizance of the accusations, proposal of a new asset class and easier rights issue norms on the SEBI agenda. Anil Kumar Gupta, the Director General of GST Intelligence, says Infosys is yet to reply to the pre-show cause notice on alleged evasion. Says the agency's actions are as per law. Gupta says that general insurance companies owe about 20,000 crore rupees in GST for services extended to employees within special economic zone units. Calls off shore gaming websites a cause of concern. PB Fintech management clarifies on their proposed healthcare foray. Group CEO Yashish Dhaya tells CNBC-TV18 that they may look at a one-time investment of $100 million for a minority stake of 20 to 30% in a new company. Adds that they have no intention to make a recurring investment in the company. After months of mudslinging, Bharat Pay management buries the hatchet with former MD Ashneer Grover and signs an out-of-court settlement, decides to withdraw all cases against Grover and his wife. The settlement comes 10 days after Grover's brother-in-law was arrested by the police. Hezbollah will continue to fight even after the death of its leader Hassan Nasrallah, says the group's deputy leader, accuses Israel of targeting civilians in Lebanon. Explosions heard in Syria's capital Damascus amidst fears of a wider war in the region. The Supreme Court issues a contempt notice against Assam government for allegedly violating the court's order on halting bulldozer demolitions. Apex Court also pulls up the Andhra Pradesh government for making public statements on the alleged adulteration of laddus at the Tirupati temple when an investigation is still underway. And veteran actor Mithun Chakrabarti to be honoured with prestigious Dada Saheb Phalke Award, India's highest cinema honour. A Padma Bhushan recipient and two-time National Award winner, Mithun made his debut in the year 1976 with Mrinal Sen's Mrigya. He has appeared in over 350 movies across several languages. All right, let's start with the market action. A sharp sell-off on the last street with the Sensex and Nifty recording their worst single-day fall in 2 months. Sensex lost over 1,200 points, falling below the 85,000 mark. The Nifty lost over 350 points, dropping below 26,000. The sell-off was broad-based among the blue chips, but mid-caps fared slightly better, with the index ending lower by less than 0.5%. Surbhi Upadhyay is here with the market wrap.
Quite a weak start to the week here in India, where we were in stark contrast to our neighbors China, because that's the market where all the headlines are coming out from. A day of big large cap selling, and in fact India was only the second worst performer in Asia today after Japan. That market had a deep gash of nearly 5%. No real triggers really. The question continues to be whether this is just some nervousness, some profit taking, as the headlines and the attention and the focus shifts to China. Let's talk about this large cap selling. What happened on the Nifty was that, of course, we lost 26,000. The market was actually struggling by the afternoon to even hold on to 25,800. It slipped below that mark and then barely managed to close just around those levels. The fall, like I'm saying, led by large caps, and that included two of the strongest pillars of the market, which is banks and IT, and auto stocks saw a lot of profit taking as well. So let's see that in the stocks themselves. The key losers on the Nifty included Hero Moto, M&M, Bajaj Auto. There was Reliance, which saw 3% sort of a drop, ICICI Bank, HDFC Bank, SBI, Infosys, you name it, all the big boys, counting for the bears today and not really rooting for the bulls. The new entrants on the Nifty, they actually had a soft start as well. It was that kind of a day. Trent was down and BEL also closed out on the red side of the screen. No place to hide, barring metals. That strong trade continued from last week and today as well. A lot of the metal stocks on the Nifty and even beyond the Nifty managed decent gains, whether it was the likes of JSW Steel, Hindalco, even stocks like Nalco managed anywhere between 1 to 3%, and other gainers on the index actually included some FMCG names as the focus goes back to safety. So stocks like Britannia, Asian Paints, they had a little bit of buying come through, and NTPC is in focus ahead of the renewables IPO. Mid-caps now relatively better off because the mid-cap index was down about 0.5%, which was much better than the Nifty, but the advance decline ratio was really negative. 1,000 stocks advancing, 1,500 stocks declining. Some key movers and shakers included the likes of Tube Investments, Saregama, some PSUs like NMDC and Hoodco. They managed to buck the otherwise weak trend. And the ones which saw profit taking or saw cuts today included Keynes, Biocon, Macrotech, and of course PB Fintech, which is a stock that's been in focus ever since the company declared its intention of exploring a healthcare foray. Short point,
Big day of selling, and one needs to track FPI flows to see if there's any tactical move away, profit taking in India, and a shift of that money to China. But today, a day that actually belonged to the bears.
Right, thank you, Surbi, for that. Chinese stocks recorded their best single-day rally in 16 years after the country announced more stimulus measures amid an economic downturn. On Sunday, China's central bank announced a cut in lower mortgage rates for existing home loans by the end of October, providing support to the country's crisis-hit property market. Meanwhile, major cities like Guangzhou, Shanghai and Shenzhen unveiled measures to ease curbs on home purchases, boosting home buyer sentiment and pushing property stocks higher. And have the steps taken by China enough to stimulate the economy? What would it mean for India and other emerging markets? Prashant Nair is here with a deep dive on the issue. Prashant.
Well, thanks very much for that. 2 years now, it's been a slow and reluctant sort of easing which China has done, right? Last week's easing measures announced by the central bank in China and the surprise economy-focused September Politburo meeting seem to break away from the previous piecemeal style of policy easing and provide a sizable dose of policy stimulus that the market has long been hoping for. Markets have responded in a big way. From their recent lows, the Shanghai index is up 23%. The Hang Seng listed Chinese company index is up 26%. And the property index, the Shanghai property index, is up 36%. Remember, problems are in the property market, and that has seen a 36% rebound. Now, let's quickly run you through what China has done, right? It started with the central bank, that is PBOC, easing announcements on Tuesday, that is last Tuesday, 24th of September. Investors were not convinced. Markets wanted fiscal, not monetary. We'd had lots of monetary announcements, but they wanted fiscal. Guess what? The surprise Politburo meeting, the first Politburo meeting in the month of September in the last 5 years, by the way. That's how surprising it was. That was on the 26th of September, chaired by President Xi. And its read-through was that they were ready to do whatever was necessary, fiscal included, to support the economy. This is when investors started to come around. And at this point, in international media also started reporting that a fiscal package to the tune of between 2 and 3 trillion renminbi could be in the offing. Remember, there's nothing official yet on the size of this package, nothing confirmed yet. And then as we came back in on this Monday, we learned that on Sunday, that is over the weekend, we've seen more measures. Most significantly, 3 out of the 4 top-tier mega cities in China allowing big relaxations in terms of property purchases, lower sort of, cut in down payments and lower mortgage rates and sort of basically easing of rules. Well, the question is what from here? From a stock market standpoint, there are still skeptics. There are some who are turning a little more believing. That is because we've had 2 mega rallies in Chinese stocks since 2020 COVID period, which looked very big, right? To the tune of 50, 40%, but they eventually faded. This move so far is 26% from the lows. So the question becomes, does this have more legs? Looking at the past rallies, just purely looking at the numbers, there may be more to go, even if it doesn't sort of turn into a big structural turnaround. But, stocks will be wiser in hindsight. What can we expect in terms of things to watch out for? Some important events lined up. Tomorrow is China's National Day, and President Xi normally delivers a speech to the country. It's not expected to be an economic speech, but this time there's heightened attention whether he'll address the economy as well. Then on the 3rd of October, there's speculation that the Ministry of Finance in China might hold an ad hoc press conference to discuss the fiscal expenditure side as well. So this is the next steps in terms of what markets will watch out for. Remember, China enters a holiday period from tomorrow all the way till the 11th of September. So no sort of market response in that sense because they'll be shut, but headlines on the economy side will be closely watched. Back to you.
Right. Thank you, Prashant, for that update. And speaking of China, veteran investor Mark Mobius has underlined the possibility of a new bull market in China. He believes the rally in the Chinese markets will boost other emerging markets, including India. He expects the Sensex to hit the 1 lakh mark by the end of this year.
There'll be a correction, but I think we're now probably in a new bull market for China. the last few days, China has outperformed the Indian market, but I think this is going to be temporary. There'll be a pullback. Nevertheless, it's a very, very positive situation, not only for China, but for all emerging markets. Why? Because, as you know, China represents such a big part of the index, of the emerging markets index. So you've seen China is now up tremendously, and that drags the emerging markets index as well, because India is such a big part of the index. Now, what happens? That helps all emerging markets, including India.
And the big newsmaker of the day, head of India's GST enforcement body, Anil Kumar Gupta, has said that the decision to provide Infosys relief on its GST demand of 32,000 crore rupees can only be taken by the government. In an exclusive conversation with CNBC-TV18, he said that the matter would be examined once the IT giant replies to the pre-show cause notice.
So this demand is pending, and still, because Infosys is to file a reply. Infosys is yet to file a reply for this remaining 4 years. Once they file the reply, only then we'll examine, because it's a pre-show cause notice. In the GST law, for issuing a show cause notice, you issue a pre-show cause notice and then give an opportunity to the company or the taxpayer to file a reply. Once the Infosys files the reply, we'll examine, then accordingly decide on the matter. Whether our case is strong or not, that I will say we only book cases which are legally sustainable and as per the GST law prevalent at that time. So whatever DGI has done, it is as per law. There is nothing wrong in that. By bringing clarity and transparency in the online gaming taxability since October 2023, the revenue of the government has increased 4 to 5 times. Earlier we were collecting about 200 to 250 crores per month. Now roughly about 1300 to 1500 crores we are collecting. Offshore online gaming, they were, as per the amendment, they were also required, once they are providing any taxable services in India, they were also required to take registration, simple registration in India. But none of the offshore gaming companies have taken registration so far. It's about a year now since this amendment came, and it's a big challenge for us to really investigate all those offshore gaming companies.
Policy Bazaar's parent company, PB Fintech, has clarified that it will be a minority investor in the company through which its healthcare foray will happen. Speaking to CNBC-TV18, Group CEO Yashish Dhaya said that PB Fintech may invest up to $100 million in the new healthcare company for a 20 to 30% stake subject to board approval. He added that it will be a one-time investment. The venture will aim to address the trust gap between hospitals, insurance companies and patients.
PB Fintech is looking to make an investment subject to board approval in a separate venture, which actually is not a PB Fintech subsidiary. PB Fintech would probably be a minority investor between 20 to 35% equity holding, right? And this venture, for lack of a better word, let's just call it XYZ. XYZ has its own life beyond that, and PB Fintech's liability is limited to that first investment. It does not have any compulsion to keep investing into the future, right? And all this is subject to board approval.
Right, and an employee of HCL Tech passed away after suffering a cardiac arrest at the company's Nagpur office. The 40-year-old was found unresponsive in the office washroom. He was then rushed to AIIMS Nagpur, where he was pronounced dead upon arrival. HCL Tech has said that they provided the employee immediate emergency care in the company's clinic and transported him to the hospital. The firm also mentioned it's offering support to the employee's family. All right, let's take a short break. But coming up next, after months of mudslinging, BharatPe management buries the hatchet with former MD Ashneer Grover and signs an out-of-court settlement. We bring you the details when we return.
We've had people like HDFC Group to Axis Bank to the Bajaj Group support Ashoka at scale. Individuals, RK Damani, Mr. Jhunjhunwala, Rakesh Jhunjhunwala, many others have contributed. 200 founders have contributed towards building this institution because they believe it's an important project for the country, that India needs a new institution. That's a new form of education for India.
What is the Ashoka differentiator?
Where when we first dreamt of Ashoka, we had no idea that students from 40 countries would be applying to our university. Now our aspiration is, why shouldn't it be one of the best in the world?
We are the best option for anyone wanting to do high quality scholarly academic work in India.
You firmly believed in was that this must be an institute that's also inclusive.
We are perceived as being elite. I think that's largely because we do get very good students, and some of them from the very best schools. So I do think we're serving the country in one way, which is we're preventing the dollars from going outside. Individuals, R.K. Damani, Jhunjhunwala, Rakesh Jhunjhunwala, many others have contributed. 200 founders have contributed towards building this institution because they believe it's an important project for the country.
So we see Ashoka's mission to really be able to serve the country in solving these problems with the cadre of young people that we are feeding into the workplace.
If you want to maximize EBITDA, you'll be a teaching shop. You'll ignore, why would you run a PhD program? It's pure cost, no revenue. Right?
So how do you look at ROI then as far as Ashoka is concerned?
It's impact. We eventually will term out, and alumni, once they have matured, will take our place. We have no owner. There's no one family that backs this place.
The myth is that, if you study history or philosophy or political science or English literature, where will you get a job?
I'm a classic example of that. I studied philosophy and guess where I am. So
we have students who've turned down Berkeley, who've turned down Duke, Urbana-Champaign, London School of Economics, to come to Ashoka.
The valuations are berserk over there. I mean, again, great companies, but and again, I usually don't talk about stocks, but just to put some sense. And again, don't get me wrong, I'm not disputing valuations or anything, but just to give the Infosys example. Let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. Let's say it's a 30p by then because we're a fairly large company. So it needs a $4 billion PAT, profit after tax.
So when we say melt up, I just want to sort of finish that point. It usually we are talking about like a frenzied move in the very short term, but that's not what you mean. You think
I mean it makes a major long-term top, which is not a great thing. So I mean it's great that we are going up on a wall of worries in a way that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets.
Welcome back. Fintech firm BharatPe has settled a 2-year legal dispute with former managing director Ashneer Grover. In a statement, the company has decided to withdraw all cases against him and his wife. This settlement has come 10 days after Grover's brother-in-law was arrested by the police. Rachna Dhandrajani joins us with the details. Rachna, is this an end to the BharatPe saga?
Right. As you said, it is after months of public mudslinging allegations and counter-allegations, the BharatPe management has buried the hatchet with former managing director Ashneer Grover. Under the terms of the settlement, certain shares held by Ashneer will be transferred to the Resilient Growth Trust, which is the parent company of BharatPe, while his remaining shares will be managed by his family trust. Both the parties have agreed to drop all ongoing legal cases against each other, and so BharatPe, in an official statement, said that Ashneer Grover will not be associated with BharatPe in any capacity anymore. It all started with BharatPe's parent company Resilient Innovations alleging discrepancies in vendor invoices and claimed that some HR consultancies associated with the company had been set up to siphon off funds. BharatPe had in fact filed a criminal complaint in December 2022 against Ashneer Grover, his wife Madhuri Jain and her family, including her father, brother and brother-in-law. An FIR was also filed by the Economic Offences Wing of Delhi Police in May 2023 for this financial misconduct of about 81 crore rupees. In November 2023, a lookout circular was issued against both Ashneer Grover and Madhuri Jain, preventing them from travelling abroad. And the couple were then stopped at Delhi's Indira Gandhi National Airport last year while attempting to fly to New York due to financial misconduct allegations. Just last month, the Economic Offences Wing of the Delhi Police made its first arrest in the case, Amit Kumar Bhansal, who was arrested for being one of the members of the non-existing firms that had received payments of rupees 72 crore from the then directors of BharatPe between 2019 and 2021. And just 10 days ago, Deepak Gupta, who's Ashneer and Madhuri's brother-in-law, was also arrested. And now both the sides have settled the case. So what happens to BharatPe now? The company's three co-founders held a sizable shareholding. Ashneer held over 8%, Shashwat Nakrani held 4.8% and Bhavik Koladia held about 2.3%. Only Shashwat and Bhavik are now with the company's management. Ashneer had accused Bhavik Koladia of data theft. Bhavik had also transferred some shares to Ashneer, for which he claims he never got paid. We've also learned from our sources that as a part of this settlement, those shares will now be transferred back to Bhavik, increasing his stake in the company to over 4%. Coupled with the surrender and return of the shares, Ashneer will now be left with 4% of the company, which will then be transferred to his family trust.
Right, thank you Rachna for that comprehensive update. Moving on, the Supreme Court has issued a contempt notice against Assam government for allegedly violating the court's order on halting bulldozer demolitions. The apex court has also pulled up the Andhra Pradesh government for making public statements on the alleged adulteration of laddus at the Tirupati temple. Ashmit Kumar is here with a wrap on all these proceedings in the apex court.
Well, two state governments there on the receiving end. One is the state of Assam, the other one the state of Andhra Pradesh. We'll come to them one by one. First, as far as Assam is concerned, bear in mind that the apex court has been hearing matters with respect to bulldozer demolitions being used to punish those accused. Now, it is in response to that the apex court in the previous hearing had directed for a complete halt on demolitions across the country. That order has been violated, or so is the claim made in a petition made by 47 residents of Assam, who pointed out that despite the apex court orders, despite the assurance given by the government of Assam that there will be no demolitions, the demolitions have gone ahead in the state. That is something that the apex court has taken note of, and number one, has issued a contempt notice to the government of Assam. The government of Assam will have to respond. Bear in mind, this case will get taken up for further hearing tomorrow. Not just that, the other high voltage matter that was up for consideration was the Tirupati Prasadam matter. Here again, the apex court took a very dim view of Chandrababu Naidu making public comments with respect to contamination of the Prasadam despite not having the facts available with him. The Supreme Court observed that there is no evidence to suggest that there was contamination by way of animal fat. There was also no evidence to suggest that it was the contaminated ghee that was used for making the Tirupati Prasadam. And minus those facts, the constitutional position holder, like the Chief Minister of the state, making such remarks is not in keeping with the principles, is not consistent, is not something that is desirable and plays with the sentiments of crores and crores of people. So the apex court now deciding whether or not the Andhra Pradesh government will need to investigate this, or whether it will be an independent investigation led by the apex court. Back to you.
All right, thank you Ashmit for that. Moving on, veteran actor Mithun Chakrabarti will be honoured with the prestigious Dada Saheb Phalke Award, which is India's highest honour in the field of cinema. A Padma Bhushan recipient and a two-time National Award winner, Mithun made his debut in the year 1976 with Mrinal Sen's Mrigya. He has since appeared in over 350 movies across several languages. And with that, it's a wrap for this edition of Business 360. News and updates continue right here on CNBC-TV18.
Periods like that. And this seems to be more like the 90s bull market, where small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. and B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up where the entire market goes up 10x in a decade. And then you don't see that prices for, maybe next 10 or 20 years. So I'm hoping we don't get a melt up and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4 level supply. The big guys haven't yet come. And in the bigger ones, if I take the top 10 companies, no one is supplied. Having said that, the owners of those companies, whether it's BAT selling down ITC or Singtel selling down Bharti, that's happened. But it's not like the Reliances or the Tatas or someone has come with massive issuances, which I think is around the corner. It should come.
I mean, bankers we speak to tell that over the next 12 to 18 months, about $25 billion worth of IPOs should happen. But that is, I'm not sure how much of the...
So, Prashant, 25 also, I'm saying, is a small number now. It's a $5 trillion market cap. So if you don't do 50 billion, is 1%. So issuance is, the government ought to be doing 25 billion. The larger groups easily can take 25 to 50 billion. And this is combination of primary and, of course, QIPs and so on. We've seen promoter selling, we've seen PE selling, we've seen MNC strategic selling, and it's gone from across the world, right? If GE of US has sold, Whirlpool has sold, BAT has sold, Sumitomo from Japan has sold, Singtel has sold, and now Hyundai is approaching the market. So all these chaps are getting it right. But we still haven't come and raised the money.
And that will happen according to you?
I think it's inevitable. I mean, that's what capitalism is, right? That demand for paper will create the supply.
And we're a long way off from that climax or whatever.
I hope I'm not proven wrong next week, but I think this has legs to go.
This has legs to go. PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But people, defense, etc., right? That part, it looks like we're starting to rotate, people are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done, or is just like a pause and refresh case here?
Again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate. And then the excesses which happened in that period made them complete pariahs. So if 4 years ago, we were on a show and Ramesh and I remember, we would talk about PSUs and everyone was like sniggering, like, what's wrong with these chaps? But because the correction had been so steep, that it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return, and the what so-called poorest PSU may give you the best return. So it was a mean reversion trade which happened, and of course all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change, but you went from terrible to being good. So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically these are not high return areas. By definition, if you make 25%.
Presented by Policy Bazaar.
The Policy Bazaar Insurance Show.
In the last few months, headlines around the health insurance sector have been dominated by the call to reduce tax on insurance premiums. But during the same time, there's a lot which has happened from the side of government on policy front, from the side of regulator on the regulatory front, and from insurers and distributors on the implementation front, all being done to make health and health insurance ecosystem more inclusive. In this episode of the Policy Bazaar Insurance Show, we put the spotlight on how health and health insurance landscape is changing and how the government, regulator, and insurers and distributors are contributing towards this change. And most importantly, how effectively does it tick the 3 A's of health insurance: affordability, accessibility, and availability. We will be joined by our top panel, Alok Saxena, retired Additional Secretary Health, Government of India, and Executive Director Healthcare at Rodiak Consultants. Also, Girija Subramaniam, the Chairman and Managing Director at New India Assurance, and Yashish Dahiya, Chairman and Group CEO at PB Fintech. Gentlemen, thank you so much for joining us on this special edition today. We've suddenly seen so much activity in the past few days, which is related to the sector. And starting with you, Mr. Saxena, I want to start with a topic that is very much related to those activities. If one has to look at the economic survey which was presented, that spoke about the per capita expenditure towards healthcare to be about 4,500 rupees. But more importantly, it spoke about a number that is 50% of the total healthcare expenditure still happening out of pocket. Ayushman Bharat, as the government's flagship scheme, went miles in reducing that number. It successfully did so. But now when we are here at that 50% mark, what should be done in terms of a new approach, a new model of Ayushman Bharat scheme, so that now the next few steps can be taken and this number can be reduced further? And what are those few key effective areas where the new model or the 2.0 model should really target?
Thanks, Yash. Actually, I'll begin with giving you some fresh statistics, which I culled out. It's all in public domain. So we have this National Health Accounts estimates for India. And the figures that you're quoting are the published figures of 1920.
Correct.
Thereafter, there have been provisional figures, estimates for 2021 and 2022, which obviously got delayed because of COVID. And as per the latest estimates, out-of-pocket expenditure, that is OOPS, have come down to 39.4%.
Okay.
So, and that is from 62.6% in 14-15. So that's a huge drop. And of course, Ayushman Bharat Pradhan Mantri Jan Arogya Yojana, that was largely responsible for it. Also, the second pillar of the Ayushman Bharat scheme, which is the health and wellness centers, which takes care of the primary health care, is also responsible. What Pradhan Mantri Jan Arogya Yojana did, it took care of the most vulnerable and disempowered sections of the society, and at that time almost 50 crore individuals at that time. So it was said that, what about the missing middle? So this present proposal, which has now been approved by the cabinet, takes care of almost 6 crore individuals, irrespective of the income criteria, who are 70 plus. So the most vulnerable segment of the missing middle is now taken care of. They will have a cover of, on family floater basis, 5 lakh for hospitalization. And those who are existing PMJY covered families, they will get an additional top up of 5 lakh for the senior citizens above 70 in those families.
Girija ma'am, I want to come to you with another question and another issue that time and again we've spoken about the Ayushman Bharat scheme. Parallelly to the scheme, a lot of states are running their own insurance schemes, either through trust model largely. What I want to understand from you is that does that significantly create discrepancies in the flagship Ayushman Bharat scheme? Does that lead to fragmentation of benefits that a policyholder gets? Just an additional question to that, is it wrong if a policyholder is either enrolled with the state-sponsored scheme or Ayushman Bharat scheme individually? Does it sort of, impact the benefits that he gets out of these two schemes? And what should he choose in a situation like that?
Yeah, ideally, Ayushman Bharat as a scheme is either state-sponsored schemes also are similar to the Ayushman Bharat. Only there are a few differences from one state to the other. Like we are working in the Rajasthan state government. Correct. We handle the entire Rajasthan state government Ayushman Bharat the scheme, and there actually we have the differences that above the poverty line people are also covered in that scheme, and that is the difference that is there, and such differences exist from one state to the other. But the point is that we are happy that in one way or the other the scheme is reaching out across the length and breadth. So it is effective, but it definitely can be more effective if we are able to see that the insurance model is employed, because there we are able to get the hospitals onboarded.
Yashish, I want to ask one question to you. For someone, and in this case I speak about Policy Bazaar, where you get more than 50%, more than half of your revenue from tier 2 and tier 3 areas, how do you sort of propagate awareness in these tier 2 and tier 3 regions? So for someone who's commercially also making sense in tier 2, tier 3 areas and wants to see more headroom in those areas. How do you take forward awareness about health insurance in these sections of geographies?
See, the amazing thing about India is the internet and the television is actually everywhere. 70% of the total sales now come from tier 2 and tier 3.
Correct.
I think today, if I think about health insurance, broadly, the awareness of the product is there. So people know there is something called health insurance, where if you pay a premium, if you go to a hospital, your claim can, the company could pay for the claims.
Correct.
I think people still struggle with confidence and trust because that process of getting a claim is still cumbersome. And I think the technology chassis that Ayushman Bharat is bringing on board can be a big saving force there, because that chassis can be used by everybody. But at a fundamental level, why is there, push and pull at the point of claim? It's at a fundamental level a lack of trust. And what is the lack of trust? Did the person have diabetes but did not declare it? Did the person have a particular, was the person a smoker, drinking a lot but did not declare it? Was there some disease that already existed? Did the person already suffer from cancer but had not declared? That is one side of things. The second side of things is, was hospitalization required at all? It's a dengue case, but because there is insurance, he's just admitted. See, if you think about the insurance company, it on one side has consumers, on the other side it has the hospitals.
Correct.
And I think between all three of these, there is a trust deficit, which to a large extent data and technology can solve, and to some extent, regulation solves. But I fundamentally believe at some level, competition will solve that. Because without competition, the reality never kicks in. And, so I guess, I think let things play out and kind of, on the whole, the amazing news is there is a segment of population which is roughly half. In my opinion, it's about 60 to 70% it can be. But today it's already 50%, which is a huge amount, which is being covered one way or the other by the government. I think the person we have to worry about as the private sector, because we're in the private sector, is people earning more than 5 lakh rupees a year. That segment is also in stress, right? There is a good 25% of population that's in that segment. Now, what is special about these people? These people are broadly earning about 3 to 4 times the national average.
Correct.
Now, this is a world over thing. It's not to do with India. Wherever in the world somebody earns more than 4 times the national average, they have to take care of themselves. They no longer rely on government education, government healthcare,
infrastructure facilities,
and that's even in the most wealthiest part of the world. That's still true, right? So I think to some extent these people have to fend for themselves, and thus they need that education around insurance, because that is the one way in which they can actually afford healthcare. Otherwise, healthcare is too expensive.
Too expensive. And as you said, I mean, the problem right now would be to make that journey from trust deficit to a point where we can strengthen the trust enough between the three stakeholders. And I think one very right thing that you said, competition could be one thing amongst not just hospitals, but insurance companies also, so that everyone does their bit to bring that trust and strengthening of that trust. Well, it's been a list of changes from the government, to make India's healthcare ecosystem more inclusive. But in a country like India, it's never enough and only expected to continue on this path. But at this point, let's take a very short break. Lots more on the other side of this very short break. Do stay tuned.
The Policy Bazaar Insurance Show.
Infrastructure business, the cost to the consumer, which is the average public, is going to be too high. So your money made is really on leverage, and therefore the return on equity comes in that business. So, and people are shy of doing leverage after again the last cycle. And the flip of it, to just complete, the leadership of the last cycle was all the high quality businesses in the last decade, which were all getting re-rated. Asian Paints, Page Industries, Kotak Bank,
consumers, retail,
even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected. That Kotak, HDFC haven't performed for the last 5 years. Again, great companies. But it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move And there are memes on HDFC doing the round the way it was for ITC.
ITC.
And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
so things like that tend to happen. I can't forecast what will happen in...
But you're very bullish on the financialization theme.
I am very bullish.
The magic one that everybody is talking about at this point in time is AI and what AI can do, and specifically generative AI. How do you see that linking back to the efforts on the healthcare side, the innovations that you're working on? I mean, how transformative is AI likely to be, or are we on the cusp of seeing that kind of transformation?
Usually when you get new technology, it's applied in the rich world for those who are well off. And what we'd like to do this time with AI is make sure, both in terms of discovering new interventions for nutrition or vaccines or drugs, and helping give people health advice, in voice in their native language, that we actually bring these AI advances to those most in need. I mean, after all, where's the greatest shortage of doctors? It's in developing countries. And so the foundation is leading the way by giving grants to various people and pushing this forward. Even for a topic as complex as nutrition, the AIs are going to help us understand things faster than we would without it.
If you could do a startup all over again and focus on AI, what would the niche be that you would like?
The Policy Bazaar Insurance Show.
Welcome back to the Policy Bazaar Insurance Show. Now we are joined by a very special guest, Dr. Naresh Trehan, CMD at Global Health. Hospitals are an equally important stakeholder to India's health ecosystem, and the views from Dr. Trehan will be very crucial today. Sir, I want to understand from you, hospitals as we see it today have become a very, very strong stakeholder when it comes to India's health ecosystem and directly impacting the health insurance sector as well. What I want to understand from you is that how can hospitals make the entire process from admission of the patients to the treatment, to the discharge and the settlement of claims, most importantly, a completely hassle-free process for any person who gets admitted to the hospital? And more importantly, what do you require from your partner stakeholder, that is the health insurance companies, in making sure that this process is seamless?
So as has been discussed by the panel, there are three participants in this whole cycle. And the center point is the patient who needs to access healthcare. Now, we are the providers, and then insurance is the enabler for it. Worldwide, we know that there has to be a safety net for every individual in any country. As far as India is concerned, we've had this mixed system where a government has taken incremental responsibility over the years to cover more and more percentage of our population, so that the people who were left out of the whole safety net have been including, and that's a remarkable thing to have happened. Now the question is, not only is the fact that you need coverage, you also need the providers, because the demand of the population will keep increasing, especially as our population ages. It becomes more and more critical that we are able to provide them the service. But the center point here is, what is the cost? What are the things that we can do to make the patient who's accessing healthcare get the best possible treatment, get the best possible discharge process, and try to do it, make it affordable across the board, so that the premiums from the insurance companies don't go up that much. So one is to understand that there is a need for actual costing that must be done for every procedure. That is one, because any responsibility that is put on the providers has to be in a measured form, in the sense that unless you do the costing, you will not be able to come up with a fair price of what it takes to deliver the service. Second is the fact that insurance premiums, because when you're talking about private health insurance, the insurance premiums will also have to be kept under control. Now, the more efficiency we add into this whole system of the provider, of the insurance company, and the fact that the responsibility along with it of being honest upfront. So we all must understand our responsibility. We do not, the providers have to be very strict, even if the patient wants us to do any change any history or anything. We should never participate in that. One of the big pinch points that patients experience is the long waiting time between discharge summary being sent to the insurance companies and the actual revert back and patient leaving. So we've been working tirelessly on this with the insurance companies to say how can we make it more seamless, and the trust, as the trust level keeps going up, we will see that the patient can get a much better service.
I want to come to Girija ma'am with one question, and that is about cashless everywhere. Very recently, the industry took it upon itself to make cashless everywhere possible for policyholders in case of settlement of claims. If cashless everywhere is embedded in the regulations itself, through force, through the regulator, do you think that will lead to a better enforcement and help policyholders in what it intends to do finally?
Yeah, basically the initiative, cashless initiative, is a very welcome step, and I think this is something the entire industry is working on. It has given us a platform to prove that as an industry we can work in unison and develop a customer experience that will be uniform across the country at various hospitals. Definitely there will be a future where cashless everywhere will be a reality, and customers across various insurance companies will have uniform costs, uniform experience across hospitals.
Yashish, I want to speak to you about something which happened very recently, about the master circular also, which the regulator issued. Some very interesting points under that thing. Request for cashless to be approved within 1 hour, discharge to happen within 3 hours. These are really time-bound ways in which a policyholder who's already quite distressed at that point of time can be helped in ensuring that the process is smooth. How do we break this particular cycle that we have in our hands?
I'll try to give you the answer in what I think is going to play out in the next 5-10 years. Either some hospitals have to seriously get involved in insurance, or some insurers have to get seriously involved in hospitals. Because that is what will create the benchmarks. Okay. Because the only person you can always trust is yourself. The moment you're dealing with a second party, there's always different incentives, different alignments. One thing I wanted to mention, because this is the part that people across the world don't understand when they think of India. Nowhere else does an open architecture insurance scheme ever work the way it works in India. Nowhere else in the world can you go to any hospital whatsoever and just walk in and get treated. Does not exist. It's always closed loop. You cannot just take your insurance policy and go everywhere and get treated. It just doesn't work. Open architecture is just too expensive.
Yashish, one question to you. Another very interesting regulation that we are looking at is going to be the National Claims Exchange, right? So much data, so much data. Do you think this could really plug the problem of claim frauds, because you would know exactly what the person's done, if there's any pre-existing illness, if he's taken claims before, where was he treated, what was the treatment, what was the cost? I mean, you can imagine the kind of data that you would have.
Absolutely. So first of all, yes, but I would also say what already exists. All claims data already exists. So for example, we've been selling health insurance for 17 years.
Correct.
For every one of my customers, I know what claims they've had, right? So what their bill was, what claim they had, for what disease, what was rejected, what was accepted. This already exists with the IIB. I think it is about using that data more. What is missing is what existed before the person had insurance.
Correct.
I think that coming in with the NHA data would be very powerful. So far, that is missing. So far, if before you bought, so I don't have an insurance policy today in India, right? So nobody really knows anything about me in terms of, did I actually go to hospital yesterday? What did I get checked for? Do I have a disease? Nobody knows that. I think that's the conundrum. And the second part, I just want to mention on this. I think people do not fully appreciate just how difficult writing these health insurance policies is. And many times people, today you buy a corporate health policy. Next year, you may not have one. And the coverage is very limited. If you change your job, you may not have one. If you gather a disease in the middle, you will perhaps not get a new policy because no other company is going to take you on.
Correct.
Right? Lifetime renewability. Please appreciate, this is only available in very, very few countries in the world. There are countries where the entire insurance sector has gone bankrupt on this one clause, lifelong renewability. So it's a very big thing that already exists. The Indian regulation from a health insurance perspective, one of the friendliest regulation in the world from a consumer perspective. I think where we are missing is the trust element. And that part
needs to be
solved. As I said, tech will solve, but to some extent, overreaching into each other's areas will also solve.
Mr. Saxena, I want to come with you with a very interesting question, which could be a great idea if it's looked at seriously. And that is with respect to having your employer insurance policy to continue after your employment as well. It's just a thought at this point of time. Assuming you work for a private sector, you have the employer giving you an insurance policy, you go out of service at one particular point in your age, why can I not continue to contribute towards that health insurance policy that I had out of my savings rather than buying a new policy altogether after that period? Second part to that question, if one has to extend it to government employees and PSU employees as well. Government employees, of course, if there's a pension element, why can the pension not be given or the benefits to that particular individual not be given after deducting that little premium towards the health insurance policy? Same with PSU, contributing a part of your salary or your savings towards that policy and continue that policy till the point that you want to.
So for the central government employees, it's already happening. So when a central government employee retires, they have to pay a lifetime subscription for the CGHS scheme, which takes care of OPD as well as IPD expenditure for the rest of their life, the spouse and the dependents as well. So that's there. And this is a good idea. I mean, in the government, we are practicing it since 1954. Correct. So this can be, rolled out in PSUs, in the state PSUs, in municipal bodies, where, age of retirement means that your cover gets ended. So I think that's something very eminently doable, and I don't see any problems there. But simultaneously, we need to give focus on primary care, because health works on this hierarchy of primary, secondary, and tertiary. So I think these are the things. But yes, for a person who's retiring, it's important that we should allow him or her to carry the policy forward.
With that, it's curtains down on this episode of the Policy Bazaar Insurance Show. We come back with a fresh new edition very soon on another very interesting topic around insurance. Till then, keep watching CNBC TV18.
The Policy Bazaar Insurance Show.
Presented by Policy Bazaar.
Well, if you could go back to my school days even, and then I was saying, hey, how do we make software as smart as human beings? And I, was constantly thinking about it. I underestimated how long it would take, but here we are on the cusp of that. And so now the lens I apply is the lens of the foundation. If I was somebody young, sure, I'd compete with, OpenAI and all these people. But, now I'm in the stage of saying, how do I help other people work in AI apply it to those most in need?
As far as India is concerned, the role and relevance and the significance of India, especially as far as the foundation is concerned, and what you're hoping to do on the innovation side.
So India's the country the foundation does the most in. Other than the US, that's our largest group. We have a great team there. We work a lot with the national government and many of the state governments. And not only do we see in areas like nutrition or using ultrasound to detect a difficult pregnancy, we're doing a lot of studies with our partners there, which will have a benefit for India, but also because the digital infrastructure in India is so strong, we can try things out there and take them to other countries. You know, the digital infrastructure itself is a great example where, you know, the leadership has laid that foundation, and now both India and Gates Foundation are going to Africa and other places and saying, hey, you should do the same thing.
Was there a specific learning from this trip to India for you?
Well, it was pretty amazing in Odisha to see how the digital approach was connecting with farmers, that they had categorized which farmers were in which location, what were they growing. And so when they would see crop disease outbreak, they could notify them. If they saw weather coming, they could notify those farmers. If the market prices were changing, they could help guide the farmers. And so the digital revolution, bringing that into that agricultural sector, that was the first time I saw that at work. And you know, it's being scaled up in India. Now we'll take it to the rest of the world.
News which just came out, a government-to-government deal between US and India to set up a semiconductor fab unit in the country.
Right.
There are elements of technology transfer, etc. That's the cutting edge semiconductor, and sort of plans to localize production.
Right.
I just wanted your thoughts.
I think it's great. I would love to, you know, India's quote a non-aligned nation, and I don't think we should be asking to align, but I think it's great that we're reaching out to each other, helping each other, investing in each other, and I would love to see far more of that. And this has two elements. One is the national security part, which of course all countries have an interest in. And the second is just, you know, better economical.
Hello and welcome to News Center. I'm Parikshit Luthra. Israel stepped up its offensive in Lebanon over the weekend, continuing their bombardment across the country. Israel struck central Beirut for the first time since 2006. 3 leaders of the Popular Front for the Liberation of Palestine were killed. Hamas claimed that its top leader in Lebanon had been killed as well. So far, more than 100 people have been killed in the last 24 hours, taking the death toll to over 1,000 in 2 weeks. Iran-backed militant group Hezbollah has confirmed that its leader Syed Hassan Nasrallah, along with 20 other members, was killed in an Israeli airstrike over the weekend. The group has vowed to continue its war against Israel. In a statement, Israeli Prime Minister Benjamin Netanyahu has said that Israel has settled the score with Nasrallah's assassination in a Beirut airstrike. The Israeli Air Force has also targeted a power plant and seaport in the Yemeni port cities, killing at least 4 people. Meanwhile, reports have said that blasts were heard in Syria's capital, Damascus. As per the UN, around 1 lakh people have fled Lebanon since the latest escalation in the war. US President Joe Biden has said that a broader war in the Middle East has to be averted to prevent further escalation. Joining me now to take this forward is Faraz Saib, Deputy Chief of Mission at Israel Embassy in India. Thank you very much for joining us on the program, on our show News Center. Let me begin by asking you, how does the death of Hassan Nasrallah actually reduce Hezbollah's ability to carry out attacks against Israel?
I think that targeting the leader of a terror organization, not a militant group, a terror organization, it's something that contributes to the stabilization of the entire region. The question here is what the Lebanese state, the Lebanese army will do in the next step. This is actually what's important now. The keys are in the hand of the Lebanese state. If they step forward and take control in this gap that Hezbollah has left, they will take responsibility. They will apply their sovereignty on the ground. I think that we will see a de-escalation, a fast de-escalation of the situation. Of course, if Hezbollah will continue, as you said, will continue with firing missiles and threatening our civilians, of course, the situation might even go into a further escalations, and we don't want that. We want our more than 60,000 civilians go back to their homes in the north. We want that the terror organization will be pushed far away from our borders, and I really hope that this is where we are heading now.
Right. If we were to ask you, can we assume that Israel's operation against Hezbollah, considering that the Prime Minister of Israel has said that they have settled scores with the Hezbollah chief Nasrallah, now that he has said this, will the operation against Hezbollah in Lebanon continue?
As I said, it depends on it depends on two players. The first player is, as I said, is the Lebanese state, the Lebanese army. If the Lebanese army take control and take the borderline, and they will go to the border with Israel, and they will be responsible for the security and the safety of Lebanon, then there's no need for any further escalation or for any continuation of this campaign, of this war. The second player is Iran. The question is Iran going to be pressured by the international community to stop the escalation from their side? As we know, they still directing and financing the Houthis, Hezbollah, of course, Hamas, the militias in Iraq. So those are the two players that can de-escalate the situation. Israel will react to any aggression against our borders and against our civilians.
Right. We're just a week away from the first anniversary of the 7th October attack on Israel and its people, where more than 800 Israelis were killed. More than 250 were taken hostage as well, including foreigners. What kind of a message do we expect Prime Minister Netanyahu to deliver to the world, not just the people of Israel, but to the world ahead of that anniversary?
The 7th of October was a huge tragedy. It's a trauma for the Israeli civilian, for the Israeli public. 800 civilians, that's right, but we're talking about more than 1,200 Israelis who were butchered and killed and raped, and of course more than 250 hostages. Don't forget that we still have more than 100 hostages held by Hamas in Gaza, 101 hostages, and we want them back. And I think that the message of the Israeli government, Prime Minister Netanyahu, is very clear. He said it in at the United Nations. First of all, we want our hostages back. This is the first thing. We want terror organizations to stop getting financed and directed by Iran and others. And I think that the future has two possibilities. And this is what Prime Minister Netanyahu said. There's the normalization and connectivity possibility. And this is what we want, connecting East and West via Israel, via the Gulf. Of course, India has a huge part in this. And the other option is the, let's call it, the axis of evil option. And this is Iran continue attacking Israel via Iraq, Syria, Lebanon, and from the south via the Houthis in Yemen. We really hope that the first option will be the next step to stabilize the region of West Asia and, of course, connect East and West together.
Right. I would also like to ask you about the possibility of a ceasefire in Gaza. The US is still hopeful that there is a room for negotiations, but many experts say with the attacks that have been carried out against the Hezbollah, against Hamas over the last 7 to 8 days, it seems that there is no place for negotiation anymore. How would you react to those reports?
Negotiation is always an option. The question, what is the first step? And the first step that we are demanding is our hostages back, our civilians back, our young and elderly and 2 kids, 2 babies that are still there, the Bibas family, we want them back. The moment that we know that they are back, there's a huge range of possibilities, negotiation, the rebuilding of Gaza, and talk about the day after, and normalization, and all those things will happen the moment that we will have our civilians hostages back, and the moment that we have our not only civilian hostages, of course, all the 101 hostages, we want them back, that we know that Hamas doesn't control Gaza anymore, that moderate leadership will control the Palestinian society, Palestinian community. We know that on our northern border, there won't be a terror organization that's controlling a country. And then we can, of course, discuss further options. We don't want to escalate the situation more than it is now. We want to go into some kind of stabilizing the entire region. But of course, as I said, the key is in the hands of the other side in this case. We for sure won't stop the campaign. We won't stop protecting our borders, our sovereignty, and of course, our people.
Right. According to different reports, Faraz Saib, Israel did not keep US in the loop when it carried out that attack on Hassan Nasrallah and other members of the Hezbollah. How would you react to those reports?
Well, our relation with the United States is very strong and it's very deep. It's not only strategic and it's not only shared values. It's even deeper than that. The connection is the good relation and connection is bipartisan. All parties in the United States appreciate Israel. We have a huge appreciation to the United States and it stands. Regarding Hezbollah, the message is very simple. Hezbollah has the blood of more than 350 Americans on its hands from terror attacks in Lebanon. It has the blood of French peacekeeping soldiers from the 80s attacks. It has the blood of Argentinians in the attacks in Buenos Aires in the 90s. It has the blood, of course, of many Israelis, if Syrians, of others. So there is an understanding between us and our friends, of course, the United States as our really main and most important ally, that fighting terrorism is not an option. It's not a negotiation. It's not something that we discuss. It's something that we all do. The same way that India fights terrorism, the same way that the United States fight terrorism, the same way that other sovereign countries fight terrorism that threaten their civilians, this is the same. So even if the operation itself wasn't discussed, I have no idea. I don't know what kind of real negotiations happened between Israeli officials and American officials. I know that those kind of things are not something that is really open to dialogue. It's something that we just do. We fight terrorism. Okay. We protect our civilians. It's very easy.
All right. All right, Faraz Saib, thank you so much for joining us on the program. That was the Deputy Chief of Mission of the Israeli Embassy in New Delhi, speaking to CNBC-TV18 on News Center on the attacks that were carried out on Hezbollah. And they have been called a decapitating move. Let's see what happens to the Hezbollah leadership and how Hezbollah, Iran and Iran's proxies attack and retaliate in the coming days. We're taking a short break on that note, but coming up on the other side, Iran condemns Israel's involvement in Hezbollah chiefs Sayyid Hassan Nasrallah's death, adds Israel's act won't go unanswered. A special discussion with Middle East expert and former Indian ambassador Talmiz Ahmad when we're back.
Over the last 2-3 years, we've seen the rise of the so-called industrial policy across the world. Yeah. National security is being prioritized, as you said. Do you see this as part of that, in the context of that?
Yeah. So industrial policy, I'm a little cautious about. I think to combat some of these things and to do things in your country's own interest, which are hard to do economically, you're going to need some economic policy, industrial policy, like the United States has, for rare earths and things like that, and lithium. Every country is different. So the national security needs of India are going to be more around energy. I think for everybody, it's going to be semiconductor chips. So I do think that's industrial policy. I would caution industrial policy when it's used for regulations, bureaucracy, politics, votes, social, and it doesn't have, the twin of permitting, it's not going to work. So you got to be a little cautious when you use it. But yeah, we're going to have some. And like I said, I think it's very important that America and India have a great economic relationship.
Would you agree, though, that in the former part of what you described, industrial policy is kind of taking the lead? Businesses and who you align with, who you want to do business with, building supply chains. A lot of that is now, it seemingly is led by that. I mean, what governments really want to do.
Well, no, it's two different. Governments have always negotiated economic arrangements, stuff like that. If you look at the United States, the industrial policy is a very teeny part of the economy. So it isn't like it's taking over the economy. Right. I think in other parts of the world, it's obviously a much bigger part of the economy. So, but yeah, nations, because of national security and because of what some people might consider unfair competition, there will be forms of industrial policy. If I was a government, I'd be very, very careful. It should be very targeted, very specific. It shouldn't be to protect local industry. It shouldn't be to just create jobs. It should be for a very specific reason. But you're going to see it, and hopefully it's well done.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, the stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down. Inflation is coming down. And relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality. Yeah.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut.
Welcome back. You're watching News Center. Iran has condemned Israel's involvement in Hezbollah chief Syed Hassan Nasrallah's death. In a statement, Iranian Foreign Minister Nasser Kanani has said that the country will not leave any of the criminal acts of Israel unanswered. Could this lead to an all-out war in the Middle East? How will this impact tensions that have already been going on for the last 1 year? Joining us right now is Talmiz Ahmad, foreign Indian ambassador to Saudi Arabia, Oman, and someone who is an expert on the Middle East as well. Ambassador Ahmad, thank you very much for joining us. Would you actually call this a decapitating blow to Hezbollah, or do you think the group is now strong enough to absorb, regroup, and re-emerge?
There is no doubt that the Hezbollah has suffered a very major blow. A large number of its top leaders have been killed. Israel has also indicated its technological outreach through the explosion of the pagers and the walkie-talkies. Israel has indicated that it has the capacity to inflict extraordinary damage on this organization. Does this mean that the organization is now finished? Certainly not. This kind of assaults on Hezbollah have taken place several times in the past. In fact, the former leader, the leader before Hassan Nasrallah, had also been killed by the Israelis. Indeed, it has been a pattern, as far as Israel is concerned, to take out senior leaders of movements that are opposed to them. But that has served only a domestic purpose. It for a moment shows their leadership, particularly Prime Minister Netanyahu, as being a very effective and powerful leader of his country. But the factual position is, and that is borne out by history, that such assassinations actually serve very little useful purpose. Such movements are able to get together all over again. They have a very motivated cadre. They also have a leadership that is well trained and also anxious to prove itself. So while there is a setback, no denying that, it will recover as it has done in the past and will remain in robust opposition to the Israelis in the coming weeks, months, and years.
Right. Right. That's an important point, sir. And when it comes to impacting Iran's influence in the region. Do you think now Iran will be forced to react and retaliate directly against Israel?
Iran will retaliate, but at a time of its own choosing and in ways that it believes will be effective in terms of its own national interest. Iran has been deliberately and consciously provoked several times, both by the Americans as well as by the Israelis. Both of them have been anxious to drag Iran into an all-out conventional conflict so that Israel can repeat the assault on Iran that it had done in 1967 on Egypt and Syria. Because of 40 years of sanctions, Iran does not have a conventional military capacity. It has safeguarded its interests by building non-state actors across different parts of the region. These are not conventional forces, and it is very easy for a conventional force like Israel that is armed to the teeth and provided state-of-the-art weaponry by the Americans to assault these cadres. As you know, in order to take out one high-profile leader, the Israelis are willing to kill 100 and even 200 people. For them, Arab lives don't matter. You have seen this in the case of Hamas. Just a few people have been killed in terms of leadership, but 40,000 Palestinians have been killed. My own assessment is Iran is not likely to be dragged into a major regional conflict because that is not a conflict that it can win.
Right. When it comes to a coordinated response from the axis of resistance, do you feel that Iran's proxies in the region will retaliate? We could see a coordinated attack on Israel as a result?
These various non-state actors, militant groups, have as their priority concern a domestic agenda. Hezbollah is concerned about Lebanon security. The Iraqi cadres are concerned about their political influence within Iraq. The Houthis are concerned about their place in Yemeni politics. Each of them has emerged as a player in the current conflict because of the atrocities perpetrated on the Hamas and on the Palestinian people. Each of them has said very clearly they will stop their belligerence the minute there is a ceasefire and humanitarian assistance is provided to the Palestinian people. But the Israelis have no interest whatsoever in a ceasefire and in a peace process. They do not wish to address the core issues that animate anger in the region. And that is why you find Israel's leaders totally committed to a permanent conflict in the region rather than address the issues that are the original source of the conflict. I don't believe there will be any concerted attack. I feel that each of these is autonomous. Iran is a broad inspiration and possibly has upgraded their weapons capacity, but that is all. Iran, this is not a coherent or cohesive group that is like that is formed like a military coalition. It is not. These are all non-state actors. All of them have certain weaponry, but these are militia at the end of the day. They do not have the weapons capacity that Israel has in terms of aircraft, artillery, and the technology that supports its weapons of war in current times. So none of them is capable, either separately or jointly, they are capable of inflicting considerable damage on the Israelis. They can be of nuisance value, but that is all. What animates them is their anger, their commitment, and their larger purpose.
Yes, you made an important point that they will serve as nuisance value for Israel in the months and years to come. Now, coming back to the possibility of an all-out war, how do you think the American election could be impacted by Iran being drawn into the conflict, a larger all-out Middle East war? And do you think there could be some impact on Netanyahu's war against Hamas and also Hezbollah, depending on the outcome of the US election, Ambassador Ahmed?
I must confess to you that I am completely appalled at the role of the United States in this extraordinary conflict. The United States has been a bystander. It has been a major provider of weapons to Israel and has made weak statements from time to time urging a ceasefire. I am personally convinced as of now that the president has been rebuked in public by Netanyahu, and he has bleated from time to time saying that he wants this ceasefire or that ceasefire. I don't actually believe that the United States has any commitment to a ceasefire, nor does it have any influence on Netanyahu. But they do not have the courage or the capacity to stop the supply of weapons. So today, the kind of mass murder, what many have seen as genocide, that has been perpetrated by the Israelis over the last year is entirely on account of American weaponry. American weaponry in Ukraine, where they are fighting the Russians to the last Ukrainian, and here they are pursuing in West Asia their own agenda at the expense of the lives of the Arab people in the region. This is mass murder as a camouflage of the absence of policy. Will it impact on the elections? The elections, the American political order is dysfunctional. It is in disarray. This is a quarrel within the United States that is a polarized country. Two people are competing with each other on issues that are overwhelmingly domestic. None of them has the capacity to be tough on Israel, either now in the election period or afterwards when one of them sits in the White House. I do not believe that any American president has the capacity to actually stop weapon supplies to the Israelis and demand that a two-state solution be pursued. They will not be able to do that. And because of this, knowing full well this American weakness, Netanyahu has carried out this mass murder and genocide right in front of our eyes.
Right. Very important points there. Thank you very much, Ambassador Ahmed. Always a pleasure having you here on CNBC TV18. With that, we come to the end of News Center. Thank you for watching. Goodbye.
So my question is all geopolitics, which may determine the state of the economy. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries get involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest question. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy. But we are spending a lot of money. And in my view, that spending the money causes growth. It also causes inflation. And whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm putting me on the cautious side of that one.
US has been trying to reduce its dependence on China. India has been and is expected to be a big beneficiary of it. Do you think we are sort of using that full potential right now, or there's a long distance to go?
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation look at it and say we can't rely on someone who might one day be an adversary, that doesn't make them an adversary today, for supply. Just like JP Morgan's always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like if countries are aiding and abetting industries to dominate global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought, It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. This semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. A huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got US elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that? I mean, in that sense...
ICICI ETF and CNBC-TV18 present Smartly Passive, unlocking the world of ETFs.
In current times, consumers are seeking easy investment solutions that offer better returns on their hard-earned money. With this in mind, CNBC-TV18 and ICICI ETFs present Smartly Passive, Unlocking the World of ETFs, an informative masterclass where top industry professionals share insights on the current financial landscape and how passive investment tools can be leveraged as a part of a portfolio. Passive investing, notably through exchange-traded funds or the ETFs, has emerged as a significant trend in India. And in this masterclass, we help you understand how ETFs can serve as a strong diversification in your strategy and your portfolio as well. As always, our industry experts will share their success mantras for prudent investing as well. Let me introduce them to you. Please welcome Gurmeet Chadda, the Managing Partner and Chief Investment Officer at Complete Circle Wealth, and Chintan Haria, the Principal Investment Strategy at ICICI Prudential Asset Management Company Limited. And in this episode, we'll focus on the commodity ETFs. These funds invest in physical gold or silver and can help you diversify your portfolio. So let's take a deeper dive into these funds as well. But first up, gentlemen, thank you so much for joining in today. It's a very interesting topic, so we have to get going and try and understand more about this as well. Chintan, let me start with you. Thank you for joining us in the studio. And you know, there's so much attraction towards physical gold, physical assets, physical silver in the country. There's a growing attention towards digital assets as well when it comes to digital gold or digital silver as well. What's your view on this? Is that the way to go about investing in some of these commodities?
So let's look at the history. 20 years back, there was no gold ETF. So there was no option for investors to invest in, in the form of digital gold or in the form of gold ETF. 2 years back, there was no silver ETF. So now today, those options are there. And versus storing it physically, of course, it's easier to invest through ETF. So clearly, it's a long way to go. Physical silver and gold still has a lot of comfort in terms of how people perceive it. Of course, jewelry is one aspect. But in terms of investment avenues, I think more and more gold ETF and silver ETF would form part of everyone's portfolio. And from a financial investment standpoint, that's an easier way to go by, right? You do not really want to store large quantities of silver. It's difficult. And gold, of course, while we do want to store it physically and people want to have it, let's remember physical storage and gold ETF is equal because gold ETF is backed by physical gold. So effectively, you are buying physical gold, but in an easier form.
And you don't have to pay for the storage costs as well.
Yes, you do pay, but through a more institutionalized mechanism which reduces your cost, and you don't have to worry about security as well. And more importantly, the purity.
Okay, all right. So that is how we compare it with physical gold. Gurmeet, your take on this, the popularity that these digital assets are gaining. Do you like this particular segment as well?
Oh, absolutely. And as Chintan said, gives you purity, gives you the added advantage of flexibility like financial instruments. They are traded like any other stock on the cash segment of BSE, NSE. And 1 unit of ETF basically is, for example, in gold is the price of 1 gram of gold. So if gold is, let's say, trading at 72,000, for example, the price of 1 unit of gold ETF would be basically 1 gram, which is, let's say, 7,200. So it's convenient. It's and post budget, it's become tax friendly as well. So now, if you see the listed gold ETFs, they are flat taxed at 12.5% after 12 months. So safe, pure, no storage issues. Gold also doing very well in the portfolio. If you see last, for example, 30-year returns, equity is about 14.5, gold is about 13.5. And much lesser standard deviation. So if you see the maximum drawdown in gold That's hardly 25% compared to, let's say, 55-60% in equity, which we saw in 2000. So, good asset class to be in. The kind of geopolitics and the world which is moving towards, a new order makes sense to, gives you hedging benefit, gives you returns, low volatility, and very convenient.
Oh yes, and gold is everything that one can talk about in last couple of months, right? So, Gurmeet, coming back to you itself, just simplify it for our viewers. You spoke about how gold connects with an ETF, how they are priced. But what are commodity ETFs exactly? Other than gold, we have silver as well, other commodities. So how can one invest there through these funds?
So, commodity ETF is nothing but a passive vehicle which tracks the price of that particular commodity backed by physical commodity, right? So these are physical commodity backed. In India, we have physical ETFs. Globally, it's more complex. We have synthetic ETFs also, but that's too complex. So you can invest in silver. There are agricultural commodities. There are ferrous, non-ferrous metals. But for the sake of simplicity and the sake of understanding, because commodity as a word is quite complex, India, for example, the easier is to do gold and silver. While gold we just discussed, silver, on the other hand, actually is both a precious metal. It's also called a white metal, and an industrial metal. So silver is actually a function of two things. One is in terms of it being a precious metal, and it tracks industrial consumption. So silver would be very much like equity. It tracks manufacturing activity, mining activity, and that is why if you see the volatility in silver would be much higher versus the gold. So if I compare all three, as I said, last 30 years I'm talking about, 30-35 years, equity 14-15%, gold about 13%, silver about 7.5-8%.
Okay, get that, and thank you for that differentiation that you explained very nicely as well. So that is how commodity ETFs work. Chindan, coming to you, because when we talk about gold, there's so many avenues now available. We have sovereign gold bonds, we have digital gold. How does it differ from, say, an ETF? And what are some of the advantages or, say, disadvantages as well if we invest in a gold and silver ETF versus the other avenues?
So if we look at clearly from a gold investment standpoint, sovereign gold bond, which started I think in 2015-16, have their advantages of having an yield of 2.5%, and post 8 years of holding period or on maturity, there is no taxation. So clearly that advantages are there which have been given by the government for those who subscribe to it. And today if we look at it in terms of the incremental investments or incremental sovereign gold bond issues, there are not many. But on the other hand, gold ETFs clearly have the advantage of you not having a limit in terms of how much you can invest. In sovereign gold bonds, there's a limit of 4 kgs per person per year. Apart from that, of course, as an asset allocation tool, if you want to trade in and trade out, gold ETFs and silver ETFs provide that much more liquidity. They are easier to probably enter and exit in larger quantities, because still the sovereign gold bonds, even though they are listed on the markets, they are not that liquid, and currently because of the scarcity premium, they are actually trading at a higher price than what they should be justified based on the international price of gold. So there are pros and cons, of course, but the way we look at it is if you want to buy and hold, then obviously you can have both the options. But if you want to put it as part of an asset allocation strategy, then gold ETFs and silver ETF do have an edge. Physical gold, of course, in terms of jewelry, there are making costs, etc. So that is a completely different, and the touch and feel of gold is something which everyone likes, and so that cannot be replaced. But in terms of investment avenues, both sovereign gold bonds and gold ETFs work for investors. However, gold ETF does provide them with added advantage of no limitation on how much you can invest in that, plus the easy entry and exit in terms of the online on the exchange. You can trade them much more easily.
Indians love physical gold, but of course from an investment point of view, these are some of the avenues which would be available. So say when we are talking about investments, Chintan, what role would silver ETF and gold ETF play in the overall portfolio construction? Are these short-term bets that one can take, or does it have to be for a longer term where they can put in their portfolio?
So clearly if we break it up, if you look at gold, for example, right, for the last 14 years, say 12 years, US markets have done so well that equities have basically taken limelight and the maximum amount of flows. Gold from 2011 till 2021 did not perform, and arguably it has just about come up to its 2011 levels in the international markets. So gold is now starting to get its flows in terms of international ETFs, but just look at the comparison. International ETFs in terms of equity ETFs have an AUM of almost $7 trillion. Gold ETFs are only about $240 billion.
Wow.
That's just 3% of the equity assets. Globally also, if we look at the comparison, total equity in terms of market cap globally is $100 trillion. Debt is $300 trillion and gold is only about $15 trillion based on the available gold that has been mined in the last 250 years. So clearly, gold has been the forgotten asset class despite it having a 5,000-year history of store of value. Of course, it has a lot to do with money printing leading to equity markets doing well, and I think a lot of money chasing that. But I think that will change as we move along and more volatility. And whenever there's volatility, whenever there is a little bit of panic in the markets, gold becomes an asset class of choice. So as a diversification tool, we are suggesting anywhere between 5 to 10%. Put it in gold today. You made a lot of money in equities, maybe book profits there, no harm in that, and have it in gold so that it gives you comfort. It may not have yield, of course, if you invest in gold ETFs, but it gives you the comfort and safe haven investing. And even if a little trickle from this $100 trillion move towards gold, you have it. Silver is a completely different story altogether. 4 consecutive years of deficit. This year the deficit is supposed to be the highest, and now today, unlike earlier, 20% of incremental demand annually in silver is coming from the newer asset classes like solar and
new energy,
5G, new energy. That is something which is causing silver demand to go up sharply while supply is stagnant. So 4 consecutive years of deficit in a commodity, there is a definite stretch in terms of the availability of physical silver. So we believe physical silver can, or rather silver ETFs can also be a part as a diversification tool. It won't do what gold does. So when markets actually are volatile, silver may show some volatility. But in terms of just the demand supply mechanics right now and the new age requirement of silver, we believe silver is a good addition to your portfolio. So gold plus silver around 15%. Earlier when we would have spoken, I would have said 10%. Now just increase it to 15%. Because the outlook on equity is getting that much more volatile. And so it's better to have some safe haven asset like gold and silver where the demand is genuinely strong right now.
Very interesting, and the data just shows how much more headroom is available for investments here. Gurmeet, your take on this one, because we usually talk about gold as an investment, silver doesn't get spoken about so much. But as Chintan just pointed out, this has a bigger supply-demand gap, so to say, that we are seeing right now. What's your take?
Well, I think I endorse what he's saying. Also, we get so carried away with returns, we forget the 2 other aspects of asset allocation, which is low correlation and diversification, right? And gold has the least correlation with asset classes. It typically does well when there is a crisis. It did well in 2008 when Lehman happened. It did well during COVID period. It jumped up when you had a Russia-Ukraine war. So does well in a crisis. So it has that hedging benefit. So we originally migrated from Pakistan. I remember my granddad used to tell me that an ounce of gold is good enough to run you for a couple of months. It still holds true. An ounce of gold is about 28 grams. That's what roughly about more than 2 lakh rupees. You can still survive, right? If you have an ounce of gold. So it doesn't lose its purchasing power, and that's the point I think even Chintan was making. Silver, as I said, it's if you track silver, it's a bet on the new age themes which are coming up and a broader revival of manufacturing, mining, etc. So if you're gungo on and the way the geopolitical situations are evolving, supply chains are getting disrupted. Hard assets will do well. And if you see, a weak dollar, if let's say the kind of debt US has, and now US will start cutting rates, we have a Fed meet today, a weak dollar traditionally is very good for commodities. So, the macro is in your favor. The gold gives you a power, protects your purchasing power plus returns. Silver gives you a play on the rising new themes and industrial activity. So perfect makes sense. 10% odd in your portfolio should be towards gold and silver.
Okay, so words of wisdom from your grandfather as well. It's been coming in from generations, clearly. The love that Indians generally have for gold, but of course we have diversified the way we invest in gold as well right now. Gurmeet, just to follow up on that, now that we're talking about returns, usually that's what investors look at the end of the day. We have to talk about post-tax returns as well. What are some of the key tax implications on investing in, say, gold and silver ETFs, if we compare it to holding physical gold or silver?
Yeah, so physically, if you hold it, you have to hold it for 2 years for long-term capital gain, which is 12.5%. And obviously, if you hold it above a certain threshold, there are wealth tax implication, but that comes once you hold a very large quantity. In an ETF post the recent budget, because it becomes a listed financial asset technically, because the underlying is financial assets. An ETF on the exchange, the taxation is 12.5% after 12 months. So in terms of tenure, it's more efficient than physical gold. But if you, for example, take a gold, there's another option of gold ETF. Sometimes there can be liquidity issues for a retail guy. There could be a creation unit size issue. You can also take something called a gold savings fund, which is basically a fund of fund which invests into gold, where you can actually do an SIP also, you can do an STP also. So it offers you all the mutual fund convenience if you take a fund of fund route. So digital and physical gold are 2 years, 12.5% long-term capital gain. Gold ETF is 12.5% after 1 year old.
Okay. It's turning out to be a very interesting conversation. I'm learning so many new things about gold, silver, ETFs and generally that asset class. But we have to get into a quick break. It's time for a break. We'll continue this conversation right after this short break, so don't go anywhere.
ICICI ETF and CNBC-TV18 present Smartly Passive, unlocking the world of ETF.
Irreversible? The break in relations, sort of a Cold War?
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America in that one, so that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about disconnecting.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, On social, ICICI ETF and CNBC-TV18 present Smartly Passive, unlocking the world of ETFs.
Welcome back. You're watching CNBC-TV18 and ICICI ETFs present Smartly Passive, unlocking the world of ETFs. And we are diving back into our very interesting conversation. It's all about commodity ETFs. Chintan, let me come to you. You gave us this data, and I'm really boggled by that till now gold and silver is such a small part of the overall ETF picture globally as well. So how do you see the role evolving in the next decade, especially with the growing interest in digital currencies? There are so many of them. Alternative assets have also come up. So what does the next decade look like here?
So I think the last decade was in general a decade of low inflation, low growth for the world. Arguably with US slowing down and likely to cut rates, and China also wanting to prop up their economy, maybe the prices of goods in China go up, prices of services in US go up, leads to inflationary pressures. So unlike the last decade, 2020 to 2030, which is this decade, may see inflation running high. And as Gurmeet mentioned, inflation causes commodity prices to do well. And within that, silver, for the purposes mentioned earlier in terms of demand supply, and gold, because of the sheer underinvestment in gold, both are likely to probably do well eventually. It's not like there will be a straight line, there cannot be corrections. But as part of asset allocation, they should be a part of investors' asset allocation for diversification benefit. And it's not just silver and gold, arguably copper, aluminum, zinc, and any commodity that you can think of. I mean, because the world is where it is, crude today is at $70. Otherwise, with all the wars happening, crude need not be at 70, but the demand is definitely anemic globally. There is a chance of a bounce back eventually when money printing starts in US, and of course China also takes some action. At that point of time, you will find these commodities start doing well, and probably being invested in them today and keeping space for averaging them lower will ultimately help achieve the objective of creating wealth through commodities as well. Gold and silver both, for different reasons. Gold as a safe haven investment and something people will eventually go back to, right? Other asset classes which you mentioned, like digital currency and all, probably new age or newer generations can understand them better. But the people who have real money and who are probably having it largely in equities today would look to again go back to the safety of gold at some point of time. In universal pension funds, don't invest in gold because there's no way to value gold, and it's not part of any benchmark indices, and they track benchmark indices. But hopefully that will change as we move along and when gold starts to do well. When something doesn't do well for 10, 12 years, obviously people forget it. But last year and this year, I think gold has been one of the better performing, if not the best performing asset class. And 2-3 years of doing that, probably people will rush back into it, and we have to position ourselves before the gold rush, so to say.
Yeah, millennials and boomers with the real money, they would be the one looking at gold and silver like that. Gurmeet, your take on this, the next decade for this asset class?
No, looks positive, as been last 3 decades as well. I just pointed out, I think it looks good. And I'm a great believer that the way central banks have printed money, look at the debt US has now, it's about $36 trillion. The interest payment has crossed $1 trillion. That's actually now the third line item in their budget. It's crossed the defense payout. So I think the way, this fiat currency will continue to lose some value relatively. And that's where I think if you see central banks across the world are adding gold and will diversify more from dollars. So I'm not saying, I'm not in the camp that, the de-dollarization as all is happening. But I think there'll be some shift which will happen. We are seeing that we saw globalization last decade. This decade is more like regional blocks, right? With China, Russia, one block, Europe,